down by 2.8%. This as a result of that read across from those Fed minutes, so selling in particular tech stocks. The dollar is not the haven of choice, though, it seems, through the Asia session. It's the yen that's getting the gains. We're back to thinking about a higher yield environment. That goes hand in hand with that Fed narrative, Tom, of course. And so we're seeing yields go higher. We've got the US 10-year yield here, but it is a broader theme and has been developing through the Asia session as such. And oil prices certainly in focus. Manus Cranny on the ground for us at Vienna, at that OPEC meeting, talking about what kind of time frame they've got to push through some of these cuts in production they've been talking about. What do you see in futures?
Futures are pointing lower, pretty significantly on the CAC Garn. Futures down by 0.8%. Anna, here in the UK, the FTSE 100, again, back below that 7,500 level. In fact, 7,400 is where you're hovering right now, with losses of 0.6% priced in for these markets. DAX futures down by 82 points, Anna.
Okay, so that's the weakness we're expecting at the start of the European trading day. Let's see if that comes to pass. The FTSE 100 out the gates first, as is usual, down by 0.1% or so. The Spanish IBEX down by just over 1%, so slightly higher beta market maybe. So the Spanish market leading the fallers right now. Interesting that the dollar index is on the back foot, though. So we're sort of risk off, but we're not buying the dollar, we're buying the yen. As I mentioned, the yen has been gaining. The Australian dollar up by 0.4%. The euro, a little bit of a gain there. We got some factory orders data out of Germany earlier, Tom, as we were saying at the top of the last hour, and actually it underscored the recovery we've seen in that data set. It's really volatile. It was only 1 month's worth of data, but perhaps worth noting. And I mentioned the higher yield environment back in vogue post those Fed minutes, and that's certainly evident in the sovereign bond column. 5-year Australia, 30-year Spain, take your pick, all kinds of geographies in here for you. And we see higher yields, once again, a big topic of conversation on these markets.
Every major sector in the red, and the loss is really being felt in basic resources, down 0.8%. We've seen iron ore, copper under pressure, and a reminder today that the debt crisis in China's property sector is still a long way from being managed and resolved. A number of stories there have led to concerns about the demand then for some of these basic resources, and that is hitting the sector. It's now down 1.3%. Technology also taking a hit, down 0.9 on that higher yield story. Energy off by 0.7%. Manus Cranny on the ground with us, for Vienna, in Vienna, of course, for that OPEC symposium, and the cuts that have been extended from the Saudis, but not putting a floor so far under prices. So this is the picture across the session. Also worth flagging what's happening in travel and leisure, currently down 1% on the session, 0.8% lower for autos, and that was one of the few sectors, one of just 2 sectors that remained in the green yesterday. But it's basic resources, technology, retail, energy that are leading losses at this stage, Anna.
Okay, that's what the market is telling us right now then, a fairly red picture across the board. Let's get to Sam Unstead, who joins us once again from the Markets Today blog to reflect on the market open and think about some of the other stories that are doing well on the blog this morning. Interesting to think about something that has been talked about a lot over recent days, and interesting to see regulators perhaps being called on to act now. The UK telling the FCA to step up its review of bank rules for politicians. Now, do we call this the Farage fallout? Is this in response to what's been happening with his bank account? But it seems clear that this is a broader story than just one person.
Well, we certainly can call it the Farage fallout, so why not? But I think this is quite a strange story, but I think it does feed into something that we've seen over the course of the last few weeks, which is the government and regulators pushing different industries in different ways. You know, this one is less about consumer. You know, this is, you know, you've seen a lot of meetings with banks about savings rates, which is much more consumer-focused issue. This seems like a bit of a side issue to me in terms of the banks. I don't know how much risk this really poses to them, but it keeps them in the headlines. You know, it keeps them being under pressure.
What about the pressure that's coming through from politicians, from this government, around deposits at banks and deposits being raised as people struggle, of course, with remortgaging? The government has said, the Chancellor has said, look, one thing we can do is pressure the banks to raise those deposit rates as interest rates rise.
Yeah, and I think that's, I mean, so I think part of this is a political move. You know, it's, you know, as you guys mentioned a few minutes ago, we do have an election coming up probably in the next 18 months or so.
Yeah.
This is a push to try to take away some of those.
Is it a risk for the banking sector?
Yeah, I think it's a risk. You know, I think any extra oversight, any extra regulatory oversight that may come from that, it is a risk. Remember as well that a lot of that rate benefit that especially UK banks have been getting has been fading. And if that starts to fade off and they have to start passing on more and more of that in savings rates, then profits are going to get hit.
Take us to another story that I know you've been covering on the blog. The billionaire Jim Ratcliffe seeing UK energy policy, quote unquote, wrecking industries. What's his take?
Yeah, so I mean, he's talking particularly about nuclear and about just investment, the way that the UK invests in manufacturing industry. I think bear in mind here, I mean, Jim Ratcliffe's been a very busy man in the last few months. You know, he's trying to buy Manchester United at the moment. He had a deal fall through for Ineos, after which he was criticising the Competition and Markets Authority. So I think this is kind of the next leg of that. Remember as well, he is a Brexiteer, so he wants this sort of free market, you know, economy, or certainly one of those types of Brexiteers. So, but specifically, he's going after energy policy and how we're investing in energy to create jobs.
Yeah, he's got plenty of skin in the game on that question, hasn't he? When it comes to the tech story of the day, as we were discussed with Anna earlier, around Threads. Have you added? Are you on Threads now?
Not on Threads yet.
See,
Tom's an early adopter. Tom's an early adopter. It results in a phone that buzzes a lot. Is so far what I've learned.
That's because I'm technologically incompetent. I haven't worked out how to
it's because you're busy. You haven't had time to change the settings.
I feel like once Sam is on it, that for us that's the big tell. When Sam Unstead is on, then we know it's going to be a success.
That's very flattering. Totally untrue. But I would also say, you know, one thing that I would want to know, for I think you're going to speak to Tom Seal again very soon. What's the verb for it? You know, so you tweet when you're on Twitter. Do you thread? Is Tom going to be threading?
That sounds like a dance move.
So something to think about for the rest of the day.
That's very important. Thank you very much. I can't get over the reference to clothing as well, but I think maybe that doesn't translate to other geographies. Maybe that's
not, but it's only day one.
Just a London thing. Okay, thank you very much.
Sam Unstead threading some of those themes through the markets today, of course. Check out the blog as well. Sam, thank you. You can get more, of course, from the team on the front page of Bloomberg UK, the website, or by typing TLive Go on the terminal. Let's check in on some of the individual stocks on the move. Joe Easton had teed some up for us before the start of the session. Joe, how's it all playing out?
So, Tom, we're going to have a look at some of these early movers. Now, Currys, that's the big decline in the UK today, dropping as much as 10% after they refrained.
I think we might have an issue with Joe's mic, which is a shame because he was about to take us through some early movers. Let's see if we can rectify that whilst we reflect on Currys down 8%, 8.3%. In fact, he was going through that story. So interesting on the UK consumer, the story they were telling and the impact that's having on their share price this morning. Let's, in fact, go to what's on the day book. So things that we're watching out for from a market's perspective today. At 9:30 a.m. here in London, we're set to get UK construction PMI data. This afternoon, between 1 and 2 p.m. UK time, the Polish Central Bank will deliver its latest policy rate decision. At 1:30 p.m., fresh US jobless claims are published. A short time after that, at 1:45, Dallas Fed President Laurie Logan speaks at a central banking event. That, of course, comes just after the FOMC minutes. We had those out last night. Then at 3 p.m., we'll get the JOLTS data out of the United States. Job openings. There's a real focus on all of this jobs data as we build. We've got 3 pieces of jobs data then when it comes to JOLTS, claims, and ADP, building towards the non-farm payrolls tomorrow.
So the claims, the JOLTS, the ADP, and then the non-farm payrolls with that survey expectation of 225,000 and the jobless rate as well, the unemployment rate. And again, to what extent is this jobs market in the US holding up? The picture still seems to be, and the word resilience came through in the FOMC minutes about 11 times.
Right.
In terms of the number of times they repeated the word resilience. Does that continue to be the theme for the jobs market?
That's really interesting, isn't it? Because that points to a lack of cracks in the jobs market. I mean, if we get the numbers that the Waco function suggests we should get, which is an increase in jobless claims, a drop in JOLTS, and a decrease in job creation in the private sector, all of that would point to a less tight labour market and things moving in the direction that the Fed wants. But then I was just looking at what we're expecting on non-farm payrolls. Sure, a big job creation number in the 200,000s or so, but we are expecting actually unemployment, the rate there, to drop down from from 3.7% to 3.6%, moving in not the right direction as far as the Fed is concerned.
3.6% for the unemployment rate in an environment where you've got a range of, 5 to 5.25% on the Fed's funds rate. It's pretty remarkable. Things on some levels looking like they're pointing the right direction, but that unemployment rate may be concerning for the Fed as they try to get their hands around core inflation in particular. Coming up, more on the markets with Charlotte Ryland from CCLA Investment Management. We'll get some of Charlotte's calls and her assessments of where central banks go from here. She joins us after the break. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is markets today, 11 minutes into the European trading day, and a sharp move lower on European stocks, down a full 1 percentage point. And the bloodletting in the CAC 40, the French market, down 1.5%. A redhead across the terminal now in terms of the implications for the UK. Traders fully pricing in a BOE interest rate peak at 6.5% by March. It had been around 6.2% in Feb. 6.5% now is where markets are pricing in the terminal rate for the BOE by March. We will put that conundrum, or at least that possibility, to Charlotte Ryland shortly. But before we do that, let's get to some of the individual stocks that are on the move this morning. Joe Easton. Joe, how is it shaping up?
Absolutely, Tom. So we're starting in the UK, following those headlines on the BOE there, but Currys is the big decliner today, down around 10%. We said it was bad. They've scrapped their final dividend, and also warned of some weakness over in their Nordic business as well. That one's sliding a lot. Meanwhile, the sugar company Südzucker getting a boost in Germany. Some supply constraints are pushing up the price of sugar, including the El Nino weather patterns over in the Pacific. Meanwhile, the operator of the Paris Stock Exchange, Euronext, they get a downgrade by Deutsche Bank, who warns of subdued trading volumes in equities and other asset classes as well. Meanwhile, Embracer, this is a video game company behind titles like Tomb Raider. They've had to raise some share placing in order to get some new funds. They've done that at a discount, and that stock is dropping as much as 9% over in Stockholm. We're also going to have a look at some of those paper companies. I mentioned earlier JP Morgan and Morgan Stanley both getting more positive on these names. Smurfit Kappa, Mondi, UPM all seeing small gains with the price of paper expected to soon hit a bottom, a bit of a boost maybe coming back from the online retail business, given a slump in that recently. Finally, brought up United Utilities. This is a stock that's been hit due to concerns around Thames Water and the read across around that. But Morgan Stanley, again, today reiterating that this is a safe company in terms of their debt load, and they're positive, recommending people buy into United Utilities. That one up around 2% in London.
Yeah, interesting. Back to those paper makers then, Joe. Interesting to see those gains. They look modest, but in a market that's dropping, and the stock 600 down nearly 1%, not bad performance. Joe, thank you very much. Joe Easton from our equities team. Let's get to the UK rate story. JP Morgan says there's a risk that the Bank of England will have to push interest rates as high as 7% and trigger a hard landing in the economy to quell inflation. As Tom was just telling us, traders now fully pricing in a peak of 6.5% by March, so maybe 7, not all that far away. Charlotte Ryland joins us, Head of Investments at CCLA Investment Management, to give us her thoughts on the UK and beyond. Charlotte, good to speak to you. What do you make of this, the debate then about how high rates get in the UK? I mean, 6.5% by March, now priced in. JP Morgan talking about the possibility of 7. How high do you think we go?
I mean, I think we're priced in quite a lot in terms of the UK curve. I mean, yes, if you look at the UK versus the US, where we've steadily seen inflation rolling over, the UK, we've obviously had a couple of shocks. We've got wage inflation still remaining very high. But I think if you look at sort of underlying, commodities are moving in the right direction for the UK, energy prices coming down, food prices potentially coming down. Sterling is strong, and that will be helpful in terms of the inflation picture. So other than the wage picture, you know, there are signs of that beginning to weaken off, and the Bank of England already being quite aggressive. That quite a lot of that's been priced into the bond market. You know, and you would expect that to begin to hit in terms of the housing market and in terms of the consumer. So you'd expect some weakness to start to come through, and hopefully that will mean we don't quite have to get 7.
Might limit how high we get, maybe not 7. Okay.
I mean, it's worth reminding, isn't it, ourselves and viewers, that there was a time not too long ago when 5% seemed pretty preposterous to many in the UK. So as Evenram from our MLive team is pointing out, don't write off 7% too soon. Charlotte, in terms of, you interestingly point out, and it is pretty fascinating to consider, the differential in terms of the yield on the benchmark in the UK versus Greece. I mean, you're talking about a 70 basis point differential yields on the UK gilt 10-year, 452, the Greek 10-year, 383. That's remarkable. Is there value then in the long end?
And again, and that's against a country that's struggling and, well, fighting to get back its credit rating.
Absolutely. I mean, it seems, you know, Italy would again be sort of another country where you normally expect that the UK would be somewhere between, you know, Germany and the US and that kind of band, but it isn't. Clearly, that's the inflation issue we've got. Maybe that's Brexit, who knows? But, you know, for us, I think, yes, at this point, we are starting to see a little bit of value coming in from that longer end in terms of the bond market.
So buying gilts at the moment, then, would be something to...
Yeah, I mean, having been, you know, an area where you don't want to be at all, you know, a year ago, now actually I think there's a big bit of value coming through.
Okay. In talking about other things that you're interested in, or focused on rather, the chemical sector, we've seen actually warnings coming through in the chemical sector. We talked about this actually, warnings from industrials with one of our guests earlier on this week.
Yeah.
Do you expect that to sort of to be a negativity that spreads? And if so, is that sort of German industrials, French? What are you looking at?
Yeah, I mean, I think, you know, the industrials have held up really very well. I mean, because if you look at the top-down indicators, the PMIs, et cetera, they're all saying to you, you know, we're moving into a slowdown. But you're not really seeing that coming through in the numbers from the industrials. Has that been things like, you know, the Inflation Reduction Act in the US? Maybe that's been helping. Maybe it's been some of the delayed orders from the pandemic that are actually coming through for these guys. But I think as we move into the second half, you know, the chemicals are probably saying to you, there's probably some destocking, there's probably some weakness to come from those guys.
Does the underperformance that we've seen in commodities, does that start to change in the second half, and how consequential is China within that?
I mean, so far we've had a pretty sort of tepid recovery from China. You know, their property market isn't on fire in the way that it has been, you know, perhaps in past downturns. They haven't got that sort of stimulus that you got coming through sort of, you know, the last financial crisis. So, you know, without that big China driver, without, you know, a big infrastructure boom somewhere else, which we're not entirely seeing, you know, with a slowing economy, you know, there's not a great deal to say that, you know, we're going to get a very tight commodity market.
And interesting, today we see the CAC 40 in Paris weighed down by some luxury goods, certainly heavily weighted LVMH is weaker, and that weighs on that sector down by 1.3%. You could say maybe there's some China read across there. Also, that might weigh on basic resource stocks, might weigh on things that the FTSE 100 does well. Does that mean underperformance in the second half for the FTSE, just like we saw in the first half then,
Yeah.
if commodities aren't coming back?
I mean, the things that drive the FTSE 100 are banks, they're mining, and they're oil. And none of those have particularly positive outlook, I'd say, for the second half.
So to be clear, you wouldn't be increasing. How much exposure do you have to FTSE 100 at this point? Would you be looking to increase, or you stay where you are? Or small caps looking attractive? Anything in terms of
anything in terms of the UK? Is there any hope?
I'm trying to find a silver lining.
Is it guilt?
Yeah,
long in guilt.
No, I mean, I think for us, you know, it's still some of those big global companies. It's something like an RELX, for example.
Yeah.
You know, that's benefiting as people begin to travel more, as conferences come back on, and then you've got a good core business in terms of their sort of legal and their academic publishing. So businesses like that for us still look attractive, but you know, the bulk of the FTSE 100.
We had another guest mention that company, in fact, in an AI context. So that's interesting. Let me ask you about the earnings season then, that's not yet upon us, but will be shortly. Tom was going through some research from Goldman Sachs earlier that talked about a trough in the second quarter in terms of EPS, and then quite a rapid rebuild in EPS as we go through the rest of the year. Is that how you would expect things to play out? Because our guest in the 7 hour saw it differently, saying that rebound comes face to face with some pretty strong headwinds later in the year.
Yeah, I mean, I don't think we've really had the proper slowdown yet. I mean, we all went into the year thinking, actually, you know, it's going to be a really tough, and we're going to get this, you know, big downgrades in terms of earnings. Actually, they've held up a lot better than anybody had thought. So to suddenly think they will rebound into the second half, having not really slowed, I think is perhaps more challenging.
How important is the consumer within that consideration? Are we starting to see the consumer fray, the drumbeat of the theme that these are households and consumers that have a healthy balance sheet? That really came through last year. It was almost kind of a consensus view. Is that starting to fray at the edges now?
Yeah, I mean, I think certainly some of the estimates we've seen in terms of sort of the excess savings that built up in the pandemic, that those have been spent. I mean, possibly there's still some at the very high income levels, but certainly for the bulk of people, that's probably not there as a support. The other thing that's been doing really well, of course, is services, so people going on holiday, going to hotels, et cetera, having experiences. You know, have they spent that money now? Maybe it's going to be a bit tougher. And certainly, you know, things like some of the consumer durables already looking pretty weak. We've had warnings from Halfords, obviously Currys this morning. So, you know, I think that part of it's looking already quite difficult. But it's going to depend on the job market.
Yes, I mean, so we look for cracks maybe there, but I wonder, even before we get those kinds of signals around the consumer, maybe it will be like forward bookings from aviation, from travel companies. That could be something of an early warning sign. What would be the other things that you would be looking for?
Yeah, I mean, I suppose you could look at the hotels. I mean, they're still seeing, you know, very strong occupancy, very strong rates, so they're not really seeing that slowdown yet. But, you know, we're in the midst of the summer, so they probably wouldn't be.
Charlotte, thank you very much. Thanks for joining us. Charlotte Ryland, Head of Investments at CCLA Investment Management. Good to speak to Charlotte this morning. Coming up, Meta's newly launched app is taking aim at the Bluebird this morning. We will discuss a new risk for Twitter next. This is Bring Back.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business, Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
This is Markets Today. 24 minutes into the European trading day, you're seeing losses across the benchmark of 0.7%. Futures in the US as well. S&P E-minis down by 0.4%. And traders now pricing in a terminal rate here in the UK of the BOE of 6.5% by March. To all things tech now, though, Meta founder Mark Zuckerberg says its newly unveiled social media app, Threads, has reached 10 million sign-ups this morning. An hour ago, it was 5 million. The app is taking a direct aim at Elon Musk's Twitter. But the app is not launching, interestingly, in the European Union because of some regulatory issues. For the details, we are joined by Bloomberg's tech, media and telecoms reporter Tom Seal. Tom, first impressions then on this new app, Threads, and whether it really is a contender versus Twitter.
I think Elon Musk may be sweating. I mean, it's a real contender. I've seen, hundreds of thousands of people seem to be flipping over, 10 million, in fact, in the first few hours.
Just to follow you.
And that's just talking about me. And big brands, that's been the big concern for Elon Musk. He's said himself advertising revenue created since he took over. His kind of new approach to moderation may not be very reassuring for them. Whereas you're seeing, they've had a bit of sandbox time on Threads, and the big brands like the NBA, Netflix, they're keen to try it.
Okay, so working on their thread game. I mean, what is this competition going to look like then between Meta and Twitter? Are people going to tweet and thread, or are they going to pick one or the other?
Well, this is the issue, isn't it? It's a kind of annoying proliferation of do I have to post on all of these different apps now? So the network effect is what makes social media great. Lots of people have tried to beat Twitter, and so far Twitter's still here. But this is a real threat as a Twitter killer because it already has the 2 billion users of Meta, and it's been run through Instagram. There's an interesting post right now from the head of Instagram. He stayed up all night, Adam Mosseri. He was saying it's really easy to get a lot of sign-ups on day one, but it's quite hard to keep them coming. So that's the next step.
Tom, how real is the rivalry between Mark Zuckerberg and Elon Musk? We had one of the headlines of the story is Zuck posting a kind of playful, but maybe it's more realistically painful tweet aimed at Elon Musk. Is this real? Is this a very visceral rivalry between the two?
Yeah, I mean, I can't say I've met them, but I mean, I think it is real. The cage match that we're all looking forward to, they're said to be really preparing for it. They're both genuinely into it.
Wait, seriously? Is that a real thing?
All signs indicate it's a real thing. Elon Musk's mother is posting furiously that she doesn't want him to do it.
Maybe it'll happen. Maybe it'll happen in the metaverse. Thank you, Tom. Thanks very much for joining us. Bloomberg's Tom Seal with the latest there. Just a quick word on what's happening with gilts, because Tom, you were pointing to this. We should check in on gilt markets. We're seeing 2-year gilt yields up 9 basis points. We're seeing everything across the UK curve, in fact, all tenors up by more than 5 basis points.
Yeah, some quite marked moves there across UK debt.
Rates broadly across Europe are higher too.
This is true. This is the context. But you are seeing that more pronounced, as you said, at the front end. The 9 basis point move at the front end, 5.46 on the 10-year here in the UK, 4.55 as markets price in a terminal rate of 6.5%. Coming up, we're going to talk OPEC and oil. Stay with us. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Markets Today, 30 minutes into the European trading day. Here are your top stories. Sentiment sours for global equities with European stocks following Asia into the red. Bond yields climb after hawkish signals from the latest Fed minutes firm up bets on a July hike. Meta takes aim at Twitter with the launch of Instagram's Threads, but not so far in the European Union. And traders fully price in 6.5% interest rates in the UK by March. That after JP Morgan warned that the Bank of England may need to trigger a hard landing to quell inflation. Tom, so half an hour into the trading session and things looking gloomy. It's the Fed, it's expectations about higher rates there as a result of the hawkish minutes we got out of the FOMC. Not quite such unanimity on the pause, it would seem. It's also the UK story and the building rates picture here as well.
And so as a result of that, you are seeing the biggest move lower in European stocks in about 2 weeks. So down on the benchmark by about 0.8%. Over in Germany, the DAX is off by 117 points. Here in the UK, the FTSE 100 now back below 7,400 as the level, dropping 0.8%. Yes, you did get the clarity on just how uncomfortable that decision was for those Fed officials in June, and the expectations now that July is almost certainly priced in. And of course, on the UK front, as Anna was suggesting, the markets now, traders placing bets on a terminal rate of 6.5% by March, and you're seeing a move up, a pretty pronounced move up in gilt yields as well, as the sell-off there in UK debt becomes a little more pronounced on the back of that. On your sectors then, let's switch it over because, of course, the losses of yesterday, utilities was one of the sectors that remained in the green yesterday. That has, in fact, reversed. And what you're seeing now, I should say, is that utilities are gaining 0.3. They were actually down yesterday. So this risk-off tilt, utilities is often favored in that risk-off environment. So utilities, the one sector that remains in the green, 0.3%. The selling pretty heavy in autos. That's a drag, of course, over in Germany, down 1.2%. Travel and leisure as well, taking a big hit, down 1.6%. Banks off, financial services, every major sector losses in the session so far. Again, apart from utilities, basic resources tying to the China story, and the Goldman Sachs report, interestingly, that investors do not expect aggressive stimulus to come out from officials anytime soon. 1.3% is the knock across basic resources, Anna.
Okay, so a lot of negativity in the markets this morning. Let's talk about what's going on with oil prices. They're kind of stable, actually, versus yesterday's close, at least. On Brent, 76.54, down 1/8% or so. Crude, then, pretty steady as traders assess the impact of the latest round of supply cuts from OPEC Plus and the US industry report that pointed to another drawdown in nationwide commercial inventories. This as the oil producer groups meet that meeting continuing in Vienna. Here to talk world energy markets, Carol Neckler is with us from Crystal Energy. Carol, very nice to speak to you. So give us your sense of what impact you would expect to see from Saudi Arabia and Russia extending their voluntary cuts. We're still stuck in the 75, 76 range on Brent, it would seem. How would you judge the recent Saudi and Russia move to have gone down with markets?
Good morning.
We appear
well,
to
look,
have
I mean, the Saudis already told us last time they announced the increase. Hello, can you hear me?
Yes, do carry on, Carol. I apologise. Sorry, we thought we'd lost you for a moment, but we can hear you. So do carry on.
All right. So when they announced the cut, the voluntary cut of 1 million barrels a day, when they met last month, Saudi Arabia, they did say that those cuts can be extended. So they announced it for 1 month, and now they extended them for another month. And at the same time, the Russians, they seem to be supporting the Saudi move, so putting a show of solidarity. Now, of course, you might say that the market did not blink because there was hardly an upward movement in oil prices, but then they went back down to just above $75 a barrel. So it seems to me these kind of steps may not be at the first sight that they are making a huge impact on market prices, but they are somehow putting a floor, because these announcements coincided with other announcements that are acting in the opposite direction when it comes to the impact on prices, particularly when it comes to, for example, the data that we saw from China, the growth in the service sector. That data was not encouraging because the service sector, yes, is growing, but not as fast as people hoped for and expected. So that was the first macro data, disappointing data. And the second macro factor as well, macroeconomic factor, is the minutes or the noise that we're getting from the Fed that the pause in interest rate may have been quite temporary, and there will be a return to an increase in the hikes of interest rate. And that by itself will impact negatively the economic growth and therefore oil demand. So as such, on balance, we see what OPEC is trying to do is to put a floor on the price rather than achieving very high prices that many people are hoping for.
Okay, so a floor on the price rather than necessarily pushing to that $80+ price. Carol, what is your assessment of the relationship now between the Saudis and the Russians, and whether or not they are going to be walking more closely in lockstep going forward, the implications of that for the oil market?
Well, we are seeing definitely a show of solidarity. There were rumors there were fallouts between the Saudis and the Russians. But for me, the biggest fallout that we saw was in March 2020, just before the pandemic hit global oil markets and world economic growth. But we are far from being at that level when we had the major fallout between Saudi Arabia and Russia. Of course, you don't expect OPEC Plus to be a coherent entity, but so far, in my opinion, they are doing a good job in sticking together despite the divergence realities in some countries and also perhaps different interests. So given those divergences, I think they are putting on a solidarity front. And the Saudi, throughout the history of OPEC, and today with OPEC Plus, they have always put, with the exceptions, as I said, in terms of what happened in March 2020, but they are putting the solidarity of OPEC Plus as their priority to sustain the influence on oil markets.
Can I ask, Carol, for a bit more of your thoughts on what higher interest rates do to oil prices? So I suppose you would assume that higher interest rates weigh down on demand, and that's going to weigh on prices. But we had some interesting reporting here at Bloomberg this morning that talked about how higher interest rates push up the price of storage, and therefore actually you see reduced storage, and that could have also add a different dynamic to pricing. How would you look at higher interest rates and what that does to pricing?
Well, of course, higher interest rate, their impact is not just straightforward to say that they are going to have only one impact, because there are different players in markets. There are the lenders, there are the borrowers, but the main impact is primarily on reducing the economic activity, taking the heat out of the economic activity, because that is the main purpose of raising interest rate in order to reduce inflationary pressure. So for me, the bigger impact, of course, the impact could be on the storage. That is definitely legitimate. story, but there is a much bigger impact that is on income effect, the demand, oil demand. So that is for me more important than the impact on storage.
Okay, thanks so much, Carol. Thanks for joining us. Carol Neckler, CEO of Crystal Energy, with her outlook on the oil market. It's interesting to get your perspective. Coming up on the program as the social media fight between Threads and Twitter gets underway, what's the state of play in the battle for tech dominance between the US and Europe? We'll discuss that next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 41 minutes into the European trading day, and it's a negative session upon us. The CAC 40 in particular in Paris, down by 1.4%. There we've got some luxury goods companies weighing heavily on that index. Also some banking stocks are weaker, but the overall picture for Europe is a weaker one. Higher rates expectations in the UK, certainly to the fore, but also the aftermath of the Fed minutes last night, also raising expectations of how high rates go. Tom, and thinking about rates, thinking about the US investment picture, where inflation goes, where stocks go, all of that leads us to your morning must-read.
Yeah, well, there's a lot of focus, of course, on what happens in the earnings session and whether some of the consensus forecasts are really going to be able to hold up in an environment of still sticky inflation, of course, and higher rates as we digest that hawkish FOMC message. So I wanted to zero in on this piece by Ed Harrison of Bloomberg M Live, and I'll pull out this quote for now. Forward-looking views of stocks has shares trading hands for over 19 times earnings now versus the median of just under 16 times. So 19 times versus 16 times. And Ed says that is contingent. That could play out. It could play out if we got the similar dynamics in the first half and they are reflected in the second half. Those dynamics of slowing inflation, but growth holding up. He just says that is looking pretty unlikely. That is the Goldilocks scenario, and he's not in that camp. He thinks that stocks have gotten over their skis, and he highlights a bit of research by Goldman Sachs, which suggests that, in fact, for the second quarter of this year, we're looking at an earnings recession of -8%. There it is, there's the earnings recession. But then the consensus forecast suggests that you get a very sharp rebound in the fourth quarter. Again, that only happens, he says, if you get that Goldilocks scenario. But there's a couple of other scenarios when it comes to inflation and growth that could be much uglier, particularly, of course, if you get inflation remaining high and growth slowing or stagflation. That would be the potentially worse outcome. He just says the chances of all of this coming up in terms of the Goldilocks picture, well, that's going to be challenging on the earnings front, Anna.
Yeah, and he thinks that stocks really are going to be challenged in the second half of this year in the way that they weren't, in his view, in the first half. Interesting analysis then in that morning must-read. Let's move on to the tech sector. Venture capital firm Creandum says Europe has the highest density of unicorn tech hubs in the world. Its latest report says Europe has all the ingredients to be the world's dominant continent for tech. Let's get to our conversation then about this. Stefan Helgerson joins us, general partner at Creandum, to talk us through the analysis that they bring us this morning. Very good to speak to you then, Stefan. Why such confidence in Europe's ability to be a home for unicorns?
Well, I think if you look back 20 years, Europe has gone from basically nothing to almost 20% of the early stage tech investing today. And if you look at the seed side, it's even 30%. So I think the trend is very positive.
Okay, and you're focused on seed, you're focused on those early investments. You back companies like Spotify and Klarna. You've got some big names in the portfolio. There is a funding freeze right now, though, in Europe. Some of what you're saying kind of contrasts with what I hear from founders who say, look, I mean, some founders are having to do down rounds, VCs saying those are the well-capitalized, it's a good environment for them because they can put a little bit more pressure, they can get better valuations from these startups. As a startup, as a founder, this is a really challenging time.
It's a tough time, but if you look at this is a cyclical industry. I've been in this industry for 24 years, and you go back to 2000, 2008, etc. I think we've had a great run for 10 years, and the fact that it's now a down period, I think it's normal.
In that time?
I think it's roughly the same.
Roughly the same. Okay.
Roughly the same.
But in terms of this, there's the cyclical story, but then there's the structural story, and you're telling a more positive structural story, and you tell a positive story about the fact that unicorns are spread across a lot of different capitals in Europe. But aren't there still barriers to expanding across Europe that don't exist in the US? I mean, language is just one of the very obvious ones. But does that not weigh on European businesses' ability to expand?
So I think Europe is a complex place, and yes, there are some limitations on expanding to other markets. On the other hand, I think if you're in a small market, a small geography, like most countries in Europe, you actually know from day one that you have to go outside your market, and that's an advantage versus if you start in the US or China.
In which parts of the tech ecosystem do you think Europe can really lead? I was speaking to Joe Lonsdale of 8VC, one of the founders of Palantir, a couple of weeks ago. He says Europe risks, and I'm quoting, regulatory suicide on the question of AI. Can Europe really play a consequential role in AI if officials are building out regulations that are just too restrictive in that space?
Yeah. So I think that's a concern, but I also think if you look at Italy, for example, where they restricted the use of OpenAI and ChatGPT, that was reversed within a week. So I would hope that that's the same that will happen across Europe, that we will not have regulation stifling innovation here.
The regulations you see now, the proposals you see coming out of Brussels, do they concern you?
They do.
Which ones? I mean, but we've got a story today about the Digital Markets Act. So we're covering Threads and the release of Threads by Meta. And this is available in the UK. It's available in the United States, not available in Europe because they want more detail. According to our reporting, they've delayed it in Europe. They want more detail on the Digital Markets Act. I mean, you're not here to speak on behalf of Meta, but from somebody who's focused on startups, does that give you vibes of a positive place to be for tech?
So I think it's one of the concerns, and I think regulation is an area where Europe has to improve. I think over time, innovations such as AI is just hard to stop. Again, look at Italy. They tried for a week, and then they had to reverse the decision.
Do you think? What do you think about the Threads versus Twitter? Do you think Twitter is in peril now?
So I think it's interesting. If you go back 10 years, Google launched something called Google Plus that was supposed to disrupt Facebook. That was pretty hard. My bet is on Twitter rather than Threads. In the cage fight, maybe on Zuckerberg versus Musk, simply because of age. But it's hard to copy. It's hard to copy, even if you have the users.
I love the cage fight. I'd love to explore that in more detail. But why do you think Twitter wins out in this fight?
So I think, it's hard to build a service by itself, but it's also hard to copy it. Twitter has a lot of engaged users. And again, if you go back to Google+, Google thought they had all the users, but they had a lot of Google accounts that weren't really active, right? And I think it's the same here. Just because you're an Instagram user doesn't necessarily mean you have to be a Threads user.
Okay, I mean, Instagram has had success maybe with stories, and people point to that as something that they may be copied from elsewhere, and that it is possible. And thinking about the environment for startups and for unicorns in Europe, though, back to that theme. I mean, what about where they list? Because that's a perennial topic of conversation amongst young businesses. That you get to a certain size, and then what, you have to go to the United States to list. Is that still something that people in your sphere are talking about?
Yeah. So I think it's still an issue, but I think it's improving. So I'm from Stockholm, Sweden, and if you look at Stockholm or Nasdaq Stockholm, I think that market has had more tech IPOs than London itself. So I think it's improving, but it still has a way to go.
Is Klarna, one of the companies you backed is Klarna, very successful in the payment space. Are they ready to list? And if so, where?
Probably need another year or two. Again, this is a company decision. If I were to bet, I think they'd go for Stockholm.
Right. You think that they would make that choice?
That would be a blow to the UK.
Yeah, but they're based in Stockholm. That's where the headquarter is. A lot of pension funds and other institutions are very keen to invest in tech stocks, and I think that's yet to happen across Europe.
Okay, Stefan Helgesson, thank you very much indeed, General Partner at Creandum, on the prospects of a cage fight between Zuck and Musk. His money is on Zuck, but money on Twitter versus Threads, at least for now. And of course, the funding environment and the prospects for unicorns in Europe. Really interesting conversation. Thank you. Coming up, hiring in the US is slowing, but is the pace still too high for the Fed's inflation fight? We're going to preview the all-important jobs data. That is next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome back. This is Markets Today, 52 minutes into your trading session. European markets down almost a full percentage point, and US futures off by 0.4% on the S&P E-minis. The UK now at 7,365 on the 7,600 would be a good picture. 7,365 on the FTSE 100, down a full percentage point, off by 76 points. A line crossing on the terminal. Of course, we reflect, it wasn't that long ago when there was this uprising, of course, in Russia, led by the Wagner Group and Prigozhin. He was expected to have been in Belarus. He had been in Belarus for a period of time, according to reports. Lukashenko now, the leader of Belarus, saying that Prigozhin is not in Belarus now. Again, according to reports. We'll bring you more if we get it on that story. Let's talk about what's happening in the markets then and bring back Noor Al-Ali, or bring in Noor Al-Ali, with a particular focus on the jobs data, Noor, and how that may play into the thinking around the Fed as we weigh up that hawkish FOMC set of minutes.
Absolutely, Tom. And the big theme that we've seen in the jobs data, or in payrolls in particular, is that it's quite robust, right? To the surprise of analysts alike. We had that from Bloomberg Economics earlier as well. And I think that points to the fact that perhaps it can give further ammunition to the Federal Reserve to raise interest rates a bit more. We've seen that division from the minutes that came out yesterday. Now we're pointing or expecting potentially something coming up as soon as July as well in terms of extra rate hikes from the Fed. But also, let's take a step back and see here. There's a moment here where payrolls could be revised lower, and that could play a picture into perhaps the Fed slowing the pace of its rate hikes. But it's all data dependent at this point, isn't it?
Right, supposedly so. And we've got plenty of data to come today, from JOLTS to claims to ADPs. We get all of that in the run-up to non-farm payrolls tomorrow. And thinking about the payrolls data and what we'll get tomorrow, yes, there's the job creation figure, of course, but also the unemployment rate. Actually expecting that to come down from 3.7% to 3.6%. So, I mean, even if we see signs of a cooling jobs market today in some of the data, we might brace ourselves, I suppose, for that level of tightness in the US labor market.
Absolutely, and that's been a big theme this year, Anna, and that's part of the reason why the Fed, potentially a lot of the policymakers there, are a little bit hesitant on whether or not, raising rates further, 25 basis points or less, or holding even more, will point to a policy mistake, particularly with volatile markets as we've seen recently in this year. But I think the overall arching theme remains that we still have a tight labor market. The economy in the U.S. seems to be a lot more robust. Even though productivity has come down, you have seen labor costs come up, and that inflation problem remains front and center for the Fed.
Is this a company hoarding question? That's been some debate over whether companies are just reluctant to let workers go, and whether we're actually getting to a crunch point on that. I mean, we've seen layoffs, of course, in finance. We've seen layoffs in some of the real estate as well. Technology, obviously. Is there a pivot point that comes, or a crunch point that comes to the jobs market?
Absolutely, there is. And this is all about behavioral economics, because at this point, if you're worried about a recession coming, you're going to try and say, well, let me try and hold on to my workers, get that productivity out of the way. Let me give them those raises now, because I know I'm going to be letting people out, letting people off sometime soon. But as well, I'm going to take a step back here and say, well, you know what? The economy has held up better than we'd expected. Inflation is still quite elevated and much higher than the Fed likes to see. We're definitely at a point where we're seeing another interest rate hike from the Fed in July. And the question is, to what extent do we keep those rates higher? And is there more after that?
Right, and that is certainly triggering a lot of thinking about higher rates this morning. Noor, thank you very much. Noor Al-Ali from our Markets Live team. Remember, you can get up-to-date analysis from Noor and the rest of the Markets Live team. MLIVGO is the function to use on your Bloomberg terminal. And Mark Cudmore is not with us, but he is still there, I should point out. He'll be back shortly with us, of course. In terms of the markets then, Tom, we see weakness in equities. We see weakness in bonds, and those bond yields going higher.
Yeah, I draw your attention absolutely to the front end of the curve here in the UK. Gilts now 5.38. That's an 11 basis point move up in yields at the front end here in the UK, as markets price in a terminal rate of 6.5%. Futures in the US down by 0.5%. Stay with us. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Global stocks slide, bond yields climb after hawkish Fed minutes signal more rate hikes. U.S. Treasury Secretary Janet Yellen is due to in Beijing shortly for talks aimed at easing tensions between the world's two biggest economies amid an ongoing trade war. Plus, Meta takes aim at Twitter with the launch of Instagram's Threads. Millions sign up in the first few hours, but it's not yet available in EU countries. Also coming up, we'll take a look at the future of Britain's National Health Service on the 75th anniversary of the founding of the NHS. We'll ask what's in store for the creaking healthcare system over the next 75 years. But first thing is first, so let's check on the markets. A lot of focus is, of course, on the Fed minutes. Let me tell you what that's meaning for example, the U.S. 10-year yield, 3.9594. Now, what we found out with those Fed minutes is that a large majority of participants, some of them actually voted for a hike already last time around, but most participants are expecting interest rates to go higher from now. Now, what that means is, of course, we're seeing repricings across the board for some of these treasuries, and then the UK 2-year yield. Every day I wake up, and thank you to a lot of viewers that actually write in saying this could be the day where the 2-year goes as 5.5. We also have a really interesting note by JP Morgan talking about the fact that given all the composition of the UK economy, they forecast, or it's not a real, or it's at least a real possibility that Bank of England interest rates have to go out to 7%. Have a think about what that means for mortgage rate and also the housing market. The picture across Europe, we also get France, where we have riots that have been erupting over the last 10 days. So we look at some of the underlying causes and what that means next. You can see Europe still in the green, and then we wait to see what happens in the U.S. as we have data. Now, joining us to talk about the markets and to talk about what all of this means for the next couple of months, Yakov Arnopolin. He's Emerging Markets Portfolio Manager at PIMCO. Yakov, so good to have you on The Pulse. This is like a revival. We haven't spoken to you for quite some time, and you choose the most exciting day to come here because it's the day after the Fed minutes, and if you look at emerging markets, they, of course, are so dependent on dollar strength or not. How do you see the global economy developing from here?
Absolutely. Well, once again, thanks for having me. Great to be here. A lot of moving parts, as always, in emerging markets. We're following the Fed very closely, but I think what's been quite interesting is how much EM have performed this year despite ongoing fears about the Fed, despite ongoing fears about the ECB, Bank of England, and so on. And it's been interesting that because EM central banks managed to hike rates so aggressively and so quickly, very much anticipating hikes by the developed economies, Now they're actually at a point where they can start cutting rates, or at least pause, despite the fact that we're probably going to see another Fed hike in July.
But Jakob, do you worry, and there's this funny little thing actually with the Fed, is that they keep on saying and they keep on telling the markets that they're going to hike. The market doesn't quite believe it because maybe they look at credit crunch, they look at some of the lending data. Are you expecting the Fed to be more aggressive than it's priced in, and what does that mean for emerging markets?
Yeah, of course. Look, it is plausible that we see more than one hike this year. I think having said that, when you compare the U.S. to Brazil, where rates are at 13.75%, where real rates are positive, and we see positive real rates across emerging markets, whether you look at South Africa, you look at the Czech Republic, that protects these EM central banks and, again, allows them to actually go in the opposite direction of the Fed, even if we see further tightening out of developed markets. And it's interesting because if you look at how well EM currencies have done year to date, that kind of reinforces the case for potential easing by EM central banks, because the inflationary pass-through goes the other way, right? So stronger currencies, less inflation, so consequently potentially room for these EM central banks to, I wouldn't say ignore the Fed, never ignore the Fed, never ignore the ECB.
Never ignore the Fed.
Never ignore, but nonetheless, because they've been so aggressive, actually go in the opposite direction.
Right, but what the Fed is doing is repricing dollar, right, at the margin, and certainly changing treasuries. So that change the composition of what we're seeing in certain emerging markets, in investor appetite.
Yeah, it's interesting because EM has faced every possible shock one can imagine over the past 18 months. We've had Fed tightening, we've had geopolitics, we've had politics, peak outflows, peak defaults. So now, after having gotten bloody, so to speak, EM looks pretty compelling, both on the currency side, on the bond side, and again, not to ignore the Fed, but nonetheless, it can actually, let's say, have a pretty decent runway over the next few months. One thing we're just mindful of is, again, in the face of potential further Fed tightening, or at least the Fed then staying on hold for a while, when we think about EM central banks, they tend to, we say that they go up in an elevator, in a lift, as we're in the UK. Yeah. They go up in a lift in terms of their rate hike, so they hike very aggressively, and then they go down the stairs. So the cuts may be gradual, so it may take time, which again actually supports currencies more carry.
Yeah. Jakob, I also want to talk about China, but Treasury Secretary Janet Yellen is actually expected to land in China later this hour. Now, she's aiming to find areas of common economic ground. She wants to open communication channels amid an increasingly turbulent relationship between the world's two biggest economies. And of course, her visit comes days after China imposed restrictions on exporting two metals crucial to keep technology industries, the latest escalation in this ongoing trade war. And so, Jakob, this is something that Janet Yellen said in April, that she wants to look after American interests while at the same time not hurt China economically. What does that look like, and how do investors take advantage of this if they can?
Of course. Well, anecdotally, I feel like I got a degree in geology over the past 24 hours, following all the precious metals.
The little components, right?
Gallium, germanium, it's been fascinating. Look, I would say on the China front, there are probably two tracks. The geopolitical track, the commercial track. To us, frictions will continue. If we don't see a détente near term, obviously they may be dialed up, dialed down, but ultimately, when we speak to our colleagues that follow Washington, D.C., it seems that the one area where there's common ground, where there's bipartisan support, is being hawkish towards China. With that in mind, certainly we hope that this trip kind of maybe reduces tension somewhat, but going forward, we would still see ongoing tensions. Yeah. And I think with regards to how to take advantage of it and what we're seeing our clients do, there is actually, I think people are waking up to the fact that as we expect further noise, let's say, between China and the US, maybe China and Taiwan, people are looking at where they're invested. Yeah. And those invested in EM equities, MSCI EM, a benchmark that has 30% in China, 15% in Taiwan, basically half the benchmark is China and Taiwan, are looking at that and saying, well, maybe I should shift from EM equities into EM debt, which has far less exposure to those two. So it's almost like they're trying to shift exposure elsewhere and diversify.
Yeah, and that could be also decoupling or supply chains. Jakob, thank you so much for now. Jakob Arnopolen from PIMCO stays with us, and we'll talk a little bit about Eastern Europe as well. Coming up, Europe's energy flows. We'll discuss that in our exclusive interview with Maros Sefcovic from the European Commission. Our Maria Tadeo conducts that interview shortly. This is Bloomberg.
York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to the Pulse, everyone. So we're nearly a year on from the peak in European energy prices, a crisis, of course, that bruised governments, consumers, and business. It led to a range of responses from the EU, including joint gas purchases, and most recently, a gas trading platform. Now, our Europe correspondent, Maria Tadeo, is in Brussels with a special and exclusive interview for us. Maria, over to you.
Yes, good morning, Francine. And what a year it was for the energy markets. And we're joined, obviously, by Maroš Šefčovič, who is Vice President of the European Commission. Now, you put together what you said to me, this is going to be like a relationship matchmaking, but we're not going to find love. We're going to find buyers of gas. I know that you got to 10 billion cubic meters. That was the amount that you were able to match. What's inside the number? Tell me, who's buying, what kind of contracts, what came out of the total number?
I think we've been pretty impressed, first and foremost, by the demand aggregation, because it was much more than we expected, especially for the first call, but also the fact that that we've been oversupplied by the bids, because we got the offers for almost 17 billion cubic meters, and as you said, we matched over 10 BCM, and I'm glad to say that we managed to cover most of the European territory, including, I would say, the territories which are not easy to supply, like Moldova, like Ukraine, and they got they demand completely matched. And what I heard from Moldova was that also price-wise, it was much better than what they get from traditional suppliers. So the second round, which we are starting right now, again, we've been quite impressed by the demand. So it's already around 16 billion cubic meters. And of course, we start with international tender tomorrow. So by Monday evening, we'll have also the results, what been the bids and how the matchmaking will proceed.
So you will reach out to the sellers. And what is the next goal? Because winter, I mean, it sounds a little bit funny to say it's around the corner, but when it comes to the preparations, you know it already is.
It is.
So how much can you get?
I think that we are permanently communicating with our member states, with all the energy players. Let's not be complacent. I mean, we managed last winter. We've been also a little bit lucky, but at the same time, everything had to fit in just to make it through the next winter as we did the last time. And therefore, we hope that by the end of the summer, we will have fully filled all the gas storage across Europe. And then, of course, we want to work with certain reserve, because you never know what might happen in our volatile worlds, and therefore we want to be fully covered for the next winter.
Exactly. You say we want to be on storage looking good in September, like we did last year. But on a scale from 1 to 10, how much do you worry about this winter? Because the European industry, they still say, yes, prices went down, but the damage, the repercussions, we still feel it. It's painful still.
It is. I mean, when you talk to our industry, they told you that the last year was indeed a year of survival. This is how they describe it. And this year they're telling us that still manufacturing and producing well below the potential, and we need to get them back to the market to fight for our industry, to make sure that they would prosper. And of course, they need not only enough of energy, but better prices. And therefore, we are trying also to increase the transparency, competition on on the market. And of course, I would be definitely worried until the next spring. I think we are in much better position than we've been the last year, but definitely not be complacent because it would be a big challenge.
Yeah, and of course, there's a lot of this talk still about this recession in Europe. But I wonder if your platform, if it becomes successful and it becomes a role model for the way that you can connect both buyers and sellers, do you see this being extended to critical raw materials? Just as one idea, the Commission wants strategic autonomy. Is that doable?
I think there are definitely, I would say, two new directions we should take. The first one is to use the platform for the common purchase of hydrogen, because that's the next big thing. But also, I think it could really serve as an excellent blueprint for the common purchase of critical raw materials. I mean, we see, you know, how this new rough geopolitical world is also impacting the global supply chains and supply of critical raw materials. And I think we as a Europeans should pull our political weight and economic size a little bit better than we did until now.
And you say the European Union should pull that weight. And we've seen now the Council says, yes, no to decouple from China, but yes to de-risking the economy. The Chinese responded this week with some exports controls. Is that a warning that they say you want to de-risk? Go ahead, but it's going to cost you and expensive?
You know, I think that we've been kind of expecting that sooner or later this might come, and therefore, I mean, I was pushing for already quite some time that we need to have this open strategic autonomy. We need to be able to diversify our suppliers, because we are paying a lot for dependencies. Look, you know, how much the dependency on Russia's supply of gas and oil costed us until now. And therefore, we started with our Critical Raw Material Act. We want to proceed with strategic stockpiling of critical raw materials and use the platform, as we did for the gas, as a blueprint for doing something similar for the critical raw materials. So we definitely have to invest much more in critical raw materials to have the strategic supplies we need.
But you don't worry about potential retaliation, or you do, from the Chinese, who say, okay, sure, you want to do that, fine, but we provide a lot of them.
Of course,
we pull the strings.
Yes, of course, we analyzing the current situation and discussing it now among our member states. But I would say the conclusion is very clear. We need to diversify the suppliers. We have to prospect what we have in Europe, what we have in our neighborhood, and bring enough investment to develop the possibility of diversification of supply chains of critical raw materials for our key industries.
And of course, speaking of the Green Deal, which is still the cornerstone of European policy for the future, there was a story today we had on Bloomberg which suggested the cost of this could now go incrementally to 700 billion euros a year in investment. To make it clear, this is from the private sector, not taxpayers. But I do wonder, that bill goes in crescendo pretty much every 3 months. What is going on with that? Why is there this big gap between how you started, where you budgeted, and where we are now?
I think a lot it has to do with, I would say, overall price developments, I mean, on the global markets. But at the same time, it's also the fact that we want to accelerate this process, because we have seen that we cannot be dependent on the fossil fuels.
Even if it costs more.
Even if it costs more. It's a matter of economic security. It's a matter of using our indigenous sources of energy, like solar, wind, hydro, nuclear, and to make sure that we will be much more, let's say, independent from the perspective of how we generate
and on this
the energy.
Do you think the European taxpayer is going to stay with you on the Green Deal? There's a lot of pushback at times. It's too expensive. I don't see what it does in real life.
I think we, of course, have to be very conscious about the fact that we shouldn't talk only about the importance of the green transition, but also how we are going to protect the most vulnerable parts of our society who are impacted by this change. I think that green and social have to go together, because otherwise, I mean, it's very difficult to make these transformative changes if you do not have enough of the public support. So I'm one of those who say green is great, it's important, and we have to do it, but it has to come together with the social policies to match it.
And you also have the European elections next year, where that will be at play. And then a final question, I have to bring it back to the UK, because I know you've left that chapter of your life, but you can't fully escape it. So here's my question to you, but it is connected to Europe. However, you do know that there has been reports about this EV possible tariff that could be implemented to both cars that are made in the UK and the European Union, unless there's a number of components that are made in both markets. The UK government says this could kill, made in Europe EVs, but also in the UK. The European auto industry says this is dangerous too. Do you see potential to have some leeway there so that this does not get implemented?
Our approach to this is quite clear. We are pretty sure that if we will not give our battery sector the chance to grow right now, we might never have it. Because, I mean, we know that there is a hockey curve in the acceptability and sales of electric vehicles, which will be here between now and 2026, 2027. And if our battery sector will not be part of it, so there will be take-off agreement signed with, let's say, Chinese suppliers, and for them it will be very difficult to recover. So this is very important for us, because batteries would represent 50% of the value of the car. So therefore, we want to give every chance to battery sectors to prosper.
Well, would you reconsider this tariff? If the industry in Europe says this is going to cost a lot, and the UK government also says this is going to hurt us both, is the Commission potentially open? Maybe not today, but consider reopening that?
You know, we are afraid that if we kind of get soft on this issue, that in 3 years we would have the same discussion as we have right now. So therefore, I think that we have to put everything on the table, and as it stands right now, we want to make sure that our battery sector is prosperous enough, and it's delivering, and it's becoming the part of the value chain we have to build across Europe.
Well, Mr. Šefčovič, thank you so much. Always good to see you on Bloomberg TV. Good luck with your new round of tender offers for your platform. We'll see how it goes. Thanks so much.
Thank you.
Francine?
Yeah, Maria, thank you so much. Maria Tadeo and the EU Commission VP there. We're back with Jakov Arnopol. And Jakov, this was a great conversation, really trying to push, the Commissioner on the plans, first of all, for some of these raw materials. As you say, we're all experts in what China's trying to do and how we could try and counter that. But also energy. So if you look at emerging markets, and this is not only Eastern Europe, how much is the potential high energy price a real downer for the next couple of years?
Yeah, it's curious because I would say, focusing, let's say, on Eastern Europe, we have more exposure to the region than in living memory. And a lot of that has to do with the fact that energy prices are well off the highs.
Yeah.
And on the back of that, we're seeing really a smattering of downside inflation surprises, obviously, versus expectations. So that's actually quite encouraging. So with that in mind, we have quite a lot of exposure in Czechia, in the local bond market. We're looking at the Hungarian forint. And on the credit side as well, between lower inflation, but also, hopefully less geopolitical friction and political friction, a lot of the Eastern European countries, their credit, so dollar bonds, euro bonds, places like Serbia, places like North Macedonia, Romania, are quite interesting at the moment.
Jakov, as always, thank you so much for joining us. Jakov Arnopol, their emerging markets portfolio manager at PIMCO. Don't be a stranger. It's been way too long since we had you on last time. Coming up, Meta's newly launched app is taking aim at the Bluebird this morning. Elon Musk has fired back. We'll discuss the new risks for Twitter next. And this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap.
as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The Meta founder, Mark Zuckerberg, says its newly unveiled social media app, Threads, has reached 10 million signups so far this morning. Now, the app is taking direct aim at Elon Musk's Twitter. However, it's not launching in the European Union so far due to regulatory issues. Well, joining us now is Bloomberg's Alex Webb. Alex, we've all been playing around with Threads. I have to say, it's fantastic. How does the functionality compare to Twitter?
There are two pieces to this. There's whether the social graph that it's built up through Instagram is able to build the connections pretty quickly that you would want in a social network. And so far, it kind of looks like it has, because it's able to port users over from Instagram itself. That's something that these other would-be Twitter competitors have struggled to do because they just don't have that existing social network. On the functionality of the app itself, there are a few things that aren't quite there yet and which presumably could be quite important. Not least, there isn't a desktop version, which for a lot of power users, and by that I kind of mean the media, they use it on their desktops, not just TweetDeck, but in browsers. That could be a bit of a hurdle when you look to trying to get people engaged with it throughout the day, that people constantly have Twitter open. It's going to be a bit harder with Threads with no desktop. There's no live stream. There's no sort of Twitter Spaces equivalent. Those sort of things presumably will come, but they're not here yet.
Thank you so much, Alex Webb.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, this week, we're taking an in-depth look at Britain's struggling health service. The NHS has turned 75, but what will it take to survive to 100 and beyond? The UK government calls the health service Britain's most treasured national institution, but a recent report has found that it lags behind many other countries on spending, investment, and health outcomes. At the end of April, almost 7.5 million patients were waiting to start treatment in England alone. That's a new record. Of those, 370,000 were waiting more than a year. The UK is well behind other major European economies on hospital beds, averaging just 2.5 per 1,000 people. Now, avoidable mortality rates in the UK are also higher than European peers. It all begs the question, can the NHS be saved? And what will it take to fix it? So let's bring in our panel of experts. Susie Ring, our healthcare reporter, and Olivia Kunati-Ahulu, our equality reporter. So congratulations, first of all, on this important piece of data. You have this amazing expose looking at what the NHS promised. You look at data, you crunch the data, and you basically put it together to say, how can you also fix it? Susie, whilst you were putting this together with the team, what was the most surprising? That out of the 8 metrics, the NHS is probably doing badly on all of them.
I think that's it. You know, the rhetoric that the NHS is doing badly is well known. There's been lots of problems for decades and a lot of underinvestment that's needed to be rectified. But with this analysis, you really got a sense of the extent to which things are going badly. So the fact that 1/5 of the constituencies are meeting none of the 8 indicators that we looked at, so these are the metrics that they should be meeting for things like wait times for A&E, ambulance handover delays, it was really the extent to which those targets aren't being met that was so surprising.
Yeah, and Olivia, I have to say that, you know, one of the most shocking things is you realize that location really matters. So depending on your postcode, you either live or die if you have to use the NHS. Has it gotten worse in years? Like, what have you found out through your reporting?
Well, I think that was one of the other surprising things we found was the extent of the geographical changes. So as you were saying, in the southwest, for example, we were really finding that region, when you look at those specific indicators, was really, really struggling. And, you know, there are some quite visceral feelings you find when you think that if I called an ambulance, would it get there in an amount of time for me to be okay if something really serious was wrong? And there is the sense that COVID, of course, created this backlog that is now very, very hard to come back from. And with staff pressures as well and the cost of living crisis, there is a sense that things have worsened to this kind of crisis point.
Yeah, if we take, you know, some of the indicators, so ambulance waiting times, it's handover delays in ambulances, waiting times in A&E, hospital bed occupancy, well, same day or next day GP appointments, diagnostic tests, referred treatments, and then cancer treatment, waiting times. What's gotten worse out of those 8 categories?
I think the actual issue is that they're all really interconnected. Yeah. So one of the reasons we looked at these metrics is because they all had a kind of wait time element, so they were kind of comparable from that sense. And one of the paramedics I spoke to in Bristol made the really good point that, you know, she's there outside waiting to transfer people into hospital, which is the handover delay point that you mentioned, and that no constituency is meeting the target on. But the reason she's waiting outside is because there's no beds in A&E. Well, there's no beds in A&E because there's no beds anywhere else in the hospital, so those people have been taken to A&E, and there's no beds anywhere somewhere else in the hospital because there's not the social care to discharge people to. So it's this kind of interconnectedness that's really at the heart of the issue, and everything has a knock-on effect on everything else.
Yeah, and so if you look at the causes, it's very difficult to pinpoint. It's not only underfunding, it's the lack of staff, and Brexit probably exacerbated some of the concerns we have.
Yeah, exactly. It feels like there's this twofold issue. One is just the weight of demands. What everyone says is that people are getting older and people are getting sicker, very basically. So when people are turning up to hospital, they're coming with 2 or 3 very complex issues, when in the past it might have been 1, because people are living longer, and that's only set to get worse. And then you have the NHS itself in terms of being what we all know, understaffed, underfunded, very low staff morale. So there's this sense of these 2 competing pressures, and it's not clear how that's going to resolve itself.
So there's not an easy fix, and as you say, it's all interconnected. So if you have a pressure point at one, there's a backlog on other parts. Is there anything that they can do more quickly to try and alleviate some of the pressure?
Well, we had the government publish its 15-year workforce plan last week, which is definitely welcomed, and everything in there, is very much what the NHS has been saying for a while in terms of we need more doctors, we need more nurses, we need more incentives for those people to train and stay in the UK. One of the issues we have is a lot of people train in the UK but don't stay in the UK because pay isn't as good, lifestyle isn't as good. So we had a lot of good narrative coming out from that in terms of more medical school places, making sure that those places are also particularly increased in those areas with shortages, because of course one of the dynamics is you will always have people in London, for example, who are, top medical school students, people that want to come and live here because of the lifestyle, but you won't necessarily have that capacity in more rural areas. So definitely workforce is a key part of this, and that has come out in the plan. But there are also other issues around technology reform, investment in old buildings and old hospitals. Again, this interconnectedness of you can't just fix one thing, you have to try and fix a number of things to make the whole system work.
How much can you actually fix with extra money and funding?
I think money is always going to help. If there's more funding, then you can pay people better, you can reform technology, you can invest in buildings. But money isn't the only thing. There is definitely just a sense that I think morale has ebbed so far over time that is going to have to take time to come back again. Also, it's not a quick fix. The government workforce plan is really talking about places coming in from September 2025. Well, we're in 2023 now, so we're not going to see the fruits of that for a good number of years yet. So it's sort of what's going to happen in that time, what are the sort of short-term interim measures that can be used to try and boost morale. I mean, obviously, we're still having strikes over pay with junior doctors and ambulance workers and nurses. A lot of that really needs to get resolved for us to be able to step forwards.
And Olivia, the other trend is that, of course, a lot more people have been paying for private insurance, which just, increases the gap between the haves and the have-nots.
Yeah, exactly. And I think one point that we found is that just because people are paying for private care, that potentially takes kind of staff out of the pool of the NHS. So it just kind of accentuates those pressures. And I was speaking to someone who didn't necessarily want to go private, but it was just kind of the small things where after she had a stroke, in order to really fully regain her mobility back and get back as well as possible, she just felt that those resources would not be available to her in the NHS. So she kind of said, if it wasn't for my savings, I just don't think I would be able to have the independence that I have now.
Yeah, when you look at some of the inequality to do with health services, do people, pay a lot of attention on the parties that offer what to decide who they vote, or is it almost a second thought?
Well, I guess Rishi Sunak has identified, the NHS is one of the key things he wants to focus on, and waiting times is one of his priorities to cut this year. So I think it's definitely on the minds of political parties, and the Labour Party have put forward their own agenda. So yeah, I think the NHS is this, it's obviously a life and death issue, but it's also a very emotional one about how we identify to be British. So I would say it's high on the agenda.
All right, thank you both for joining us. Our equality reporter, Olivia Konoti-Ahulu, joining us, of course, on this wonderful story. Susie Ring stays with us. Coming up, more on the pressures facing the NHS next with Ben Zaranko from the Institute for Fiscal Studies. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policies.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, as the NHS struggles with long waiting lists, budget constraints, staff shortages, and mass strikes, it's no surprise that more patients are turning to private healthcare. Research from the Private Healthcare Information Network shows that admissions to independent facilities hit a record high last year. There were 820,000 private inpatients admissions in 2022, with hip and knee replacements the fastest growing procedures to be done privately. Well, we're now joined by Ben Zaranko, Senior Research Economist at the Institute for Fiscal Studies. Also joining us here in the studio with me, Adrian Woolridge from Bloomberg Opinion, and our healthcare reporter, Susie Ring, is still with us. Ben, thank you for joining us. Also, Adrian, thank you for joining us. Ben, when you look at the funding and actually what would make a meaningful difference to the NHS, how much pot can the government spend on the NHS, which is meant to be the pride of the UK?
Well, that's really a political judgment. And what we've seen in recent years, and since 2010, since the coalition government came to power, is the NHS be prioritised relative to other public services. Other public services were cut back really quite sharply during the 2010s, things like prisons, your local governments, the court system. Those services faced large cuts. The NHS saw its budget rise. Now, it rose more slowly than it had done historically, but it was still increasing. And that's been a decision that repeated governments have made. So you've seen the NHS take up a bigger and bigger share of the overall pot. But in terms of how far that can go, that's really a political judgment. I think the challenge facing whoever wins the next election is that some of these pressures from an aging population are really starting to bite. The number of people aged 85 and above is projected to increase by 40% over the next decade. Those people use a lot of healthcare. It's almost certain we're going to have to increase the health budget if we want to meet those pressures. And the question then becomes, where does that funding come from? So these pressures they've been known about for a long time, these pressures from an aging population, but they're really starting to bite, and it's going to force some very difficult decisions.
But Ben, and this is crucial, right? Without, I mean, I guess hindsight is a wonderful thing, but if you look at the underspending that successive governments have done in the UK, is it because they didn't model an aging population that needs more care, or did the pandemic really put them off track?
Well, I guess underspending is in the eye of the beholder. We're spending more in the UK than we ever have done in the past. It's true that we spend less than some of the Western and Northern European countries to which the UK is fond of comparing itself. But it's also true that the UK spends more than lots of countries in Southern Europe, for example. So the UK is sort of in the middle of the pack amongst the EU. Given the UK is sort of in the middle of the pack in terms of its GDP per capita, that's perhaps not to be, not too shocking. And I think that really, since 2010, the decision has been to protect the NHS while cutting everything else, and the bigger increases for the NHS budget have been precluded by concerns about the public finances and perhaps a reluctance to raise taxes towards those Western and Northern European levels that other countries have in order to fund their health systems. So there's choices along the way that have led us to where we are.
Okay, so let's not call it underspending, Adrian. Let's call it broken NHS. Is there anything that works, from the NHS right now?
Well, I think the problem with the NHS is that we have this rigid distinction in our minds between public and private. That private has to go in this completely separate sector. And I think one of the ways forward would be to introduce insurance to top up public spending, so people could actually go into NHS hospitals but use health insurance to top up, either to get faster service or to get better food or to get separate, better rooms or something like that. So keeping these things completely separately, religiously separately, I think is a very questionable thing. And the other question, of course, is whether you could have top-up fees to go into. But as long as we have this rigid notion that you can't pay any extra within the context of the NHS, people are forced to go private.
Yeah, which 10 years ago, certainly if you're a foreigner in this country, you think it's amazing because you have everything for free. And if you look at the other European models, it's just not the case. Usually you pay something and you get it reimbursed. Susie, does the NHS survive in its current form?
I think we have this tension where this idea of having healthcare free at the point of need is incredible. That is such a privilege in a country to not have to worry about financial burden, not have to rack up debt like we see in the US. People have kind of medical bills that, bankrupt them. And that is that's a real privilege. However, when it gets to the point where actually, yes, finance isn't prohibiting you from going to A&E or the doctor, but the fact that you'll be there for 12 hours is prohibiting you from going, or you can't get a GP appointment for a week or two, even though you really need to see someone, that's a different kind of prohibition. So I think something's got to give is the answer. And one of the things I thought was quite interesting that came out of the King's Fund report they did a few weeks ago was that it's actually quite hard to totally change your healthcare system. So countries' healthcare systems are quite tied culturally to who they are as a nation and have been born out of, ours has been born out of the Second World War, and there have been sort of foundations that underpin them that you can't really just transfer and think, oh, Germany's got a better model, let's take that. But there are tweaks and things we can definitely learn from other models that would help reform it for the next generation.
So, Ben, how do you look at staffing? If you increased staffing, so either because people thought it was a great job or you paid more, some of the nurses and great doctors that we have at the NHS, would it make a meaningful difference?
I think one of the puzzles at the moment is that the NHS has quite a lot more frontline clinical staff now than it did just before the pandemic, and yet the NHS is managing to treat fewer people every month than it was prior to COVID, which suggests that staffing isn't the only thing that matters. It seems clear and obvious that with a growing population, an aging population, we're going to need more healthcare staff at some point, and that was a very clear lesson coming from the government's workforce plan. But I think it also seems clear that if you just keep chucking more and more staff, frontline staff, into a system that isn't working very well, then it's not obvious that you'll get better outcomes. And so I think the focus on staffing, where there are undoubtedly legitimate concerns about morale and retention and so on, has to be coupled with a focus on the other things that might determine productivity, whether that's the management system or the role of data analysts or the capital equipment available to staff or the number of beds available or the IT systems, and all these things that clearly are going to matter as well, and thinking about how we can use the resources we've got more efficiently and more productively, rather than just the answer immediately always being, oh, we need more staff, we need more staff. So I think there has to be a broader conversation going on.
But Ben, as the Bloomberg article writes beautifully, right, the emergency care is the most visible, but a harder problem is all of the backlog of these non-urgent procedures. So is there a backlog that requires a different system, or is it fixing it through just having more nurses? I mean, I don't know the last time you tried to get an appointment for, through a GP and NHS, but Central London, it's almost impossible for at least a couple of weeks.
Absolutely, there's very clearly pressures on getting access to a GP in the first place, which might be preventing some people from joining the waiting list. The irony is that the backlog might be even greater if people were able to actually join it. I think that the NHS is clearly trying out new models of care. So to give one concrete example, they've been doing more what they call hot and cold sites. So having hot sites where there's an A&E department, for example, and things can get disrupted if there's a big influx of patients, but having cold sites where they don't have to worry so much, the patient flow is much more predictable, and so you can just churn through more of your routine operations and avoid them getting disrupted by COVID or other things. So I think there's new models of care there, which I think are working quite well, but there's clearly, if you look nationally, a big issue here about the struggle to treat enough people to get the waiting list falling. Now, I don't think we have a solid evidence base on this yet, but there might be reasons to think that longer waiting lists are perhaps partly responsible for some of the worsening in population health we're seeing, more people inactive due to poor health, more people claiming disability benefits. It's at least plausible that the NHS is playing a role in that. So there could be economic benefits from sorting this out as well.
All right, and Adrian, quickly, you know, when you look at private healthcare, is that a good or bad? It takes pressure off, but I wonder whether it also takes doctors with it.
To some extent, but what I would argue for is private healthcare as a supplement to the NHS. So you actually had private wards in NHS hospitals until the late 1970s, when the Labour government got rid of it. It's this notion that you can't mix the two systems that is so derogatory in Britain. If you look at other countries, if you look at France, Germany, Switzerland, there are all ways in which you can use a tax system to support, or a compulsory insurance system to make sure that everybody gets access to free healthcare, but then you can top it up with different levels of personal payment. The problem with Britain is we're obsessed with the American example. We think we either have this wonderful quasi-religious thing called the NHS, or we have America, and you have people dying in the streets. There are many, many alternatives, and all of those alternatives, I think, make some use of a mixture of public provision or compulsory public subsidized insurance with an ability to top up the system, because you can get more money in that way.
Okay, and we'll talk a little bit more about that. Thank you all for joining us. Ben Zaranko, Senior Research Economist at the Institute for Fiscal Studies, Susie Ring and Adrian Woolridge. Stay with us for more on this important topic. This is Bloomberg.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup.
This is a 3.
As the economic picture does.
The OK is getting ready to make
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Back now to our deep dive into Britain's struggling National Health Service. With me, Susie Ring, our healthcare reporter, and Adrian Woolridge, our global business columnist for Bloomberg Opinion. Now, Adrian, you said something that really struck with me is, the problem with actually reforming the NHS is that a lot of politicians say, well, we don't want to be America because there's no free system.
Yeah.
But is there, if not an easy fix, something that we need to strive to get to? Because it can't survive in this current state.
Well, the most important thing is that we have to stop treating it as a religion. I think the extraordinary thing that happened yesterday was having this church service in Westminster Abbey, celebrating the NHS. We should be thinking about different examples from around the world, and those different examples have certain things in common, that they have a basic system which provides basic care for everybody, but they allow other sorts of money or other sorts of top-ups to come into the system. And in Britain, that's verboten. The idea that everybody gets exactly the same service, that they can't top things up, is essential to our sense of national identity. But it's a sense of our national identity which is in danger of destroying the very thing that it celebrates.
You also have a new opinion piece out today, which is a really great read, talking about conservatism and the difference between the U.S. and, of course, here in the UK. I mean, are the NHS fault lines, to blame because of the Conservatives and also the austerity years?
Well, one of the many problems with the NHS at the moment is that we had a long period of austerity introduced from 2010 onwards by David Cameron and George Osborne, and we're feeling the effects of that now. They did two things that were bad, I think. One was that they cut back very, very significantly on long-term investment in the NHS, and the second is that they didn't tackle the community care problem. In fact, they were cutting back on local government expenditure all the time. So we did have a golden opportunity then, because borrowing was virtually free, to do something about these long-term problems. We can't now because it's expensive to borrow, and we are suffering from the consequences of that. No proper community care system and an NHS that has been squeezed for a long time.
All right, thank you both for joining us. And again, congratulations on this important, if sad reading, looking at the data and seeing what the NHS will do in the next 5 to 10 years and beyond. Susie Ring, our healthcare reporter, Adrian Woolridge, Bloomberg opinion columnist. Now, Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta in New York, our Guy Johnson here in London, and this is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
10 a.m. in London, 5 a.m. in New York. That means it's 5 p.m. in Hong Kong. Our top stories today: hawkish signals from the latest Fed minutes, firmer bets on a July hike. Global stocks suffer losses as bond yields continue to climb. Common ground. U.S. Treasury Secretary Janet Yellen arrives in Beijing for talks aimed at easing tensions and opening communication channels between the world's two biggest economies. And Meta's Instagram officially unveils its Threads app, taking direct aim at Musk's Twitter. Millions sign up within hours. It is not yet available within the EU. Good morning, welcome. This is Bloomberg Surveillance. This is the early edition. I'm Guy Johnson in London. Of course, I'm stepping in for Danny Berger, Kriti Gupta in New York. Kriti, I think this is shaping up to be quite the session. This week has been a complete dud so far. I think we're now going to get some action.
Oh, I completely disagree. I feel like Monday, even though it was kind of the day between a holiday here, had a lot of news flow that is now having ripple effects. We're talking about the Federal Reserve now. We're talking about China. We're talking about the EV space, all of which kind of started seeping into the conversation on Monday, Guy. But I think what's interesting, to your point, is just the way the markets are shaping up here. Because take a look at what futures are doing. Already a sell-off on our hands, down about 0.5% when you look at those contracts. 44.63 for our radio audience when you're looking at S&P futures. But the bond market gets interesting. Guy, I think you're right here in that today might be the day where you start to see those round numbers forming. In the 2-year yield on the front end of the curve, potentially hitting 5% on that note. We're looking at 4.97 right now, higher by about 3 basis points. Go out further out on the curve on the 10-year, you're looking at 3.97, only 3 basis points away from that round number of 4%. So again, a move of 4 basis points higher already baked in. What's interesting here is that, remember, we do have some JOLTS data, we have initial jobless claims, we do have economic data that could push those yields higher and get us to those round numbers. The question is, when do the technicals kick in and when do you start to see some sort of pullback from those round numbers? Again, I want to bring to your attention, though, very quickly before we go to the Asia session, because there is a lot going on overnight, is what Bitcoin is doing. Because as we see those yield moves, you really want to keep an eye on what those ripple effects are, including in gold, in commodities, and also Bitcoin. 31,000 handle here, higher by 3% already. It's unclear what the narrative is, what's driving this, but certainly a commodity to keep an eye on. I promised you a check on the Asian markets. That is important because we have a major sell-off in China on our hands, perhaps influencing the sell-off you're already seeing in futures. The Hang Seng down by 3% overnight. Also seeing a very, very strong fixing by the PBOC. So seeing dollar yuan at about 7.25. You are seeing a little bit of easing since that happened, but still, nevertheless, the Chinese government again and again making it clear that a weaker yuan is not acceptable. On the heels of that news, you are seeing copper take a little bit of a hit as well, down about 1% as our proxy for that, well, global growth story, but specifically that China growth story. The one outperformer guide, the one piece of green on the screen in the Asia session came from India, where you did actually see the Nifty 50 higher by about 0.4%.
Keep an eye on dollar yen for what is happening in that CNY trade, that Chinese currency story. It's going to be interesting. Eurozone retail sales data just dropping onto the screen right now, down 2.9 year on year, the estimate down 2.7. They're certainly selling in Europe today. That fits the narrative. You can see it on the screen in front of you. It's going to be interesting to see whether the story out of Asia that Critty just brought to us translates into Europe, then translates into the United States. As Critty says, are we going to go through 5% on the US 2-year today? Alex and I will be breaking the JOLTS data, the services ISM data at 10 a.m. Eastern. Look forward to that. That could be one of those critical moments. But I think the Fed misled us. The Fed told us it was unanimous, and it wasn't. It clearly wasn't. And as a result of which, this hawkish tone is now percolating through the market. We've seen a huge move this morning on UK 2-years. We're up by 8%. We faded a little bit, but we're seeing a really big move. There is now a fully priced 6.5% rate by next March for the Bank of England. Is the Bank of England going to 7? Is the Fed going to 6? I think that's a critical question we now need to ask. Euro dollar barely budging today. Euro stocks 50. Here is a fascinating story as well. Critty was talking about round numbers. 42.90 is where we're trading. We keep failing at 44. Ding, 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 ding along the top. We can't break through that number, and we backed off it now, 42.90. So European stocks are getting hit, and hit pretty hard today, Critty.
Certainly a lot to keep an eye on, but it really comes back all to that central banking story. You mentioned the economic data. Let's go and play a little bit of rewind here. The latest Fed minutes showed some division among officials, as you pointed out, Guy, in the central bank's decision to hold rates in June. New York Fed President John Williams believes there's still more work needed to get that inflation number down to 2%.
We can take some time and assess and collect more information, and then be able to act, knowing that we also have communicated through our projections that we don't think we're done based on what we know.
Joining us now for a little bit more analysis, Bloomberg MLive editor Noor Al-Ali. So, Noor, we on the surface see this as a unanimous decision, but begrudgingly, when you look at the minutes, explain to us why perhaps the Federal Reserve, in Guy's own words, perhaps sold us a puppy. It's a phrase I just learned this morning. Talk to us about what is going on, perhaps in the market's minds as they get those minutes.
I mean, I don't know about you, Critty, but I like puppies. I've got 2 at home. But, to be honest, if you're looking at what the Fed's trying to say, they've got a dual mandate, and it's really important for them to maintain financial stability. We've seen what's happened with SVB earlier this year. We've seen what happens when you talk about, back in 2013, tapering, those kind of fears in the markets, really outsized when you hear the Fed, veer off the path. And we were expecting at a time when the Fed paused, for it to pause. The data was calling for it, the market consensus was calling for it, and for them to have raised rates, particularly in that juncture, would have been quite difficult, I think, for markets to digest. So fine, we had a pause, and I was in the camp that never believed that the Fed was going to stop raising rates. If you look at the ECB, if you look at the BOE, they're continuing to raise rates. I know they're in a completely different ballgame here, but the Fed is still head set on raising rates. You've got PCE, core inflation data, all that stuff still much higher than the Fed likes. And the jobs market, yes, it's cooling, but it's still quite tight.
Apparently, the phrase comes from you'd buy a bag which you thought had a piglet in it, and it actually had a puppy in it. That's where it came from. I like puppies too. I'm just going to point that out. Does the Fed get to 6? Does the Bank of England get to 7?
That's really tough, right? Because you had earlier data out of the UK today showing that the housing data came in at, 38 something, which is quite shocking. Housing activity in particular, that's the PMIs in the final print. That's quite important. You've got the housing market really feeling that heat of those interest rates, mortgage rates really soaring, people renegotiating now from those near zero terms. And look, I'm gonna do a mea culpa here. It's definitely central bank's fault. We've maintained, very accommodative monetary monetary policy from the financial crisis onwards. And right now we're raising rates aggressively, massively, quite at a steep rate. And we're expecting the economy to maintain itself. I think not, right?
The mistake was made a while ago, I think seems to be the consensus. Let's talk about what's happening in China right now. Big move lower in the Hang Seng a little bit earlier on. Is that just a reaction to what is happening with the Fed minutes? I'm also looking at what is happening with the currency markets as well, trying to figure out what the story is there. They're trying to support it. I'm wondering what happens next, how much support is going to be required.
I think that's the biggest story, and you've got your hand on the pulse here, Guy. I think the PBOC repeatedly intervening in the fixing market, fixing the currency higher than the market consensus repeatedly over the last couple of weeks shows you its resolve. This is a country that's trying to stimulate its economy. This is a central bank that's trying every single alternative, or at least the obvious alternatives that we have for it to support its economy, to support the currency. And just keep in mind that the PBOC has a very different mandate. They have to keep the yuan stable. It's not about it going high or low. It's about it maintaining those stable ranges within that 2% range, and that's why the fixing there. And so I think that's a massive story that's brewing in China, and it's going to have a massive ripple effect onto the commodities market, onto trade with Europe, equities, everything. And I'm really excited about seeing
Everybody's telling me to keep an eye on what's happening with dollar yen as well, because that could be the canary in the coal mine on this one. Noor, great stuff. Thank you very much indeed, Noor Al-Ali, joining us on what's happening in these markets. Let's stick with China. Treasury Secretary Janet Yellen starts her visit to Beijing today amid an increasingly turbulent relationship between the world's two biggest economies. Joining us now is Bloomberg Asia Government and Economy correspondent Rebecca Chung-Wilkins. Rebecca, expectations are really low for this trip. What should we be expecting? What actually is going to come out of this? If they just continue the conversation, is that enough?
Well, I think in part continuing the conversation and retaining those open lines of communication is important, and that's partly because Janet Yellen is actually going to meet sort of newly appointed counterparts. We do have a host of new leaders in Beijing in these top positions, and simply because of spiraling tensions, there hasn't been a great deal of contact between Yellen and her colleagues on the Beijing side. So that is significant. It is, of course, also significant that the US and China, to some extent, can figure out how to disagree together. But as you say, there is this fundamental disagreement, both sides sort of pointing these potential technological retaliations at one another. There's a little bit of perhaps a mutual ground to be found when it talks about China offering distressed sovereign nations some debt relief, potentially over climate change too, but really that's overshadowed by the tensions around the respective restrictions that both sides are now contemplating.
Well, speaking of those restrictions, let's talk a little bit about the metal curbs that were potentially introduced. I think gallium and germanium, a lot of what the analysts are saying, look, this isn't that big, it's more symbolic than anything else. But at what point do we start to see that kind of sentiment get accelerated or perhaps pulled back? Does Janet Yellen have any sort of bearing on what that might look like?
Well, China in some ways is somewhat on the back foot. I do think that the introduction of these two controls, we don't know, as you say, it's not a ban, and we don't really know how it's going to be rolled out, but it does signal this increased willingness on the side of Beijing to comprehensively start to counteract some of those measures that we've seen the US and its allies enforce. Take that in the context, just from a few days ago, of this sweeping new foreign policy that China introduced to combat, explicitly to combat these types of restrictions. So that's the broader context here. But we still have this message from Xi Jinping seeking to reject the idea of de-risking and decoupling, of course, to maintaining that China is open for business and wants to see more foreign investment. So there still is this sort of main narrative that we see Beijing trying to push. It's in no small part because of the challenges that you were discussing earlier in the economy. You know, there is issues that of just trying to get the economy back on its sea legs, shore up the currency. There's so much instability elsewhere. Youth unemployment, the property crisis still unresolved. If he can find a little bit of stability in the relationship with the US, that would offer him some relief and some space to tackle all of those other problems.
Yeah, something that has a very real read-through into the tech sector. Bloomberg's Rebecca Chung-Wilkins all over that story. I want to stick with that tech story, except bring it stateside. Meta's Instagram has officially launched the most serious threat yet to Elon Musk's Twitter. More than 10 million users have already signed up for the new app called Threads. Joining us now is Bloomberg Quick Takes Alex Webb. Alex, overnight, my phone buzzed nonstop because of the amount of notifications I got from Threads. You open the app, it looks identical to Twitter. How does it compare?
It is very, very similar. And the one thing that they are doing very well at is using the existing social graph they have, the social network they have through Instagram, porting that over to Threads, and therefore giving you an almost instant network. And that's something that a lot of would-be Twitter competitors, the likes of Blue Sky, the likes of Mastodon, have really not been able to do because they are not building on an existing product. Nonetheless, there are a few things that you don't quite have yet that you do have in Twitter. Not least, there is no desktop version, which when you think about a lot of power users, not least the media, people will have Twitter open all day, whether on TweetDeck or on the website, and that is not something you're able to do. You have to do it through your mobile. There are a few things like that, which I'm sure will come with time. There's a suspicion that they accelerated the introduction of this in order to capitalize on some of the issues over at Twitter, but it seems like a very propitious start.
Alex, what is critical mass? Where do they need to get to?
I mean, for it to be meaningful to Facebook, you need it to be sort of as big as Twitter, presumably. At the moment, it's at 10 million users, which, you know, that's great straight out of the gate. One of the fastest launches for a new app we've probably ever seen. But Facebook, or Meta, says that it has 2 billion users across all of its apps. So, you know, you're sort of about half a percentage of their total user base. Now, took Twitter 16 years to get to their users. If you're going to get to that point, you need to have those high quality users, the people who are going to post a lot, who are going to post high quality content, going to post news stories, videos, all that sort of stuff. You need them to be very actively engaged. Day one, that seems to be happening. How long can they sustain it?
Great stuff, Alex. Thank you very much indeed. Alex Webb of Bloomberg Quick Take. Okay, what have we got coming up for you? We're going to bring you a live interview with Rapid Energy President Bob McNally. That's going to be coming from the OPEC seminar. That's taking place in Vienna. We'll go there next. We're also going to catch up a little later with HSBC senior economist Liz Martins for more on what is happening with this rate story. Plus, Secretary Yellen kicking off her trip to Beijing amid China's metals ban. We're going to have more on all of this with Oxford's George Magnus. That's all still ahead. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policy.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. It is day 2 of the OPEC International Seminar in Vienna. Oil prices are steady, slightly in the green as traders digest the impact of the latest round of supply cut announcements. Bloomberg's Manus Craney is on the ground and joins us now with a guest. Manus.
Kriti, very good day to you. Yeah, we're outside the Hofburg Palace. Day 2. Let's see what the news flow is. We've brought Bob McNally out of the palace. He is, of course, president over at Rapidin Energy Group. Bob, good to see you this morning. You say that we are dancing in a macro minefield. What does that mean for the oil market? Define the macro minefield.
The macro minefield is central banks raising rates, credit conditions tightening, and enormous macroeconomic risk. We think back to 2008. We hope it won't be that severe. You can think back to other financial crises, but there's a risk of just a gut punch to the global economy and to specifically oil demand if you have a sudden implosion in financial conditions. That's the risk.
Are you not worried about a repeat of another SVB Credit Suisse?
We have to be, because the Federal Reserve is raising rates. The ECB is raising rates. The Bank of England is raising rates. Credit conditions are tightening. That risk exists. Now, it's not our base case. I would be betting on higher oil prices and big deficits here shortly. But does that risk exist? Certainly.
What makes you so sure that deficits and deep deficits will come in the second half of this year?
Two things. One, we think demand's going to be okay. Globally, 1718. China up about 900,000 barrels a day. The world's not going to hit the skids in terms of demand second half. Secondly, Manus, believe in these cuts. I think the Saudis are in it to win it. They are going to deliver large cuts. We're going to see exports decline. Russia's going to cut exports in August.
What do you reckon they'll do in August? Rita stood there this morning. She said they'll cut by 400,000. Will you meet and marry the energy aspects?
I'll see 400 and raise a little bit. I think they want those tanker trackers to show 500 down. I think it'll be closer to 500 than 400, but I think August is going to show a decrement in Saudi seaborne crude exports.
So if this really does come to pass in August, is that the clock ticking down? Is it August fill or kill on the real whites of the eyes of these deficits?
That's the amuse-bouche. We need to see the first course will be big cuts in exports in August. But, you know, it may be data or lag, Manus. You know this. It may be September. We have to see secondary sources. We have to see the inventories show up on land, clear the oil on the water. So it may be we need 2 or 3 months. But I think we're getting close. It's the summer of truth, and we should see it in the data here by the fall.
A former White House advisor, so let's put that hat on for the moment. Do you think the USA is peeved or pleased with an extension to the unilateral cuts and the Russians jumping on board? First take.
I think they are quietly peeved. Look, they're quietly peeved. They learned last October. Doesn't help to yell at the Saudis or OPEC Plus. Doesn't help. They're happy because gasoline prices are about $3.50 a gallon. As long as they stay that way, they're okay. They just don't want to see $4 a gallon. Until then, they'll just grin and bear it, as you will.
Okay, so they're going to go in and bear it. You say your bearish factors are reducing. What is it that makes you believe we can get to $90?
So I think we are.
And when is that $90 call?
Sort of toward the end of the year. I think we'll be heading towards $90 a year.
How do we get there?
So we get there by seeing first this summer these big deficits. Crude inventories start dropping significantly in July, August, and September, number one. Number two, we see that term structure, that backwardation that we now see in return. It stays. Now speculators get paid to be long. So all the short positions you see reverse and folks go long. So I think that'll cause that rally, that sharp rally.
I mean, we've just come out of contango and moved back into backwardation. So if I'm out there and I'm looking at the structure of this market, does that backwardation extend aggressively? And is that what helps the momentum on the strip?
Exactly. We think that backwardation will extend for Brent. You know, you're seeing it in Murban. You're seeing Brent trade under under Dubai. You're starting to see that tightness in the sour crudes, the beginning waves of those export cuts. We think that will intensify further.
Now, Sahil Al-Mazrui made it very clear yesterday, he was grateful and was thankful to the Saudis for their unilateral moves, but now is not the time for the UAE to join those moves. What would it take, or does it take, the UAE to step forward in that capacity to perhaps shift the dial again?
Well, I think if we get to the fall and those deficits that I expect and many others expect don't appear, and we are still soft in the market and contango comes back, then, if you will, I think the hat will be passed among leading OPEC plus producers for more cuts, more contributions. That's an if. I don't think it's their base case. It's not our base case. But if and only if we get to that point, I think then the UAE, Kuwait, Iraq and Russia will be asked to do more.
Let's throw you a curveball. Why not? What do you think Putin got from MBS to come on board with these cuts?
You know, I think Putin has learned stability is very important. He's gotten burned twice now by inadvertently contributing to oversupply in the market and seeing prices collapse. I think he has been burned, and I think the fear of a return to 2015 or 2020 is enough for Vladimir Putin to understand, better listen to the Saudis, better listen to the UAE. When they say we need to do more to keep oil prices stable, better listen. I think that's enough.
Do you think they are prepared to take that pain, even though they're in the midst of funding a war? And he needs those petrodollars to fund that war.
I think so. You know, it was only 3 years ago that the price of oil went at one point negative $37 a barrel in May of 2020.
Yep.
So memories don't fade that quickly. So I think Putin, as bad as it is for him now, it could be much worse if Urals is at $10 a barrel in November.
What's the risk they lose control like they did in 1986? Is that risk gone? Is that just off the table completely?
Low. I think the bigger risk would be 2020 or 2008, where they don't cut fast enough under an implosion of demand. That wasn't 86, was the Saudis just flooding the market because they were tired of being the swing producer for 4 years. That I don't think is going to happen. Bigger risk is that we get to weak demand, bigger cuts are required, they don't do it or don't do it fast enough, and they lose control to the downside. It's there, not my base case, but it's certainly there.
The 86 question was a Tom Keane question, by the way, Bob. If you're just wondering, I mean, the divinity that I have is limited. That is Bob McNally with me outside the Hofburg Palace on day 2 of the symposium, president of Rapidin Energy. Good morning, good afternoon, good evening.
Manus, yeah, I'll take all of those. Manus Cranny, good morning. In Vienna with Bob McNally. Really useful conversation. Manus is going to continue the great coverage we're getting from the symposium. You can see that throughout the day. Let's turn to, I guess it's kind of going from hydrocarbons into the brave new world of EVs and what has been happening in China. Some EV news definitely catching our attention overnight. Tesla and China's top electric vehicle makers, including BYD, have pledged to maintain fair competition and avoid abnormal pricing in the world's biggest EV market, which of course is China. The pledge basically signals a possible end to a price war that's rattled the industry this year. Critty, Tesla started this, which I think is fascinating.
They started this, they're continuing it, but it's a global phenomenon, guys, something that they really did. I think it started in the US, actually, to try to gain market share from the likes of General Motors and Ford, especially in a car culture here in the States where if your granddad bought a GM, then you're probably going to be buying a GM as well. The idea that this took an international twist and actually BYD, the largest Chinese EV maker, hopped on board is pretty interesting to me.
Well, they all did. A whole load of them did. It got really quite brutal in terms of the price war that we saw in China. Some really big cuts coming through, which Tesla ultimately started. What I think is fascinating is that there are 4 things, effectively. There's more than that, but there's 4 basic tenets to this agreement, which is non-binding, which they've signed up to. The last one is to promote core socialist values, which is something that Tesla has signed up to.
Yeah,
promoting core socialist values.
It is, but it's also worth keeping in mind that this whole thing was brought on by the CCP itself. I think what's more interesting is also how this is going to affect the market here, because remember, this was a controversial strategy to begin with. Tesla shares actually suffered when Elon Musk talked about this, and now being rewarded for going in the other direction.
Well, yeah, gross margins okay, but they're definitely going down the volume direction. We saw that in the evidence over the weekend. Liz Martins, HSBC senior economist, joining us next. Does the Bank of England get to 7? Does the Fed get to 6? We're going to talk about that next. This is Bloomberg.
Politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but...
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Hawkish signals from the latest Fed minutes firming up bets of a July high. Global stocks suffer losses as those bond yields start to climb further and further. And finding common ground, U.S. Treasury Secretary Janet Yellen arrives in Beijing for talks aimed at easing tensions and opening communication channels between the world's two largest economies. And Meta's Instagram officially unveils its Threads app, taking direct aim at Musk's Twitter. Millions sign up within hours, but it's not yet available in the EU. I'm Kriti Gupta in New York with Guy Johnson stepping in for Danny Berger. That all happening in London. Guy, what's interesting to me is that we have a lot of fundamental news, a sum of all parts trade, if you will, but it is still the FOMC that is taking the cake this morning.
The FOMC definitely spooked the market. That was more hawkish than I think we'd been led to believe. Unanimous, it clearly wasn't. But I guess the hawkish commentary since then should have told us what the real narrative was. Nevertheless, more hawkish. That spooked market. So you're seeing a big move in yield. You're seeing stocks coming off. Asia has sold off overnight. Banks seem to be at the center of that. I've heard it's dividends. I've heard it's the discount window. Anyway, take your pick. Basically, the setup from Asia is not particularly clever this morning. European stocks, as a result, are suffering. We are down by 1.2 on the 600. Take a look at the stocks 50 as well, down by 1.4%. Cameron Kreis keeps pointing this out. We keep bouncing off 4,400, and we keep doing it, and we've been doing it all summer. So keep an eye on that. UK 2-year, big move this morning. It's faded a little bit, but big sell-off. Yields are up. We were up a little bit more earlier. You've got the survey out on inflation expectations this morning, pointing to medium-term inflation expectations expectations going higher. Euro dollar going nowhere in a hurry. So basically, you've got a reaction. But later on today, you're going to get jolts at 10 a.m. You're going to get ISM services at 10 a.m. Eastern. Both of those two pieces of data, Kriti, I think are going to be critical to how this session develops.
Yeah, especially when it comes to the bond market. Guy, you mentioned that kind of souring sentiment in Asia and in Europe. Well, you're already seeing that seep into the U.S. session. Pre-market here down already 0.4% on S&P futures, 44.65 for anyone who's looking. If you're talking about round numbers, we are getting there in the stock market and in the bond market. The two-year yield, 4.97, just 3 basis points shy of that 5% level. Go further out on the curve, that 10-year yield, again, just 3 basis points away from that 4% level. What the JOLTS data really signifies is the ability to move this market. But I got to say, Guy, the technicals are going to jump back in when you hit those round numbers. I think that's going to be really crucial in terms of navigating the trade, not just in today's session, but going into payrolls tomorrow as well. I want to quickly bring your attention to Bitcoin because the ripple effects are crucial when you see this kind of volatility in the bond market. You're going to look at gold, you're going to look at oil, even copper. Also keep an eye on Bitcoin because you're already seeing a bid here, higher by about 3% this morning, trading Guy with a 31,000 handle.
Well, let's focus on the Fed, Kriti, and talk more about what we've had and what we're going to get. New York Fed President John Williams speaking in the afternoon yesterday, saying that the Fed has more work to do on monetary policy. He also says that he will be data dependent when deciding on the Fed's next steps.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense. Getting some more data, getting some more information about how the economy is performing, how the past effects of monetary policy are affecting economic activity and inflation, and then basically having a meeting by meeting decision about how to adjust policy.
Let's talk about how policy develops from here. Liz Martins, HSBC senior economist, joining me now on set. Nice to see you this morning.
Good morning.
Is the Fed going to 6%? Is the Bank of England going to 7%?
Well, we don't think so. We think the Fed's got one more to do. The BOE have 2, of which one is half a point. But clearly the market's getting more and more kind of hawkish in its expectations at the moment. I mean, it's really difficult at the moment, isn't it? There's this debate. Is inflation now about to come off? Is it going to stick around? Have we done too much tightening? Have we not done enough? And there's 2 schools of thoughts, I think, even within our team, about which way to go. And I think, I sympathise with the central banks actually making these decisions.
Is the risk to the upside or the downside?
Well, look, I think on inflation, the risks here are still to the upside, and it's because of these strong labour markets that we've still got. There are some early signs in some parts of the world that it is turning, but even if it turns, even if jobs start to go, even if we go into kind of technical recession, can pay growth lag that and continue to be passed on as services inflation? I kind of fear that it can, and that puts central banks in an even worse position where they've got high inflation and weak growth, and they've got to decide what to do with that.
Liz, Kriti in New York, as we talk about that trade-off, the inflation recession kind of trade-off that you almost just outlined, at what point do we start to focus on the recessionary take? I mean, it feels like this kind of whatever it takes mentality has been the mantra for the last year or so. At what point do we actually believe that a recession may actually materialize?
Yeah, well, look, we're not forecasting a recession, but clearly the higher rates go, the more likely it becomes that it all ends in tears. And at the moment, that trade-off feels, quite fairly simple. We need to conquer inflation, and at the moment, the labour market's relatively strong. Growth is still, muddling through. I think the difficulty becomes actually if you do enter recession, and more importantly, I think if you start seeing a real spike in unemployment, then the question becomes, well, how much do we want to get back to this specific 2% target? Can we live with 3 or 4% inflation in exchange for economic stability? We're not having that conversation yet because the economy sort of isn't in recession, but that's going to be a difficult question perhaps further down the line.
Liz, talk to us a little bit about the China read-through here. The fact that China may be exporting deflation in the near future, just given the kind of contraction that you're starting to see in that part of the world. Is that something that will be welcomed by the likes of Chairman Powell and his peers in Europe?
I think so, but I think it's something we're already seeing on the manufacturing industrial side, right? We're already seeing shipping costs right down to where they were pre-pandemic, a lot of commodity prices lower, a lot of manufacturing companies talking about outright deflation in their input costs. So that part of the equation, I think Chairman Powell and other central banks will be less worried about. I think where we're still worried is the kind of inflationary psychology aspect and in the services inflation bit. So every little helps, of course, on the manufacturing side, but I think the services is where we're really looking for an improvement here.
What's the relationship between asset prices and monetary policy at the moment? Central banks have tightened very aggressively. Markets in many ways have not responded as aggressively. Do we now need to see a financial markets response to these higher rates? Is that something that is required in order to get economies back to where the Fed wants? And could we see a divergence where we see a soft landing in the economy and a hard landing in asset prices? And how does that work?
I'm not sure we'd have one without the other. I can see what you're saying, that, you know, markets have kind of refused to respond to this higher and higher rate environment. And markets is one of the channels through which higher rates should work. And we know that the usual channel through consumer demand is operating in a very, very slow burn fashion. It's not coming through soon enough. So I think there's going to be other channels. There's going to be corporates lending less, investing less, maybe starting to let people go. Government spending probably is going to have to come down, and maybe a market, you know, adjustment might be a part of that story as well.
The consumer story is really interesting. We're talking about this over the last couple of days. Weirdly, the Bank of England raises rates. So let's use the Bank of England as an example. Mortgage rates have responded, but a lot of people are on a fix, so they're insulated from it. You've also got a huge number of people that don't have mortgages and have huge savings, which are benefiting from the higher rates. Is monetary policy aiding, assisting almost the consumption story that we're seeing at the moment? And how do central banks solve that?
To some degree, that's true. And not only that, but banks are now under pressure to pass even more of the higher rates on to savers. So for a segment of the population who are less affected by mortgages or even rentals, maybe they own their own home, they've got a nice pile of savings, you know, for them, demand is being actively stimulated. And the other part of the equation is government policy, where actually the government threw a lot of money at people in the energy crisis and continues to do so to some degree, or will do this winter. So in a way, you've got monetary policy rising, but you've got offsetting elements happening. And the other thing is the policy in the UK again to say to people, well, actually you can switch to an interest-only mortgage. Now, every sympathy for those households that are feeling the pain, but it offsets a big chunk of the impact if you do that. So no wonder it's working quite slowly.
Liz, I'm so glad you mentioned the fiscal read-through as well, because, of course, stateside, it's a major conversation about just how much of the kind of student loan forgiveness, for example, falls in that same category. Talk to us about the possibility or the odds of another pickup inflation. You saw that dynamic in some of the EM countries, a little bit of a feeling in Spain and France as well. What are the odds we see that actually happen in the next year or two?
So a pickup in inflation because of fiscal
or any other
policy. Yeah, look, I think it's reasonable. You know, we've seen a very long, you know, cycle here, and the supply side has kind of got less attention than the demand side, and actually the supply side has clearly been weakening, and we see that across developed markets. So yes, you might get a period where demand falls back and inflation falls back too, but then what happens if you don't increase the supply side? Well, as soon as the economy starts to recover, inflation comes back too, and fiscal absolutely plays into that. I think, you know, when you have central banks doing one thing and then governments on the other hand doing the other, then demand maybe doesn't get hit to the extent that you might normally expect it to.
Certainly something we're going to be keeping an eye on. A job, I have to say, I don't envy for a lot of the central bankers. HSBC's Liz Martins, thank you as always for your time and your insight. Coming up on the show, we go to the China story. George Magnus of Oxford's China Center joins us next. Stick with us. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. U.S. Treasury Secretary Yellen has arrived in Beijing to start economic talks as tensions rise between the world's two largest economies. Joining us now is George Magnus, research associate at Oxford's China Center and the author of Red Flags: Why Xi's China is in Jeopardy. George, a pleasure to have you on the show. Thank you for joining us. Let's start with Janet Yellen's trip here. How much progress can actually be made in terms of thawing the tensions?
Yeah, well, you know, it depends how you want to measure progress. I mean, if we're looking for breakthroughs and compromises and a restoration of what we might call normal diplomatic relations, I think kind of chasing the wrong path here. But from a low bar, I mean, I think it would be churlish probably not to say that the reestablishment of dialogue, which is what kind of kicked off with Secretary Blinken's visit to China quite recently, I mean, is a result of sorts, right? I mean, I don't think there's a lot that they have to talk about. There's very little they're going to agree about. But actually the reestablishment of dialogue and establishment of normal communications, if that is normal, I mean, is an outcome that we should say, yeah, it's check that box. It's quite important. But I think there's a lot that obviously the two biggest economies of the world need to collaborate and talk about. But I'm afraid I don't really see much in the way of breakthrough or compromise, to be honest.
Well, in terms of keeping that dialogue open, what's interesting is this is coming on the heels of a visit from Secretary of State Anthony Blinken, in addition to efforts already by ambassadors in that region. George, what would be needed after this trip to continue that dialogue? Another trip, perhaps? Another figure of the U.S. government visiting? What might that look like?
Well, I mean, I think it would probably be a good idea not to set sights too high, right? So if this kind of establishment of communication, particularly at this economic / U.S. Treasury level and senior economic representation in the Chinese government is base camp kind of thing, then obviously in the context of G20 negotiations, IMF negotiations about debt restructuring, climate change negotiations. I mean, there's a possibility that these kinds of things could plant a few roots. Obviously, there's a lot of speculation that Xi Jinping, may attend the APEC summit on the west coast of the United States later this year, which could set up the scene for a kind of off-ramp kind of bilateral meeting with President Biden. So there are we're talking about the possibility of two adversaries really kind of trying to thrash out differences, or at least talk about their differences, and find ways in which they might collaborate in areas where their interests are aligned. But it's really, really hard, and I think there's a lot of hard diplomatic work ahead, to be honest.
George, morning. It's Guy. Nice to see you. The PBOC, the Chinese authorities, would like to have some currency stability right now. They have a Fed problem. They have a global central bank problem. How tenuous is their grip on that stability?
Well, I think, I mean, I'm not sure that I mean, obviously, a lot of people I think you're alluding to, obviously, the weakening of the renminbi against the US dollar, which has, I think, reached a kind of low point it hasn't seen for quite some time. I mean, this is partly a reflection of, the sort of proverbial interest rate differentials, Fed's tightening, PBC is, if anything, is easing monetary policy. They cut interest rates quite recently. I mean, not that that's going to have much effect, but I mean, the Chinese economy is faltering. It's important for them to try to keep the currency stable. I think it's probably gone weaker than the PBC ordinarily may have been comfortable with. And there has been some sort of suggestion in the marketplace that it's kind of stabilizing a bit. But yeah, I mean, I suspect it's going to go down.
Could we see a significant revaluation, as we have seen in the past, which has spooked markets?
A revaluation?
Well, a reassessment of the currency level, a devaluation.
Oh, I see what you mean. I don't think at the moment the Chinese government and the PBC will be willing to sanction any such move. I certainly don't think they're willing to do it, out of pique. I mean, there's always a possibility that it could be done for that reason. But I don't think so, because things in the Chinese economy obviously are not particularly great at the moment. There's a lot of kind of instability in terms of the demand in the economy. They're very worried about kind of debt levels in local governments and the risk of bad loans in the banking system. So these things are all kind of coalescing. Sort of a devaluation or a depreciation of the currency that would actually ignite even further kind of illicit capital flight would probably not be something they would sanction. So I would expect them to try to keep a lid on this for the time being.
George, I want to come back to the geopolitics here, because in the light of these tensions with the United States and arguably Europe as well, it feels like the focus really shifts to some of the other major players in the Asian Pacific region: South Korea, Japan, India, arguably Russia as well. Where does China stand in terms of keeping its regional allies on its side?
Well, this is a 64 trillion yuan question, really, because we are looking, obviously, in terms of the big sort of geopolitical picture of a struggle for influence in countries, in Asia in particular, but in the wider world as well, in which, economic and political favors will flow. So obviously China has its Belt and Road Initiative. It's been kind of joined by a number of initiatives that Beijing has announced in the last couple of years: the Development Initiative, Security Initiative, Civilization Initiative. I don't think China is going to be very successful in knocking down doors in Japan, South Korea, for example, and India. And if anything, it's kind of pushing these countries more towards the sort of American orbit, I would say, even for countries that, like India, that don't really like kind of being forced to choose sides. And Modi's visit to the United States, obviously recently, is kind of indicative of that shift. So the real battle, I think, really is in more kind of more formally defined emerging and developing countries in Asia and Africa, South America, where not everything is going China's way, as I think people have kind of assumed, like, over the last few years that it would. People are kind of resentful a little bit about the United States and liberal-leaning democracies and the kind of demand that everybody should support their efforts in Ukraine. But, the American soft power still carries pretty heavy weight, I think.
Certainly puts a lot of the tensions in the South China Sea into a lot of perspective. Oxford's George Magnus, thank you as always for your time and insight this morning. Coming up on the show, look at some of the market-moving events you're going to want to watch throughout the day. Stick with us. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London. Kriti Gupta, of course, in New York. Kriti, let's take a look at what we've got ahead for the rest of the day. You get a lot of jobs data out of the United States. All of this could be really interesting. You've got ADP coming up. You've got claims. You've got JOLTS. You've also got the ISM thrown in there as well. We're going to get PMI data and ISM services. We will have instant analysis at 10 p.m. On 10 a.m. on all of that. Plus, we're going to hear from Dallas Fed President Laurie Logan. That is at 8:45 Eastern time. You've also got Joachim Nagel of the Bundesbank speaking at 12 p.m. Finally, President Biden speaking on Bidenomics, Love Bidenomics, at 1:15. And as we mentioned earlier, Janet Yellen beginning her visit to Beijing today. That name came about as a criticism. I think it was in the Wall Street Journal somewhere.
Yeah, a lot to digest, certainly on the macro front. Guy, let's talk about what's going on the micro front, because there's a lot of individual movers as well, of course, as we monitor that trip for Janet Yellen, specifically in the banking space, the financial space. We know that we just got those stress tests from the Federal Reserve around a lot of the U.S. banks, potentially saying, look, that they can ace them, but they weren't really testing for a lot of the interest rate risk. Nevertheless, after stress tests traditionally is when a lot of the banks come out with their dividends. Bank of America now saying they have about a 9% payout. Nevertheless, you are seeing the stock pull back about 0.5%. 0.6%. We are also seeing some comments from the ECB, the banking watchdog there, essentially saying we might need to raise the requirements for European banks. So seeing a pullback in the European financial sector as well, which is having a very real read-through into the ADRs of the likes of Barclays and Deutsche Bank as well. I want to go global and talk about the EV story because, of course, that has been one that's crucial in terms of China. 16 EV makers plus Tesla signing on to fair practices, basically saying we are not going to engage in a price war. A lot of those stocks also down with the broader market. But Guy, this is the story that I think takes the cake. Meta Platforms releasing their own Threads app, their own version of social media, or Twitter, I should say, to compete with Elon Musk's Twitter. Meta Platforms higher by 1.8%, but some of its competitors, like Snap, down about 0.6%, and even Tesla, which I'm putting as kind of a proxy for that Twitter story, also down 1%, Guy.
You're on it, right? Early thoughts?
I am on it. Look, it's very similar to Twitter, so I'm trying to understand kind of the difference, but it also kind of feels like Facebook, so I'm curious to see how they expand it.
Okay. We look forward to watching that. At some point, I'll sign up as well. We'll see.
Certainly something we're going to keep our eye on. That's it for Early Edition. Surveillance is ahead. Stick with us. John and Tom, take it from here. This is Bloomberg.
Faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The dip and rip hasn't happened. It's been more sort of rip.
You know, it's an interesting time because no one expected what happened in the first half.
What's important is what's really dragging up the market and how much more can that go.
You have this math problem where the giant stocks get bigger and they push the indices higher and don't drag the rest of the market with it.
I wouldn't chase this rally too much. I would stick to your plans.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market just about negative 0.4% on the S&P 500. Pushing forward from here into payrolls tomorrow. TK a little bit later this morning, jobless claims. We'll get some data as well from ADP, job openings, all of that stuff. But we kick off this morning distracted by a new app from Mark Zuckerberg
We've been
and
sitting
Instagram.
Here. If you guys can see us big little here 2 minutes before John's like, can you open Tom? I'm on Instagram.
What do you make of this one? What do you make of this?
I make it's a huge deal. I'm guessing I could well be wrong. I defer to Alex Webb on this, but I think it's a huge deal. It's about the fabric of the nation, about our social network, and we'll have to see where it ends up. To get back on track here, this is an important Thursday. We've got the right guest to lead off, George Goncalves, to give us wisdom. John, I'm sorry, into jobs, into all this economic data, we have a new rate structure this morning.
It's amazing, isn't it? It's not just the Treasury market getting back somewhere close to 5% on a 2-year. It's also in the United Kingdom, the gilt market. Do you remember the drama of the end of September last year in the UK when gilt yields were in and around 470? 2-year right now, 545. And we're talking about potentially bank rate over at the Bank of England going through 6 and maybe getting to 6.5 at some point in the next 9 months. Pretty phenomenal stuff developing.
I get the drama of 6% chit-chat, and folks, this is really important if you're in the stock market as well, but we're just going to focus on the tea leaves this morning. We go into Thursday compressed economic data, claims and the rest of it, and into jobs tomorrow with a 10-year real yield, which is almost on the edge of a reset to a higher inflation-adjusted yield. John, a 30-year mortgage jump condition over the last 6, 7, 8 days since you were on Island 4 in Italy from a 7.05 out to 7.21% this morning.
Is that biting yet? Who's paying it? I saw some stats around apartments in New York City, luxury apartments, some of the new stats. The amount of people, Tom, just paying in cash. Now, if you've got cash, great.
It's not America.
It's not the rest of the country. But, Tom, the rest of the country, for a lot of people, did remortgage. They have locked in these very low interest rates for a long, long time, pushing it out, say, 30 years. How much of this interest rate structure that you describe is actually starting to bite?
I think it's starting to bite geographically and always in the real estate business, particularly in retail and individual. You look to the West. I'll be interested to see what the rent dynamics are in the West. I believe the statistic right now is a negative 6% on year-over-year rent out California, Arizona, and that's sort of the front of what's to come.
Lisanne Saunders coming up a little bit later this hour, I believe in about 28 minutes on the equity market.
She's on Threads right now.
We'll find out if she is on Threads. I'll tell you what, Tom, Elon Musk snapping back already on this. It is definitely preferable to be attacked by strangers on Twitter than indulge in the false happiness of hide the pain Instagram. What do you make of that take of Instagram?
Does Zuckerberg have 10 homes, or is it Musk that has 11 homes? I mean, it's surreal. And, you know, we're going to be unbiased on this. John and I are going to kill ourselves not to give an opinion on this. We'll let others do that. But I'm sorry they're launching this thing after all this, 1 year uproar.
If you're creditors to Elon Musk and this platform, I think you're taking this pretty seriously this morning, Tom. I really do think you are.
Yeah, I believe Morgan Stanley, I don't have it in front of me, but I think Morgan Stanley was involved in that transaction, and they're going to be waking up. You know, they're going, Ellen Zentner, are you on Threads, Ellen? You know, be careful.
Do you remember Clubhouse?
No.
That lasted like 5 minutes, so
what was the one before Facebook?
Of course, this is very different.
MySpace? MySpace, very good.
MySpace?
Yeah. You know, it's way back.
You think Twitter might go in the same way as MySpace?
I don't have an opinion. All I know is I just signed up for Threads, and I'm rolling. I got the photo up there. The dogs are on. You know, I mean, vet bill and kennel fee are on. It's great.
Oh, you're doing dog content on Threads?
Oh, yeah.
Okay, so you won't do markets?
Well, no, their handlers have it. I don't do it.
Okay. We'll catch you with Dan Ives of Wedbush on this a little bit later this morning as well. Let's get you up to speed on the price action. Equities right now, negative 0.4%. Bit soft and negative here. Snap at a 3-day winning streak on the S&P just yesterday. Bond yields higher. Again, we're looking at 4% on a 10-year, up 4 basis points to 3.97. And looking at the FX market, the euro actually showing some strength now. 108.65. A bit of weakness yesterday, Tom, on the euro side of things.
Quickly, Mexican peso printing through 17. Never did I think I'd see this. Think about Mexico, an election 2 ago, 21-22. Mexican peso goes through 17.0.
What's happening over there?
I just think it's the adjacency to the American boom is my short answer. Plus, all of Latin America is doing well.
George Concalves joining us now, head of US macro strategy over at MUFG. George, wonderful to hear from you, sir. We all read the minutes yesterday. Some of us did, at least. I think TK gave that one a miss. But George, I think the question I've got to ask you is how significant is the division emerging on the FOMC?
Look, I don't think it's significant yet. I mean, the commentary that we got after the minutes probably mattered more. I mean, like they're going to hike in July most likely, unless something really derails it from here until then. But I do think there was some important pieces in the minutes that are worth mentioning. They're starting to focus on, although inflation is, they're highly attentive, and that's the main focus of theirs. It continues to be, but they are starting to focus on some of the growth factors, like the fact that GDI is diverging from GDP. I'd never expected to see that in the Fed minutes, and the focus on like the BLS data maybe is over counting jobs. So I think the Fed's starting to think about how robust is this recovery at this stage.
George, thrilled to have you on today. Just the right guest at the right time. I want to focus on the inflation-adjusted yield. Our listeners and viewers, it's not a common statistic. It's at 1.73, ballooning up for 1.58. Where is your pre-pandemic normal on the real 10-year yield?
On the real 10-year yield, I think we're surpassing it. I mean, we're actually getting back to levels that we're seeing pre-GFC. I mean, if we were to make a move towards 2%.
Agree. So what is the level here where it begins to fall apart?
Look, so in any other time period, because we've been operating with these huge lags that have been, kind of this liquidity buffer has been allowing markets to ignore the real rate. But if the real rate continues to march higher like it has been, I think that financial markets will take notice pretty soon.
George, you expecting a hike then in several weeks? Just to be clear, just to start there.
Yes, I do think that, given the language as well as what's priced into the market, it will take a lot to derail a hike.
And the next one after that, George, you expecting another one after that? Because there's a lot of people that think maybe they go in July, perhaps they're done. Others look at the FOMC and what the committee is communicating right now and see another one in our future.
The one that follows, I think it's really going to be about financial conditions. I mean, we're starting to see more tightening, and I think this real rate channel is important that Tom's highlighting. So I think if we were to continue to see the overall rate structure move higher, let's not forget that since last year, the 10-year in general has traded well under the Fed funds market. And so if we get a kind of normalization or a catch-up, even if it's a brief catch-up, like an anti-seasonal rise in rates, which people call a bear steepener, which we had a little bit of that yesterday and a little bit this morning, I think that's really matters. I mean, that will be where tightening takes place, because we've had rates under, and that's really helped out the housing market. So if we were to continue to see a rise in 5-year, 10-year rates, I think that would be a game changer.
Well, George, let's build on that. Let's go further out the curve. The Federal Reserve right now has communicated a couple more hikes. You seem to be on board. Potentially, that's going to develop. The Federal Reserve is also communicating at the same time, simultaneously, a mild recession, potentially in the second half. What should a 10-year be doing in the world that the Federal Reserve is projecting?
Well, I mean, it depends what kind of inflation, what kind of recession we get. I mean, we have this, we have about 15-20% risk of a stagflation, which has never been really in the cards for U.S. economic forecasting. But I think that stagflation risks are out there. That at some point, if the Fed can't really get inflation under control, I mean, you're seeing similar situations with the BOE. I mean, you could raise rates to 10%, and it might take longer to get inflation down, and all you're going to do is crush the economy. So I think, I mean, it really comes down to like a stagflation recession nuance.
How does a yield curve disinvert? What are the threads of like that, John? Thank you.
Sure, that was
nice. What are
nice.
the threads of information that allow us to disinvert, say, from negative 105 to say negative 40, negative 30?
So traditionally, it's always been the Fed cuts rates. I mean, if the Fed were to cut rates 200 basis points, the 2-year would move much faster than the 10-year for sure. Bear steepeners are kind of like unicorns, really hard to find. They're very rare. When they happen, they're short-lived, but they're very painful. So a rise in long-term rates, we haven't really seen that happen on a consistent basis. So it would have to come from the front end.
This is critical, George, and with MUFG and the Japanese affiliation, you've got first-order knowledge on this, domain knowledge on this. If the long-term yields are lower, is that pricing up yield down by foreign buyers of full faith and credit U.S. paper?
At this juncture, really, I mean, look at the actual public flows and see what's going on. This has really been a domestic-driven bond market. It has been for quite some time. We've seen less and less foreign influence for years. And so and especially in the last number of months, I do think that most of this will have to be taken down. The supply that the U.S. government's bringing to market, a lot of it will have to be taken down by domestic investors. I mean, foreign investors obviously play a critical role, but I just think that given where funding costs are and everything else that's going on, and more importantly, now the U.S. Treasury has competition from other markets. Other sovereign markets are yielding higher as well. So, and we don't know what the BOJ is going to do with its own policy, which then might make JGBs more attractive at home. So I think that the level of rates, the curve maintaining its steepness is something that I think is going to be critical, even when the Fed starts cutting rates later on.
What is your strategy as a bond portfolio? Take a full faith and credit portfolio. What is a duration strategy? Do you barbell? Do you ladder? Do you single point? Do you go to cash? What do you do?
I think you have a bias of a ladder, but with a misweighted. I do think that at some point, if the Fed keeps raising rates, we have an attractive front end. So I mean, your risk reward is how much downside can you get if rates were to move another 25, 50 versus them going down 100 or 200, right? So the risk reward has changed. And you have to look for plays that are more convex. The mortgage rates and mortgage markets, mortgage bonds specifically, as rates rise, would also be much more attractive.
George, this was fun. Anything but boring right now in the bond market. George Concavos there of MUFG. The high of the session on a 2-year 4.98. Tom, I'll try and get my words out.
Do it until you
4.98 probably would be better. 4.98 is the high of the session. That's also incidentally the high of the week, just short of where we got to in early March, which is 5.08%.
Small matter. While you were gone, we had West Texas Intermediate, I think, with a 68 print, even a 67, 66 print, and we've come back smartly. We got a 72 level on West Texas Intermediate. Brent out rounded up $77. It's not a tangible move, but it's a little bid to the system, which is a change from a week or 4 weeks ago when you left.
One more hike, 2 more hikes, TK. Ultimately, what's next after that? I think it's pretty interesting. This Federal Reserve is communicating a couple more hikes in a mild recession, and the equity market seems to be taking it pretty well.
When the facts change, Jerome Powell will change. You get yields going here, and the mortgage rate. It's like somebody, I think Ed Hyman mentioned the other day. What a great conversation with Mr. Hyman. As gloomy as he's ever been on the recession, and he said, you know what? It's still about a gallon of gas. And so, you get gas to go, 80, 90 on Brent crude. What does that do to a gallon of gas? All of a sudden, the political pressures change. Forget about all the macro babble. It's about...
Oh, I'm with you. I'll talk about the politics in the UK right now. Wow. Looking at this rate move.
You have to translate
developing at the moment. It's pretty incredible. Some real pressure developing over there.
Let's digress here, because, I bust John's chops, folks, but his work during Brexit was absolutely freaking brilliant. John, is it just a given that Labour takes over? When do they have an election? We have it the first Tuesday of November. We know what's coming.
We know when it has to come by. We don't know when it will be, so to speak. So we have a decent idea of when it's got to take place.
Mr. Sunak controls that decision?
He's going to have that decision to make. And ultimately, Tom, at the moment, going by the polls, and this is not my judgment, just based on the polls, Keir Starmer gets in. The Labour Party gets in. And you have to wonder how things get better from here. Can they get worse at the moment? Just in terms of the rate structure, we can talk about what's happening with the economy. The economy has surprised to the upside, Tom. Just to be clear on that, that's important. It has surprised to the upside. Whether people actually feel that way, and that distinction, Tom, between the economic data and how people feel has been a topic of discussion for us for a number of months.
Take us out. I got to go to Threads.
You're busy on Threads?
I'm busy on Threads.
Okay. It's good to be back. You going to give me a break on taking time off yet? No?
I don't know. I'm thinking of taking 6 hours off in August.
Equities right now, futures, slightly negative. I might join you from New York City this morning. Good morning. This is Bloomberg.
the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policies.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense. We can take some time and assess and collect more information, and then be able to act, knowing that we also, have communicated through our projections that we don't think we're done based on what we know.
John Williams there, the New York Fed president, just a touch of Fed speak following the Fed minutes yesterday, indicating one more hike could well come in July, and a truce may be, an agreement that was struck on the committee, a divided committee, to skip the June meeting, wait for a bit more data. The problem, Tom, at the moment with the data front is that we only have one more payrolls report, that's tomorrow, and one more CPI report, that's next week, and then it's bring on July.
I really thought about this a lot over the last week, and what this is really about, John, is we were ultra-accommodative, then accommodative, and some form of neutral, and I think even, for example, Bill Dudley or Andrew Hollenhorst would agree with Ed Hyman. We're there to the tension point where each decision has really significant weight. And this July meeting, whatever they decide, it's not a small matter.
Andrew coming up later, by the way, says hike in July, hike in September. Yeah. Tom, it was curious to me that in the minutes, there were people who were basically dissenting but didn't dissent. What do you make of that? I don't understand why the Federal Reserve,
where do you want to start with
unlike
this?
the Bank of England, won't just come out and say, you know what, I disagree with the decision, I thought we should have hiked at this meeting. What's all that about? Why do they have to show some kind of united front in public all the time? What for?
This is a legacy, and I'm going to go to the gentleman from the Washington University of St. Louis. His name is Lawrence Meyer. He wrote a beautiful monograph in Modest Fury years ago about how Greenspan controlled the Eccles building. And there's one chapter in there which begins the heritage of how we're different from the Bank of England and, frankly, from the ECB. It was Greenspan saying, we're all on the same page, and I've got the voice. You guys can show up and give me wisdom. But my good friend Alan Greenspan said, I'm the one in charge. And the legacy of that is there, and Lawrence Meyer brilliantly described it from 25 years ago.
An agreement between the Doves and the Hawks at the last meeting to say basically we'll skip this one, project more to come, and maybe agree to hike at the next meeting, which is just a few weeks away. If you are just tuning in, welcome to the program. Equity shaping up as follows on the S&P 500. Just a touch softer. We're negative here by 0.4%. The event of the moment for international relations, Secretary Yellen touching down, Tom, in Beijing today for conversations with her counterparts in China.
We need to go out and find somebody qualified here, and the qualities are that Chair Yellen is Chair Yellen, Secretary Yellen is Secretary Yellen, who is expert on China, that's worked at the Fed and also worked at the Treasury Department. He is Michael Herson of Eurasia Group, now head of China research at 22V Research. Michael, in the zeitgeist on Yellen's trip, what's the thing most off the mark? What do we need to know that's germane, that's not being reported right now?
That's a good question. I think what's most off the mark is maybe
there's a sense, which I think is accurate, that there aren't really going to be any deliverables from this visit. I think that's very fair to say. But this is one of those occasions where just establishing those lines of communication, it's not sexy, but I think in this case, it really is important. We've got a new economic team in China. We've got a relationship that's badly frayed, and we've got the two largest economies in the world, and a Chinese economy that's, I think, coming under some significant pressure. So I actually really think this is both a trip that's not going to produce much directly, but is quite important.
What's important to me here is the British phrase overcome by events, OBE. How close is Beijing, and particularly their leader, to being overcome by events where they have to radically change their tone with America?
I don't think that they are there yet. I don't think that they feel truly, excuse me, acute pressure such to change the relationship with the U.S. I think there's a quite high bar to get there. But I do think that there are risks of accidents in the relationship. The balloon episode clearly showed that. And there are also risks of accidents on the economic side, whether that's something that happens domestically within the Chinese financial system or U.S. financial system for that matter, or that happens between the two sides when we have these pressures for decoupling or de-risking or whatever you want to call it. We've had some reminders even this week about some of those pressures. I'm speaking here of the Chinese moves to impose export controls on some metals used in semiconductor production and potential U.S. restrictions on Chinese companies using cloud computing. So there's a lot of risk for accident, and that's why I think those channels are important. They're not going to be resolved on this trip. They're probably not going to be resolved at all, but the ability for Yellen to make contact with this team so that if they need to make a follow-up call, they know who's on the other side of the line to establish that dialogue. That, I think, is really important.
Michael, language is important. We hear decoupling and de-risking quite a lot. What's the key distinction between the two for you?
Honestly, neither of them are good. I think decoupling was clearly not the right framework because these two economies are not going to be separated from each other. De-risking, I think, is a little bit better, but also doesn't capture it. De-risking sounds passive. It sounds innocuous. What we're really talking about is, I think, a dynamic, and this is kind of academic speak, but I think it's really correct here, is weaponized interdependence. These are two governments that are really using supply chains, sanctions, different tools to try to achieve an edge and to try to, influence each other's behavior. So de-risking is too innocuous here to describe what's going on.
And Michael, it seems to me that they want to identify very specific parts of the economy in China that they want to stop the U.S. business doing business with. Michael, do you think that's possible to do that with a country like China?
I think it's going to be very difficult. I think the areas that are now defined by national security concerns in both countries are becoming much broader. National security is now an issue that is moving into areas like biotech that one normally would not associate with a national security issue. So I think it's going to be quite difficult. And I think the other challenge here is that, and this is why decoupling doesn't really make sense as a concept. Decoupling is a macro term. You can look at the fact that U.S.-China trade, continues to rise and say decoupling's not happening. But really, the story here and some of the economic risks happens at the supply chain level. It's choke points. It's, what happens if China doesn't allow, certain metals or rare earths to be exported. It is the impact that U.S. semiconductor restrictions are happening throughout China's tech sector. So it's really not at that macro level that we need to worry. It's at those, those really intricate, complicated supply chains that, frankly, policymakers don't even fully understand.
Michael, smart. That's something we've all got to work harder to understand. Michael Herson there of 22V Research. Thank you, sir. Thank you very much. TK, I think an easier question to ask is, what isn't a national security concern with regards to these two nations right now?
Yeah, I agree with that. I think it's all linked, and what I would look at, which has been underreported this summer, is the Pacific expansion of the U.S. Military. The shifts here, remember, John, Trump, Clinton, Trump, the agreement, the massive bipartisan agreement to walk away from some form of trans-Pacific trade agreement. And it seems like ages ago. That might as well be, it might as well be 40 years ago. And now we're to the point where we're figuring out where to put the next base to look for submarines.
Do you think anyone wants to introduce that concept again? I don't see that happening in the politics at the moment.
No, I don't. Based on what I read, and particularly from Greg Villiers, who's been brilliant on it, I just don't see it coming up. With that said, I think the G7 meeting in Italy coming up here in the number of quarters is really, really
12 months from now. I think it's so important. It's so important that we attend that G7
I think
get together.
The security is so strong that...
No, it's massive. In fact, Tom, I think that might be the most significant G7 in the history of G7 summits.
Could be says Churchill and FDR off the coast of Newfoundland.
That big. And we'll be having a conversation about why we should be in Puglia in June 2024.
It's a daily request.
To attend that truly historic summit.
It is truly true. Thank you. I got to get back on.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Live from New York, welcome to the program this morning. Plenty of economic data coming up through the next several hours and into tomorrow, of course. Payroll's just around the corner. Jobless claims, the ADP report, and job openings coming up very shortly as well. Into all of that, your equity market a bit softer, negative on the S&P 500. We're down by 0.4%. Snapped a 3-day winning streak on the S&P yesterday, taking a little bit more weight off the recent rally over the last few months. Never mind the last few months. Year to date, double-digit gains on the S&P. Just phenomenal stuff relative to pretty downbeat expectations, Tom, at the start of the year.
I got 4, 5, 6 places to go on the data screen looking at the Bloomberg Launchpad. John, I'm going to go to the 2-year yield right now. We're going to get a 5% print, 5.00 on the 2-year. We're not there yet, but we're getting there. The other data I see here, which is absolutely critical, is I'm up to 22 followers.
I can see you distracted based on
I'm
that.
distracted. You know, it's great. I mean, Brahma won't follow me. I mean,
what is a thread? Have you threaded yet?
No, I haven't threaded yet. I'm following F1 people. We've got the British Grand Prix this weekend.
Nice. Silverstone.
Have you been? Is it?
I've never been, and we should go.
Is it?
Maybe we could make it. We could fly.
Is
to
it
London.
like different than the others? Is it like Austria, where it's sort of wider but not stupid wide?
Rains
like
a lot.
Miami?
It can rain a lot.
It can
Given
rain
that
a
it's
lot?
the UK, have you seen what's been happening with Wimbledon, the tennis?
Yeah, big rain.
Lots of rain.
Yeah. Everybody there's on threads.
Typically a problem. Have they been threading
They've
as
been
well?
threading.
Nice.
Lizzie
Okay.
and Saunders.
I want to get to the
She's
bond
up to
market
like 500
briefly.
threaders.
2-year yield up by a couple of basis points. When's Brentmo back? That's what everyone wants to know right now based on how this is going. 497 on a 2-year, 498 a little bit earlier, close to 5%. Remember, the higher the year, higher the cycle, 5.08%. Not a million miles away, 10, 11 basis points away from that level, going into the banking malaise, coming out the other side, and we put all that yield back on top again, Tom.
Real yield coming through 1.73%, and the real yield, the 10-year inflation-adjusted yield, that matters to Liz Ann Saunders with decades of experience, chief investment strategist at Charles Schwab. Liz Ann, I just want to cut to the chase. How do you identify a second leg of a bull market, or do you just hope and pray? I'm looking at a summer, not of discontent, but a summer of building walls of worry. That sounds good to me for equities to go higher.
Not only good, I think it's necessary at this point, because what we had going for the market back in October was sort of the trifecta of an oversold market, technically improving breadth under the surface, even though the indexes had taken out the prior June low, and you had really washed out sentiment. Fast forward to the recent period, sentiment has gotten arguably pretty frothy, both on the attitudinal side of sentiment measures as well as the behavioral side of measures. You look at things like equity ETF inflows, 80% of them were in equities out of all ETF flows in the last month. So sentiment has gotten pretty stretched. And you rightly point out, Tom, it's not just about nominal yields, but real yields, which are up because inflation hasn't reaccelerated. And given rich valuations and multiple expansion, which has nothing to do with earnings this year, it's all multiple expansion. I think the rise in both nominal and real yields is starting to kind of take a bite out of some rich valuations.
How do you participate in equities? At the margin, do you sell shares? Do you make a dramatic move to the triple leveraged all cash fund? I mean, what do you do if you're in it? You're modestly or frankly really successful in equities last 12 months. What's the action plan?
So I think there's 3 action plans. 2 of them are really back to traditional disciplines, but maybe with some fine tuning. So diversification, but we've been emphasizing this is when having some international diversification is to your benefit. And our bias has been a bit more on the developed international side than the EM side. Rebalancing, but a nuance there is maybe consider portfolio-based rebalancing versus, say, calendar-based rebalancing. Like traditional mutual funds rebalance the last week of every quarter. Some individuals just do it once a year, or maybe a couple times a year. Let your portfolio tell you when it's time to make an adjustment, doing some, adding low, trimming high, as I like to say. And then, as you know, Tom, we've been very factor focused with kind of a quality wrapper around factors. So strong free cash flow, healthy balance sheet, self-funding companies that don't need to go to the banking system or the credit markets, positive earnings revisions, positive earnings surprise. So we think focusing on those quality-based factors with span both on the growth factor side of things and the value factor side of things is the way to approach what you're doing inside your equity allocation.
Lizanne, wonderful to hear from you as always. A conversation that Tom and I have been having over the last couple of months is just the amount of people that went into cash at the start of the year and feel trapped by it, and they've missed out on these big gains year to date. Could you just give us some insight into how conversations have been going with clients who have been in cash and maybe putting too much money into cash relative to the gains we've seen elsewhere?
So I think it really depends on the client. What we're finding is a lot of our investors that are yield-oriented investors, even with the bit of a miss on the performance upside, are perfectly comfortable locking in that 5% after years and years and years of having to go way out the risk spectrum. And then I don't need to remind you all there, John, you talk about it a lot. There's the concentration aspect. So yes, if you're an index investor and you were out of the indexes, you didn't get that cap-weighted benefit. But if you were an individual stock picker, given until very recently how much equal weight is underperformed cap weight, you would have had to be in the mega cap 8 names, because that's where the vast majority of performance has been. Whereas the other stocks, the other 492 stocks, at the end of May into the beginning of June, it was record percent of stocks were outperforming the overall S&P index over the prior 3-month period of time. So really depends on who the investor is. But yeah, you needed to be in the cap-weighted indexes to match that kind of return, unless you just were in the mega cap 8.
Lizanne, you mentioned international briefly. Could you build on that a little bit more about how people should maybe approach taking international exposure, particularly for those people that maybe haven't done it before?
Right. Well, so from the perspective of Schwab, our strategic asset allocation models, in terms of what percentages they apply across asset classes, of course, depends on whether you're on the very conservative end of the spectrum or the more aggressive end of the spectrum. And we don't pick individual countries on a regular basis, but our emphasis within developed markets has been more Japan than Europe. But because we approach it more at the big picture, developed markets versus EM, there's any number of ways to take a somewhat passive approach to get that exposure without having to pick individual countries.
Where is the value that's not a value trap on a sector basis? I think I want to talk about energy, but tell me I'm wrong. And there's another sector that is an opportunity rather than a trap.
Well, energy, I'm glad you mentioned that, because it's generically considered value, but because of the massive earnings growth, not this year, but last year and even in the year prior, remember that S&P does the rebalancing of their growth and value funds in December versus Russell's, which just happened last week. What happened with S&P's pure growth index, December 18th, the day before rebalancing, pure growth was 37% tech and had all 8 of the mega cap 8. On December 19th, S&P pure growth was 13% tech, and energy was the largest weight within pure growth. And only 1 of the mega cap 8 was still in pure growth. So energy was a growth area last year in terms of the fundamentals of earnings growth. We generically think of it as value, but last year it was the only sector that was up. It was mostly in the value indexes until the end of the year, and then it moved into pure growth. So I think you want to focus less on monolithic sector calls or even style like growth value calls, but don't put blinders on to sectors. There's a way to look for value, screen for value, and apply it to growth sectors, because there's value within those sectors, and there's often growth within the sectors we generically think of as value sectors. So you've got to be more open and think about growth and value as characteristics more so than index labels.
Help me with everyone that is in passive land. It has been just a great ride for passive, I'm going to say over 10 years, maybe coming out of 2009. Just at Schwab in general, do I want a less R-squared non-passive approach, or do I want to stay on a passive, whether it's SPX or it's something more narrow?
We're not or folks when it comes to passive versus active. We're and. We think there's a home for both. And it's also a function of who you are as an investor. Are you purely just looking to match some particular index? We do think, so last year active did better than, or active had I think best year since 2005 in terms of percentage of active managers outperforming their benchmark. Equal weight did very well last year. Correlations are now coming down. I wouldn't be surprised if equal weight starts to reemerge again relative to cap weight, and that is to the benefit of active. That doesn't mean active is going to leapfrog passive. It just means that active May like last year, have a more level playing field on which to compete relative to passive. But it's really the individual's choice for a variety of reasons.
It's just fascinating to me, Lizanne, where we are, and I just really want to harken back. You're too young to remember this, but there was a big lift in 75 or 76. Zeppelin was out. I think it was on the West Coast. And Lizanne, all of a sudden, there was a second leg to a bull market, which at the time, I remember this clearly, no one saw coming. Are we there now?
I think too soon to tell. You're right to point out 75, but that was the beginning of a cyclical bull market. It was an ongoing secular bear market that didn't end until the early 80s. Interestingly, 1975 and 1983 were the 2 years where the performance of the NASDAQ in the first half was stronger than what we saw. This was the third best first half. Now, you were at the beginning of cyclical bull market in 1975. That meant, though, you still had some more upside, but unfortunately, you had a significant amount of downside. 83, different story, because you were in the beginning of a secular bull market. But in both of those cases, the first half strength gave way to second half weakness. It was more what happened beyond that was defined by the secular nature of the environment that we're in. I don't think we're in a secular bear market. I think what we had, both with the COVID bear market as well as the bear market last year, assuming it's over, I think we're, let's hope anyway, cyclical bear markets in an ongoing secular bull. But I think we're in some sort of tricky state where it's hard to figure out what, say, the next 10 years looks like.
Lizanne, Clinic, as always. Lizanne Sanders there of Charles Schwab. Lizanne, thank you. Thank you very much for joining us on the equity market. The surprise of the year, Tom, just the performance we've seen in stocks relative to the gloom to start 2023.
Well, you go to stocks, but you got to go to other places as well. And that's why this, it's like July, what was it, 98 degrees yesterday? I mean, it was like crushingly hot. It was like sort of hot like an Italian island, but with humidity. And the answer is, John, there's a lot going on here into these 2 days of economic data coming up in less than 2 hours. I'm going to go to the 10-year real yield, 1.7344. I like what Kit Juke says, and he calls it big figuritis. I've never heard that phrase. It's brilliant from the gentleman at SocGen. Big figuritis is what you're going to have to pay at the tots to keep Harry Kane. Also, big figuritis, 4% this, 5% 2 year. And I'm going to take it over to foreign exchange. I'm sorry, 16.99 on dollar MEX is a big figure. That's a shock to people. Stephen Englander's got to look at that and go, what happened?
It's amazing how much you managed to fit in there. Digs about my vacation, squeezed in Tottenham as well.
It's a skill.
Sprinkle
it's a rare
of
skill.
A little bit on Kit Jukes and SocGen in the bond market.
Arsenal tots, September 23.
You'd like to go to that, wouldn't
Jukes,
you?
he's got like 6 season tickets.
Kit's got 2 season tickets,
Leave the kids
I believe.
at home and he can take you.
I've attended a game with Kit before. Would you like to attend that game? Yes. We've been to the Emirates together many years ago.
I was going to call up my good friends at the tots and say,
In fact, I believe Kit and I actually watched the North London derby together. We watched Arsenal versus Tottenham.
We did not.
Arsenal crushed
I was at
Tottenham.
the Lanesboro having a cigar. Everybody
Can
that
I get
works
to the
at
quote from Kit?
Everyone that
never
works
actually
at the
read it.
Lanesboro cigar bar supports Arsenal. Nick, everybody supports this.
I've not missed this.
Good, thank you.
At all. Kit talks about the market reaction to Fed minutes yesterday. To sell the longer end of the curve, to sell equities. He said 10s are getting closer to 4%, and big figuritis may demand that risk sentiment takes a hit when that level breaks. We're pretty close to it right now. The 10-year, 3.98. Andrew Holdenhorst of Citi coming up a little bit later this morning. We'll catch up with him at 8:15 Eastern Time. That's about an hour and 30 minutes from now. From New York, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We do see some storm clouds on the horizon. We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates. I wouldn't chase this rally too much. I would stick to your plan, stick to your asset allocation, rather than moving things around one way or the other.
You know that Spider-Man meme? You ever seen that before? Where it's two Spider-Man and they're doing that to each other. You ever seen that meme before? You must know that meme.
No.
Mark Zuckerberg posted that meme on Twitter. You know, you've never seen that meme?
No.
The two Spider-Men, they point at each other.
I haven't even seen the Spider-Man movies.
Okay. All right.
You know,
well, Threads, I have
see
to
the
say, you know, this is
Flash
it.
with
We can put it up on the screen. Take a look at this. You must know this meme.
No.
You don't know that? Come on.
No, I don't know that.
Anyway, basically, Threads looks a lot like Twitter. Wouldn't you agree? Based on my experience with that app overnight, feels the same.
On this? These two guys, they're really rich and all that. Would they just buy, like 7 medical educations in America? Pick the city.
Don't you think some of them are doing some of that anyway? I'm sure they are.
I don't know. I think it's all sort of just like, step up and really do something substantial for pick the city.
You're saying Threads isn't it?
No, it's fascinating. I mean, I'm really looking forward to this conversation we're having. How are you doing with Threads? Are you verified yet?
No, I'm not verified. In fact, I'm doing terribly.
Oscar Piastri is verified.
I had the Ferro TV handle on Instagram, but always kept it private and never developed a following.
And you have that on Threads?
So I have that on Threads.
Oh, wonderful.
So what have I got? I couldn't port any followers because I didn't have any. So I've got four on Threads. So this is going really well. This is going really well. Rockstar status.
Bramo and the tribe following you.
Over on Threads, nice. Thank you to those 4 followers. It means a lot. I will never forget you.
Let's talk about this build-out. This is going to be really, really interesting. We're really pausing this. John and I usually ignore this stuff, but this day seems different. Alex Webb is with us with Bloomberg Quick Take. He looks at this stuff 24/7. Is this day different, Alex Webb?
It does feel like they've really gained traction very quickly. Let's say the most recent numbers we know, in excess of 10 million users. I know because it puts in my profile, I was the 10,300,000 and something thousandth user. So there are a lot of people out there adapting it. That is faster than almost any app we've seen launched that I can recall. They talked about ChatGPT having a record launch, and that was 1 million users within a week. The challenge is that as a total percentage of Meta's user base, which is in the order of 2 billion, it's less than 1% of that. So is it going to be damaging to Twitter? Potentially. Does it really help Meta? At this stage, not yet. That doesn't mean there's a path to that happening.
Instagram is different than Twitter. Will Threads be different, or do they just copy what Mr. Dorsey and then Mr. Musk have done?
It pretty much looks like it's almost clone of Twitter. There are some differences. You don't at this stage have the ability to only have in your feed the accounts that you follow. It is feeding other stuff in there, much in the way that TikTok does and increasingly Instagram does. It doesn't yet have a desktop version. I suspect that might be kind of a big deal, given that so many of the sort of turbo users, the people who generate a disproportionate amount of the content, often do so from desktop platforms such as TweetDeck. That doesn't mean, though, that these functions won't come. There's a suspicion that Facebook or Meta accelerated the introduction of this to capitalize on some of the problems we've seen at Twitter, for instance, in the past week, capping the number of tweets you could see to restrict the load on servers.
Alex, as you know, Twitter over the years has had many CEOs over the last decade or so. It's never been a phenomenal business. I'm just wondering, Alex, what Meta can do with its version of Twitter that various people haven't been able to do with the actual platform.
Ads. Like Twitter has not had a really effective advertising machine. That is Meta's real core competency. They have a very well-oiled machine, close relationships with big brands. Brands see their platforms as a safer space to be than Twitter. Twitter, you've never really sacrificed that much of your personal data to it. You didn't have to and able to use it. So a lot of it was sort of contextual. They could sort of infer from the accounts that you followed what things you're interested in. Meta has far better data on you already, given that in order to have a Threads account, you've got to be porting it from an Instagram account. That means they can do better targeted advertising, even with some of the controls imposed by GDPR and similar legislation, CCPA in California, for instance. So they have, if they can pump their existing ads infrastructure into Threads, they have the potential for a lot more upside than you currently see at Twitter.
Alex, we're having this conversation here in the United States. You're having it in London, I believe. It's not a conversation that you can really have on the continent within the EU. Alex, what's happening with that, and why was that an important decision to make?
So there is a new set of legislation in Europe which essentially restricts the ability for companies to port data between different services. It's something that regulators in this part of the world really don't like. When you leverage strength, or I should say in that part of the world, they leverage strength in one business in order to generate strength in another. It's the sort of thing that Google and others have been fined considerable amounts for over the years. This is exactly what this business is, right? You're taking your Instagram user base and porting them over to this new app. Therefore, in order to obey the letter of the law, or at least see whether they could find a way to make it work, it seems that they are not offering at this stage Threads in the European Union in order to reduce any sort of legal vulnerability that might emerge from it.
You think that will change, Alex, eventually?
I suspect they'll find some sort of workaround. I mean, it seems ultimately at some stage Threads you should be able to sign up to it without an Instagram account. You can see why they haven't done that to begin with, partly because it means you have a pre-formed social network, a social graph where I open the app and I'm already engaging with people that I know from other platforms without a huge amount of legwork. That would seem to be the obvious fix to it. As we know, as we were saying, this has kind of been developed on an accelerated timeline. So, in the fullness of time, you can see that they will maybe do that.
Alex, without doing fancy differential equations or Ethernet functions or power functions, blah, 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 how do you get to critical mass? And where does Alex Webb think Threads where do you guess the timeline is to where they get to so-called critical mass?
Look, I think they need to be as big as Twitter, which is sort of 300 million users. That's when I think it starts to become meaningful for Meta. They have 2 billion users across their various apps. I think Instagram has about 1.5 billion. Those are incredibly valuable users because they're often in that super attractive 18 to 35 demographic. I don't know how long it's going to take them to get to that point. 10 million is a great number out the gate. I suspect they're not going to be adding 10 million a day for the next 30 days, right? That will be a huge ask. It took Twitter 15 years to get to that point. Nonetheless, it is an incredibly impressive start. And, the reaction in the share price, I think, is a good gauge for how people are seeing it. At the moment in the pre-market, I can see it's up like 1.5%. So, it's not gangbuster numbers on that basis, but positivity.
You do wonder how Twitter would be trading this morning if it was a public company after that that unveiling last night, I've got to finish with this one, Alex. Would you expect there to be a change in approach to the way this company's been managed, Twitter specifically and Elon Musk, given what we've seen develop in the last 24 hours?
I mean, look, that ultimately gets back to this question we long ask ourselves: what's Elon going to do? Goodness only knows. You, in any typical company, you would expect there to be a reaction, a retrenchment, perhaps a return to some of the fundamentals with Twitter. But Elon doesn't necessarily operate companies in the way that plenty of other people do. The new CEO seems basically her job is to forge stronger relationships with advertisers. Is she able then to say, look, advertisers want this, therefore we should do this? That's a big question, and there are probably only 2 or 3 people who know the answer, 2 of which are Elon Musk and Indy Iaccarino.
Alex Webb, thank you, sir. Bloomberg's very own on the latest development. Meta, Instagram, unveiling its Twitter app killer, potentially, Tom, overnight.
Fascinating. I remember when Pinterest came out, and everybody was all gaga in Pinterest.
Never used it. And still don't know what it's for.
Some manager came to me and said, sign up for Pinterest and tell us what you think. So I did it.
And what did you think?
It never got to critical mass with me, and critically with a lot of other people.
Did it get to it with anyone?
It was it was very good for wedding planning or divorce planning or that.
People plan their divorces on Pinterest.
But I'm a value to Pinterest, but is that critical mass like Twitter, like Facebook, the rest of the big ones?
Right.
And I'm absolutely, and you asked the right question. What will be Mr. Musk's response to what we are witnessing, say, in 48 hours?
It's been a haphazard approach to the platform. Yeah. He has treated it like a startup, at least from many people's perspective, over the last few months. Be interested to see, Tom, how seriously he takes this. And again, I do wonder where Twitter would be trading if it was a public company this morning. I imagine it would be down in the pre-market, based on what we've seen.
I don't know. Fascinating. Alex is very valuable. We should have him on more often.
We should. How often would you like him on?
When I get up to 100 followers on Threads. I'm not there yet.
That could be this morning. Mikey Settles, thank you. Add on Threads, 19th Threads follower, but #1 fan. Appreciate the love.
God, it's just,
to 19. This is big time stuff.
Large.
Big time. Emily Rowland, John Hancock, up next.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
The dip and rip hasn't happened. It's been more sort of rip.
You know, it's an interesting time because no one expected what happened in the first half.
What's important is what's really dragging up the market and how much more can that go.
You have this math problem where the giant stocks get bigger and they push the indices higher and don't drag the rest of the market with it.
I wouldn't chase this rally too much. I would stick to your plans.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Your equity market just a little bit softer this morning, negative 0.4%. Going into payrolls on Friday, into jobless claims later this morning. Some services data as well a little bit later. Bear in mind the weakness we saw in China. Let's see if that's captured by the index here in the United States too. Before we get into all of that, Tom, need to talk about the bond market that's in front of us right now. Your 2-year, 4.97, yields higher by 2 or 3 basis points this morning.
All sorts of bond indicators where we are on the watch, and this economic data could really shift as well. Michael McKee says look at the JOLTS data as one measure of the labor linkage into the spirit of the economy. I'm going to go to the 10-year real yield, 1.73%. That's a jump condition. We're buttressed right up against new highs. And the 10-year real yield, Liz Ann Saunders saying that it has a lot of value versus the nominal yield. It's the inflation-adjusted yield. But I'm sorry, you got to look at the level. And as we mentioned in the last hour, Kit Jukes is on the big figuritis watch.
Well, let's talk about levels in the UK. 540 on a UK 2-year, 540, and a real conversation. First thing I looked at when I woke up this morning, there's a real conversation in London at the moment about the prospect of going through 6 on bank rate at the Bank of England and maybe having a look at 650.
The entire arc of this, in fact, I was going through my photos. I'm trying to get verified on Threads, and I had to go back and get some proof of who I am. And the dog's the same thing, vet bill and kennel fee. And the basic idea, John, is I ran across our Jackson Hole photos from August, 10 months ago as well. This is a different Jackson Hole. This is going to be a different confab in England about how do you rationalize society, part of England flat on its back, and part of England, I think that it's like it doesn't exist. It's like good that rates are going up.
We've reflected on what happened in the Jackson Hole Symposium of 2022 at the end of August, where Chairman Powell talked about the need for pain, and if we didn't get that pain, it would be much more painful. You certainly don't see it at the aggregate level with unemployment expected to drop again tomorrow. They've been forecasted a break of 4, approaching 4.5% on unemployment by the end of the year, Tom, and right now we're closer to 3.5%. Than 4.5.
And I got Ed Hyman yesterday saying he's never seen economic data like this. He's never been as cautious as he is now. And it leads to almost a courage thing, as we mentioned with Liz Ann Saunders. Which walls of worry do you want to climb right now? The walls are developing fast.
These surprises have been positive, not negative. And you can take a look at the various surprise indexes, whether it's the US or the UK. So that's data coming in relative to expectations. And Tom, it's the most positive it's been here stateside since 2021. We've just had a series of upside surprises in the economic data. We often give a shout out to Neil Dutta of Renaissance Macro. Let's give him another one. He's been talking about the home builders now for the best part of the last 12 months. The home builders year to date are up by more than 40%. And Tom, never mind the recession debate, there is a conversation happening in parts of Wall Street about the prospect of things not only being better than expected, but maybe even improving in certain parts of this economy too.
The core Neil Dutta theme, folks, and this is really important. If you look at a labor economics textbook, you think you're going to get an A, and then about chapter 2, you realize you'll be lucky to get a quality C. One of the things Dutta's optimism comes from is you have wage growth and inflation comes down, so your inflation-adjusted wage improves. And Neil's very, very big on that being an understated idea. going from 2% economic growth in Q1 to wherever we are right now.
Real income's getting better. Futures right now on the S&P, a negative 0.4%, just a touch softer there, going into data in about an hour and 25 minutes from now. Then on to payrolls tomorrow. If you're interested in the median estimate in our survey here at Bloomberg, those numbers still coming through. 225 is the estimate at the moment for tomorrow morning, relative to the number we had in the previous month, Tom, of 339. You'll get a appetizer. We call it the appetizer for payrolls a little bit later, the ADP report. That's expected also to come in at 225. That's the estimate at the moment. The previous number, of course, 278.
Those are important numbers, but average hourly earnings, I'm going to look at it, and McKeith says to focus on JOLTS as well. I'm just going to focus on the wall of Bloomberg data we have. It's a huge advantage Bloomberg has here. John, you mentioned UK rates. Can we talk about German 2-year? I think Germany's like flat on its back is a fancy way of putting it.
Recession.
From 0% negative interest rates January of last year. They pop up, they get to March, and now they're right up, ready to break through the new March highs. And that's in Germany, flat on their back.
Let's get to Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management. Emily, wonderful to hear from you, as always. Tom and I were just talking about it. You've got some people on Wall Street forecasting recession, other people saying things are set to improve. Where are you and the team?
Yeah, this is a very, very tricky late cycle environment where things often look pretty great right before they're not. And you had the great Ed Hyman on yesterday, talking about this, how this late cycle environment's lasting a long time. And we would define that as a period in between when the leading economic indicators go negative and through the recession. And that typically only lasts about 6 months, but we're on month 10, 11. And in the 06-07 example, we went to 18 months there. So these are periods where you're seeing a lot of chop in the economic data, a lot of chop in yields. You want to participate in the market because risk assets can see these big swings higher. But you guys were talking about I think it was the European Grand Prix earlier on the show, and it got me thinking about how you want to participate in this market. And it's sort of like drafting in car racing. You don't necessarily want to be out front here, taking on too much risk. You want to participate by owning things like higher quality assets and leading into bonds.
I mean, I look, Emily, at where we are in the zeitgeist, just buy quality, buy persistent free cash flow. I get all that. I just want to know, do I want to be in the market or not, given the way my head's spinning with the data? Are you participating in equities?
Yeah, you definitely want to be there right now. As I said before, you can see these massive swings higher in risk assets. As you almost see investors celebrating, as John mentioned earlier, this idea that the economic data have come in a lot better than expected in many cases. So you also want to think about this kind of almost pivot party that's going on right now as investors celebrate the idea that the Fed is getting to the end of its tightening cycle. We've only got one more rate hike priced in, then a hold, then cuts in 2024. So the pivot party can be a pretty powerful one. You want to go to it, but you might want to think about, sipping on a light beer instead of reaching for the tequila, because you might have, sort of fewer regrets the next day.
That's CFA level 4, John, there.
Have you ever reached for the light beer instead of the tequila?
Light beer. John, I was weaned on Coors. You and young Roland don't know what Coors 3-2 beer is. The only one that knows that we talked to is David Malpass.
Talk to me about Coors 3-2 beer.
David Malpass had a keg of Coors 3-2 beer in his room at Colorado College years ago. It was some moralistic Midwest evangelical thing. I don't know. Where this is all before light beer. And so you were too young. You were getting shot in Vietnam, but you were too young to have a Bud. So you had a Coors 3-2 beer, which is, think of it like a Coors Light.
Right.
Put a glass of water in it. And that's
even worse than a Coors Light.
Oh yeah. Malpass had a keg of Coors 3-2 beer in his room at Colorado. That's how he got through physics.
How do you think Bud sales did over the July 4th holiday?
Actually, it's a really reportable issue. It's maybe not what we do early morning, but I think in terms of marketing and advertising, the debacle at Bud Light really needs to be studied by every institution.
Look what you started, Emily. Let's move on from that. Talk to me about stocks that you do like, sectors you do like right now, and sectors you want to avoid.
Yeah, so we continue to lean into quality. That's companies with great balance sheets, lots of cash, a limited need to tap the capital markets in order to grow. That does lead us to the technology sector. It leads us to the U.S., which of course has an abundance of technology stocks compared to the rest of the world. So, we do recognize that tech, of course, has run a lot. We've started to see that market leadership broaden. We're worried about valuation risk as well. So we want to look to parts of the market that can help protect portfolios from that. Mid-cap stocks in the U.S., mid-cap value in particular, one of the only areas that's trading at a discount, not only to its own large cap peers, but also to its own history. That's another area that we're looking at in portfolios to diversify. And again, leaning into bonds, you're getting 5%. On high quality bonds right now, investment grade corporate bonds up in the credit spectrum. That's another place we think that there's a great mix between risk and return.
If I remember correctly, Emily, and correct me if I'm wrong, you didn't jump on the international bandwagon in the way others did at the start of the year. Emily, why was that?
Well, I think that there's an idea out there that there's going to be this immaculate economic cycle where, somehow potentially the U.S. goes into a recession, but the rest of the world avoids one. And that's just never been the case. And we continue to believe that we're going to see a global economic recession. You just look at the PMIs on the manufacturing side. Germany's at 42, and meanwhile, you're seeing European equities at all-time highs. To us, the macroeconomic backdrop just simply doesn't match with a cross-asset performance. And also when you think about owning European equities, it's very cyclical, high beta. They tend to do better early in an economic cycle. And right now we think we're in a late cycle environment. So we think that you want to wait. We do have some of it in portfolios. We're overweight Europe versus emerging market equities, but we think that the better time for Europe is going to be in the future.
Emily, wonderful to hear from you, as always. Emily Rowland of John Hancock Investment Management on booze, sport, and a bit of markets.
She covered it all there. F1
Does it get
chat?
better than that? Bit of F1 chat too.
Yeah, I had no clue, but
it told us coming into the segment in the commercial break, very excited about Wimbledon.
I don't know. She was talking about draft in the F1, and I thought it was Amstel Light. The answer is like NASCAR. There's big draft because they're big cars, but the F1 cars are so low they don't have the same. Like when Sainz of Ferrari gets behind Leclerc,
you get the slipstream.
He gets a little bit of he gets a little bit of a tenths of a second toe.
And then you pop out, and then you get that.
Toe.
You press that DRS button,
and the
drag
guy,
reduction system, and
very seriously,
feels like a cheat mode.
Here.
I don't like it. I'm not a big fan.
And yeah, the DRS thing.
Yeah,
get rid of it. I'm the same way. But to your conversation with Christian Horner, I think it's been way underplayed. This guy Verstappen is like Ohtani with the Los Angeles Angels.
What Max did over
it's
the weekend.
Unreal.
What Max did over the weekend to come in on the last lap. Just before the last lap and make a pit stop just to put fresh tyres on and get the quickest lap to get a single point.
And we're not going to commercial. This is too important. And what's important here is Sky TV, with their great coverage, love what they do. They ignore him because he's so far out front. No one in American sports would do that. But Sky TV just ignores him.
Yeah, but that's the F1 director. I'm not a big fan of that. That's come off the back of the Netflix series that they start to look at these races at the back of the grid.
Oh, is that from Netflix?
Yeah,
I don't know that.
I'm not interested in that. Yeah. If you are just tuning in, welcome to the program from New York City this morning. Good
F1
morning.
today.
Equities this morning down about 0.4%. Coming up in about 48 minutes from now, actually, at about 8 a.m. Eastern time, we'll catch up with Dom Constant of Mizuho Americas. TK, I know you get excited about catching up with Dom. We'll do that a little bit later this morning.
This guy is fabulous. He owned the high ground at Credit Suisse years ago. Ira Jersey and others just put out a definitive linkage of the economic system into what fixed income said. I'm fascinated with what his update is here, because so much of where we are now is where he said we were, and he invented his phrase super restrictive. Are we super restrictive now?
Never mind super restrictive. Are we sufficiently restrictive? Tom, how about this one? If I told you at the start of the year precisely where interest rates would be in July of this year, on a 2-year at 4.97, if I told you with precision where that would that help you make your equity call?
No, because as Emily Rowland just brilliantly said, Germany's flat on its back, and German equities,
there you go. There you go.
Yeah, I don't.
It's always the tough one. You can make the macro call, you can make the rates call, and then even if you have all of that information precisely in hand, sometimes you still get the equity call wrong.
You got to buy companies, but in this environment, what's on the screen, my choice set is so small. There's so few companies that get it going.
Janet Yellen, the Treasury Secretary,
nailed that.
Touching down in Beijing. It's been a while, TK. Let me warm up. Just give me a couple of days. Be nice.
Okay.
We're meant to be friends.
Okay.
Jeanette Lowe of Strategas on Yellen's trip to China. Up next.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policies.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
Just establishing those lines of communication, it's not sexy, but I think in this case, it really is important. We've got a new economic team in China. We've got a relationship that's badly frayed, and we've got the two largest economies in the world, and a Chinese economy that's, I think, coming under some significant pressure. This is both a trip that's not going to produce much directly, but is quite important.
Valuable conversation this morning with Michael Herson there, the head of China research at 22V Research, as Janet Yellen, the Treasury Secretary, touches down in Beijing to meet with her counterparts in the Chinese government. The second high-profile trip that a cabinet member has made, Tom, in the last couple of months. Secretary Blinken, of course, first, and then Secretary Yellen follows.
The zeitgeist here is nothing's going to get done. You make an appearance, you go through the motions, and that's a good and beautiful thing always. I would just go to renminbi, 7.23 yuan per dollar. John, this is a devaluation of the Chinese currency. You can rationalize it however you want, but I would watch that, and as she comes back to the United States, if China struggles and you see yuan break down further, I don't think it's the same as it was 6 months ago. It's a big deal.
Well, let's be clear here. We used to talk about deliberate manipulation of the currency, Tom, to weaken it. And that word devaluation is quite loaded. Is this a depreciation off the back of weak data in the mainland? Or is it something else?
No, it's a nuance here between the word devaluation and depreciation. You're absolutely dead on, and that maybe it's not as fixed in devaluing as it was before, but nevertheless, it could be a depreciation off of a struggling economy. To be clear, while you were gone, Leland Miller he was absolutely clear. Leland said, this is baloney. China's doing better than we think.
How many digs is that this morning about not being here?
I don't know. You know, where's
It's
Bremo?
7:18 Eastern time. We're about an hour and 20 minutes into this. How many is that?
I can't count. You know, it's
Take a vacation.
You've got more followers of Threads than I do.
How many have you got?
I don't.
Have a check. See what you got.
It's like you know.
It's pathetic. See what we got.
Yes, it is.
This is pathetic.
That's what our head of social says.
28.
It's pathetic.
What have
They're
you
like,
got?
Tom, can we help you? You know, can we help you over a cup of coffee with Threads? I don't even know how to get to my 25.
Oh, nice. I'm beating you. All right, let's
excuse
stop
me.
the game.
75.
No, for goodness sake.
Large.
We're not playing anymore. All right. The market looks like this. Futures negative 0.4% on the S&P. In the bond market, you know deep down I'm unhappy about that. In the bond market, yields higher by a couple of basis points.
Sam Rowe put me over the top.
Sam Rowe didn't follow me. Let's sort that out. 2-year, 497 on a 10-year right now, Tom. 397, getting closer to those round figures of 5% and 4% respectively on the curve. 2-year versus 10-year, let's call it negative 100 basis points right now.
Yeah, it's a holiday shortened work week, but guess what? The next 2 days really matter here, an hour and 15 minutes away from a slew of economic data. And then there's policy in Washington as well. Jeanette Lowe briefs now, Managing Director, Policy Research for Jason Trennert at Strategas. It is a Baird company. Jeanette, thank you so much for joining us. I want to move forward. Secretary Yellen comes home. The zeitgeist is clearly not much is going to be done. Then what? In August, in September, in January of next year, how do we amend our relationship with Beijing?
It's a great question, and thank you for having me. So I think that Yellen is going to China to try to reset relationships, which I think is that's everyone's understanding. She's trying to kind of tone down the rhetoric that we have seen over the past couple of months. We've had some issues with planes coming close to each other, ships coming close to each other in the South China Sea. She's really trying to tone down the rhetoric, make this less about decoupling and more about de-risking between the U.S. and China. And so part of that is to kind of keep the negotiation points open. There is new teams in China, so she is trying to build up new relationships there and just start to have more conversations as we don't even have military to military conversations currently. But I think going forward, the biggest thing is that this trajectory is not going to change. So the U.S. and China are on a trajectory to have the U.S. continue to de-risk in key sectors, and we're going to continue to push our allies to do so the same. I mean, next week you're going to have the House come back from recess. They're going to be debating the National Defense Authorization Act, and they already have some amendments that they're going to be talking about putting on outbound investment controls from U.S. investment into China.
I mean, Jeanette, while you're talking here and on Bloomberg Radio, we're showing videos of everybody smiling, grinning. Let me take the side of the conservatives and, frankly, some Democrats as well, the liberals and conservatives in Congress. I'm going to pick on Marco Rubio of Florida as someone who doesn't trust this. The Chinese are doing the smile, meet and greet thing. What do they want from us?
So they definitely would like us to stop the tech restrictions that we continue to put into place on semiconductors, because that is definitely putting a bit of a hamper on their development of these key technologies that they believe is important for them to have a greater dominance within the world. So that is something that they are going to be looking. I think the fact that they announced having, 2 critical minerals, having some export controls on those on Monday, that is kind of, people are calling it a bargaining chip, and it is kind of a way for them to say, we have ways to retaliate as well against you if you're going to do these things to us. So it may be a way for them to try to get some concessions, but I don't really see much concessions coming down the road. The U.S. is definitely continuing to move down this path. Yes, we might be watering down things as we go, but we continue to add pieces every couple of months. Obviously, we started this last October with export controls. We're going to continue to do so. The president is still expected to put out an outbound investment, kind of a reverse CFIUS process to review U.S. investments into China, potentially this month, potentially at some point this year. You also have the talk about U.S. trying to now block Chinese companies from using U.S. cloud services so they don't get around the semiconductor issue. So that's another thing that is still on the table. So I think we're just going to continue to add pieces, but at the same time, the U.S. and China do need to talk.
Jeanette, we're hiding behind a phrase National security. Jeanette, Tom and I were talking about this earlier this morning. What isn't a national security issue right now with regards to the relationship between these two nations?
It's a great point, because I think that now the U.S. is starting to take a much bigger view of this. You know, we're looking at things like farmland now much more closely than we would just about, you know, what is in our missiles and what do we need for certain ammunition or things like that. So the definition is definitely getting broader. It was also interesting that China also used the national security line when they announced those export controls on Monday. So now everyone's going to be able to use this as their argument going forward. Definitely makes things a lot more difficult. We are definitely moving into a new environment, which is much more about deglobalization than globalization. And so it's going to be a lot more difficult to kind of parse, you know, the free trade that we've normally been seeing amongst countries if this is the new dynamic that we see.
Do you see Europe still sitting on the fence?
You know, I think we've definitely seen Europe move more and more towards the U.S. direction. You know, I think the fact that the U.S. did get Japan and the Netherlands to agree to do these export controls on semiconductor equipment was quite important. And I think that you are seeing Europe, while it wants to move a little bit more cautiously, it is definitely more in the camp of seeing the risk with China, similar to what they saw with Russia and the war in Ukraine and having too much reliance on Russia. I think that is becoming more and more clear. It's just how do they go about doing it, especially when they have so many members that they have to kind of, you know, deal with consensus there.
Important trip for Secretary Yellen. Jeanette, we've got to leave it there. Thank you. Jeanette Lowe there of Stratega. Secretary Yellen, Janet Yellen, touching down in Beijing just several hours ago, Tom, to kick off a series of meetings with their counterparts.
It's going to be serious. And, you know, I'm wondering if she's opening up her Threads account while she's in Beijing. But, you know, I'm sorry, it's serious. And to take the side of the China critics, what is this diplomacy signal? I mean, you know, shake hands, smile, smile. And I guess, you know, Henry Paulson would tell me, well, you're just doing it. You're showing face and you're there. But what's actually going to get accomplished? I'm trying to follow people on Threads. I'm trying to follow Anne-Marie Horder.
You're very distracted. How's that working out?
It's like really clumsy. You know, I mean,
AMH is a big hit on Instagram, so she can port loads of followers over to Threads.
Are you on Instagram?
Not really.
Yeah.
I have the handle, but I've never posted a thing on there.
Yeah, either have I. And I had to sign up today to do it. It's like stressful.
You know, I struggle with this, Tom. I'm conflicted. I've never been a Zuck fan. Fan of Meta.
I agree.
Things Meta. It just feels a little bit, you know.
Totally agree.
Anyway.
We're both like squirming. Where's Brahma?
Just a bit.
She's a monster.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
You going to do any work this morning?
No, I'm doing the same.
Fancy it.
You know, I'm trying to figure out a trade here with Mark McCormick. We'll get to that in a moment. Other than I'm doing threats. You know?
Nice. All right. You've worked that out. Futures right now. Welcome to the program.
He's in charge.
Just a little softer on the equity side of things. We're negative 0.4% on the NASDAQ. We're down by 0.4% as well. Small caps underperformance over the last 24 hours. Underperformance again this morning. We're down by 0.6% on the equity side of things.
I'm looking, John, here at the economic data. I think we've undersold it. I've been guilty of this. An hour from now, we begin 48 hours, actually 25 hours, of absolute crushed insanity before the Fed meeting in July. McKee says follow JOLTS, but, you know, there's a whole bunch of things to follow here.
So let's go through it. 45 minutes from now, the ADP report, the appetizer for the big one tomorrow morning, payrolls. The expectation, the estimate in our survey, 225,000, the previous number 278.
Terrible, recession level.
After the ADP report, you'll get jobless claims 1 hour from now. Jobless claims, looking for a tick higher there, 245 up from 239 in the previous read. Then you get job openings, looking for that potentially to break 10 million. We'll see. And then an important one a little bit later as well, at the same time that you get JOLTS. ISM services, so a read on the services sector in the United States of America. We know what manufacturing's doing. Not great things. Let's see, Tom, if that corresponds with the services read a little bit later this morning.
I have to see, that's the economic data, and as well as that, we've got a lot else going in. John, let's tilt to foreign exchange right now and do a review. DXY just fractionally under a 103, maybe somewhat of a give back. The Bloomberg Dollar Index, which is much more EM at 1231. Fractional, I know the Bloomberg Financial Conditions Index is more accommodative. That's not what Powell wants. Maybe the market's out front of that as well.
You mentioned the FX market, the euro right now, just short of 109. High of the session, 108.96. Right now, 108.94. We're positive on that currency pair by let's call it 0.4% on the euro against the dollar. As investors weigh the Fed's options at the July meeting, Mark McCormick of TD Securities calls for another pause, writing this. For US, disinflation is the main driver and sending the strongest directional second half cue for the dollar. Our outer consensus call that US disinflation is strong enough for the Fed to skip July, effectively ending the cycle, would reinforce lower macro volatility, Tom, late cycle growth dynamics, and boost carry.
Right now, a clinic. We are thrilled to have Mark McCormick with us, Global Head of FX and EM Strategy at TD Securities. And Mark, you know, I got like 8 ways to go here, but the only way to go is for you to define what carry is for mere mortals. George Saravelis, your good competitor at Deutsche Bank, his entire essay this morning was on carry, and particularly Asian carry. Right. That's Greek to our audience. Okay. Define a carry trade right now.
So carry trade is the way of looking at the dispersion, the gap between interest rate differentials between higher yielding currencies, which are particularly in emerging markets, Latin America, Eastern Europe, versus low yielding currencies, which are basically in Asia and parts of Europe. So what you're doing is you're funding out of the lower yielding currencies into the higher yielding currencies, but the most important component of the carry trade is volatility. So what we do is we look at interest rate differentials and we adjust them based on volatility. And then essentially our carry model looks for the appropriate basket to trade that based on the dynamics of interest rate differentials and volatility.
It's a field day now in carry. What does it signal that there's such an imbalance in global FX?
Well, the big thing is the hiking cycle started in emerging markets. They needed to basically get the credibility. They were ahead of the curve. It's kind of the first one in, first one out concept here when you think about EM, because everyone feels very confident that LATAM and other central banks are going to cut in the second half of the year. Whether or not you see that in the G10, that's very different. But I think the main thing here is that in these parts of the world, we're seeing the greatest dispersion in interest rate differentials. We're actually seeing very good growth developments. And the places where you're funding are also parts of the world where there's disinflation. If you look at where people are easing policy, it's in China, it's in Asia. So what you're doing, a lot of people we're seeing in FX market is you're funding out of a currency like China and you're buying a currency like India or Brazil or Mexico, higher quality EM currencies. Were also, particularly with India, is a place where equities have done quite well in the second quarter.
So at the epicenter of this call is a call on the Federal Reserve. We read out that quote there about Fed policy. Can you tell me, is that an expectation of what you think will happen or what you think should happen?
So what we thought should happen was they should have hiked in June. So what we think is if there's a data dependence narrative that the data was strong enough and it was robust enough for them to have hiked in June, which I think is part of the context of the minutes, which is there was an active discussion about the lags and the impacts of policy, and there was enough there to say that, yeah, we could have went. Our view is that our inflation forecast is strong enough on the downside in disinflationary terms that they don't need to hike again. I understand it's out of consensus and after the minutes that it seems increasingly unlikely and that they will go in July, but we still have payrolls and we also have another inflation report. So I think the one thing that we're pushing for is that our inflation forecasts underscore the fact that disinflation is happening. Even from a global perspective, we're seeing it globally in all these countries that we track that disinflation is moving. It's just not moving as fast as policymakers would like, but we also see the U.S. economy slowing more significantly more than others in the second half of the year, which means that they don't need to keep moving forward.
Okay, two calls there, one on inflation and one on growth. Let's deal with inflation first, and let's deal with the data in front of us. Set the bar for us. Payrolls on Friday, tomorrow, 225 is the estimate. CPI next week. Core CPI, the estimate right now, month on month, 0.3. Yep. Where does that data need to be for your call to deliver?
Right. So I think on non-farm payrolls, this is the one thing that's interesting. We're not opposed to stronger growth because when you have stronger growth and you have disinflation, that's what helps the soft landing narrative. So I think that's quite important. So we are slightly above consensus on growth tomorrow. We're looking for, I think, 250, 260 in terms of NFP, but we're looking for a 0.2 month-over-month print on inflation. And that's the most important part.
Core CPI or headline?
Core.
Okay.
So that's what allows us to move essentially into disinflation category. Because the one thing I think that people are missing is that inflation surprises globally, particularly in the U.S., not in non-U.S. G10. But if you look at emerging markets, U.S., Asia, inflation is surprising on the downside relative to expectations. And when you look at consensus of revisions on inflation, all those numbers, we aggregate them. Yeah. I think this is one of the values you do in FX because you're looking at the world as a whole rather than being a country-level economist. If you look at inflation expectations over time relative to consensus, we've seen about 60% of the countries we track with disinflationary forces over the last 3 months. So what's good is if we get good growth numbers, the Fed doesn't have to be worried about that if disinflation is and inflation numbers are coming in softer than expected, which is what we're anticipating.
Okay, somebody out on Threads just emailed into me and they said, can you talk to Mark McCormick about peso? Okay, I'm looking at Mexico. Forget about Trump, Clinton, and all that. I took it back to 1995. I did a log extrapolation, a regression analysis of the weakness in Mexican peso forever, forever, forever. We've now advanced strong Mexican peso, almost 3 standard deviations, like we've never seen since 1995. How does that change life in Mexico? How does that change life for America?
Well, the big part of it is the Mexican economy is linked specifically to the U.S. economy. So one of my favorite indicators when you track Mexico is ISM leading order, ISM new orders component. It's actually good at capturing the manufacturing base that Mexico has coming into the U.S. I don't think the strength of the currency is a detriment because what Mexico's doing, it's stuff that Canada did 20 years ago. It's kind of an intermediary of pulling things together and then basically shipping things back off into the U.S. So the currency doesn't have a dramatic impact where if you get a stronger currency, you're not going to get this negative impact to growth. We've seen over even the last 10, 15 years, those models of international trade, where if you get a stronger currency and then essentially you see slowdown in the economy, they just haven't worked. And again, there's usually 2 to 3 years worth of lags in those models, but what we see and how we tested them, they're not working. So I think the most important thing that's happening in Mexico is it's been linked to the relative strength of the U.S. economy, but it's also the best performing carry currency that you have across the world. So Brazil, Peru, Mexico are 3 of the highest yielding low vol currencies.
So do you go against that belief, and do you go weak peso looking for 17 or 18, 19?
No, I don't believe in the weak peso story, because I think fundamentally the flows are changing. I heard John, your prior guest talking about the geopolitics between U.S. and China.
Sure.
The retweaking of global supply chains is very bullish for the Mexican peso.
Well, just help me understand one thing. Reconcile this. You mentioned the new orders component of the ISM manufacturing. It's been sub 50 since the end of last summer. Why the call for the Mexican peso then?
Well, the thing is, U.S. data strength. So a couple of things you can track. You can look at data surprises, data strength, PMIs, ISM, consensus expectations. If you look at the strength of U.S. data, it's on the 100th percentile of the rolling last 6 months. So U.S. data is coming in strong. U.S. data surprises are in like the 50th percentile. So it's kind of coming in better than expected.
High since 21.
Right. And so the strength of U.S. data is still insulating the Mexican economy. So no one's looking for Benico to cut until the second half of the year. And again, that kind of falls in what our expectations that Fed will cut in December. So the thing is, the resilient U.S. economy from a data perspective has helped the Mexican economy be generally resilient. At the exact same time, we've pushed back expectations that Benico will cut. And even if they do cut, you're still looking at double-digit interest rates, where again, what you need what you need to break this carry trade apart is the global recession, which we're not calling for in the next 6 months.
What is the call on Chinese growth?
So Chinese growth, to me, is we're still sub 6%. We're probably 5.5 to 5.8 now. I think the big thing with the China growth story is that it's peak pessimism. If you think about how this was linked to the dollar, I know there was a lot of focus on the U.S. strength of the economy and the Fed in May. The bigger driver of the dollar that I see in our models is the complete capitulation of China data surprises, which went from 3 standard deviations to negative in about 4 weeks. So I think part of it is the market's gotten so pessimistic on China, it's gotten so pessimistic on Europe. Our models show that relative to what we're expecting, there's value in some of the Asian currencies. So what we like doing here is easing of financial conditions. The rate differential story is not great for the renminbi, but it's good for the Thai baht. It's good for Korea. The idiosyncratic story in India is good. So Asia in itself is a relative value play on I would say not a weaker, but a relatively less strong renminbi.
I've got 45 seconds left. You threw Europe in that bucket as well. Where does that leave the euro?
Euro it's become somewhat boring in this context. It's in a 107 to 110 range, and there's a push and pull. So the growth story has gotten really weak, but at the exact same time, what you still have is in terms of trade is still a general boost. You still have some decent momentum, and at the exact same time, what we see in like natural language processing models that look at what central banks are saying, ECB is more hawkish than the Fed. So we're expecting more from the ECB. We're expecting less from the Fed. So the rate differential story is also actually supportive of euro just kind of being 107 to 110. And our call for the U.S. to slide into a recession and poor European and Chinese data to reverse and good U.S. data to move the opposite direction reinforces that euro should break 110.
You're using those models in-house, those language models in-house?
We're all playing with them, yep.
Very cool. Interesting. Mark McCormick at TD Securities. Mark, thank you. Thank you for that. From New York City this morning, welcome to the program. If you are just tuning in, equities right now on the S&P 500, negative about 0.5%. Coming up in about 30 minutes, we'll continue this conversation with Andrew Hollenhorst of Citi. And coming up shortly, Dan Ives of Wedbush. TK, this will be cool. On the latest with your new addiction, Threads.
Yeah, I could care less about Meta. I just never got it. I still call it Facebook, but it's a perfect time to talk to Ives, get off the Apple bandwagon. We always end up talking about Apple with Dan Ives, how they're going to do here in the earnings report. But yeah, today's a Meta day with Dan Ives, no question.
Elon Musk too. Wear the sleeves, Twitter,
I thought
and
Alex
ultimately
Rose
leadership at Tesla too. Dan's going to have tons to say about that.
Yeah, well, how's he respond? I don't get it. The underlying mathematics to me is fascinating. Where do you get a critical mass? Where do you get an emotional mass that tips it? My guess is we're farther out than I think, but I don't know.
Twitter feels messy. Tesla's having a great year. Do you see deliveries in China? pretty decent.
I've never gotten it.
Stock's
from
doing
day
really
one.
well year to date.
I missed it, and I've never gotten it, and I still don't get it. I still don't. You know, and you know, frankly, while you're going, Bramo was really good about this. All these Rivians
I've got
and
to tell you this. While
the
you were
Rivians.
gone, how many times have we heard that phrase "while you were gone" this morning?
I don't know. It's like, you know, it's like a Kelly Clarkson thing. Since you've been gone.
Did you miss me? Is that what this was? Why can't you just admit it?
I can't even, you know, I can't sleep at night. You know, vet bills. I'm in therapy on it. You know, it's expensive.
You couldn't sleep at night.
I'm vulnerable. Come on.
I know. It's a sensitive issue. It's okay. I'm back. You're going to be okay.
Okay.
I'll hold your hand. We'll walk out of work together a little bit later.
Since you've been gone.
Is that your singing, Kelly Clarkson?
Yeah, great song.
That's a good song.
It's a great song.
We should play music on this show.
Don't get me going.
We did that when we did this on radio, and it was just on radio and wasn't on TV.
We programmed it, and I programmed it, and John insisted we play Clash.
No, I wanted to play Oasis, and you got it banned.
No way.
He actually got it banned.
No way.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Since the bull market has mostly been in the technology stocks, the question is, do you see a pickup in other sectors that either catches up to technology, or do the technology stocks keep running and people keep chasing those? I think the problem with technology is that once those headline names that are so big in the indices start running, it's very difficult for the rest of the stocks in the indices because they get bigger and bigger. So you have this math problem where the giant stocks get bigger and they push the indices higher and don't drag the rest of the market with it.
Big tech just keeps getting bigger. That's been a story of the year so far. Meta up by more than 100%. You look at gains elsewhere, take your pick. Nvidia, Tesla, Microsoft, Apple, up double digits across the board. The S&P 500 up by more than 10%, something like 16% higher so far year to date. The Nasdaq up something like 40. This morning, futures negative by 0.5% on the S&P. Yields a little bit higher by 3 basis points, 396.34 on a 10-year. The conversation outside of the cross-asset analysis and financial markets very much on the spat between Elon Musk and Mark Zuckerberg, and it gets real overnight with the unveiling of what they're calling threads over at Instagram, a direct challenge to Twitter, Tom.
For John and me, this is a non-event, but unfortunately, it's so important. I think, John, we got to get right to it.
I would do that right now, sure.
Is an important voice on this. Dan Ives has earned the credibility. I'm going to say 8 months ago, he was the dumbest guy in the block. How dare you think we're going up? And we have had a Dan Ives market from the third week of October 2022. I got to get the threads, but what did you see in October of 22 the rest of us did not see?
I think it was fundamentals that were going to be a lot more stable than I think a lot of the skeptics thought. What we were seeing specifically in cloud, in enterprise, and even when it comes to consumer, with names like Apple, we just felt like the bark was worse than the bite. And then starting in the fall, that's when we started to do our AI research. And in my opinion, it was going to be the biggest transformational trend that we've seen in tech. And I think as that's played out, that combo is sort of where we are today.
I got 8 other questions, but we've got this idiocy this morning. Threads, can it get critical mass?
I think it's going to be very difficult to get critical mass. I think right now the name of the game for Zuckerberg and Meta is just further expand the Instagram base in terms of the cross-sell opportunity, eventually advertising. They're trying to strike while the iron's hot, given some of the issues we've seen with Twitter and Musk. But getting to scale is going to be difficult, but Musk has left open an opportunity here. We saw what happened this weekend. There's a lot of frustration building, and I believe this is just the drum roll to what's going to probably be the cage match this fall.
Looking forward to that cage match too. Let's dig into that. Define critical mass. What is that? What's the number?
Well, I think you really have to start to get to something I'll call 30, 40 million users. When you start thinking about where we
That's
really
what you've got. That's what Bramo has.
They're going to have that by the end of the week,
But 30, 40 million users, you need engage. It's not just about the users. That's the one thing you'll see. Sign-ups in the first 7 hours, 10 million, 20 million.
Sure.
It's about you get to 40, 50 million, then scale to 100 million plus in the next, call it 6 to 9 months. But engagement on the platform is key. That ultimately.
Doubts about that, Dan, but I wonder why, because Instagram already has this preloaded base. They can port directly. I did the sign-up yesterday. There's no friction there at all. It's really, really easy to execute. Why do you have doubts?
It's really because if you look at anything that's tried to challenge Twitter in terms of any of the other platforms, it's been very difficult to scale. Now here, for Zuckerberg, you got 1 billion plus users you could tap into. They've had limited success, I think, scaling other standalone apps. And I think right now, the question is, how much resources are they going to put into this? And is this just sort of a moonshot type project or something that they really want to scale? And look, I think for Zuckerberg, they went from a position of massive weakness, going back to, when you talk about 8, 9 months ago, to now it's a flex the muscles moment for Zuckerberg.
Sure.
Especially going toward Musk.
You're not on here yet.
I'm not.
What are you waiting? Come on, you're Dan Ives.
I'm waiting till
waiting.
I was waiting for you, but
he's made his move.
So now that Farrow and Keane are on, I'll go on.
Mark Zuckerberg says this: I think there should be a public conversations app with 1 billion plus people on it. Twitter has had the opportunity to do this, but hasn't nailed it. A lot of people have had the opportunity at Twitter to do this, and they failed. What did they get wrong? And we're still trying to work this out. And why is Mark Zuckerberg the man that might be able to do it?
Yeah, I think it's monetization. I mean, if you look what Zuckerberg's been able to do, obviously with the Meta platform, monetizing has obviously been key. Ultimately, that's been the issue for Twitter. That's been the uphill battle. They're trying to get it from verification, subscription, every which way. And I think that's been the big challenge for them, especially in this essentially arms race that's going on in the space.
Define Liz Ann Saunders was just on. We all agree it's been a multiple expansion. How does a growthy guy like you, an Apple fanboy, how do you adapt to the multiple expansion of the various and sundry wonder stocks of the last year?
Yeah, I mean, I view it, especially when I look at a name like Apple, where you're going into a mini super cycle with iPhone 15. I think multiple expansions are really about the increased opportunity to monetize an install base. It's all install base based.
So it's this ecosystem baloney.
But that's why what's happening in Redmond, what's happening in Cupertino, I think it's really been what's on the other side of the mountain. And I think that's really the key.
Are we just running our terminal value out if the CFA says 5 years, 7 years? Are we all buying Apple because we think it's a 9-year terminal value buy?
That's exactly my view.
I did okay on that?
But look, you're the professor and the tactician, the master. Okay. And I think here, when you look at Cupertino,
Dan can come back.
But that's why we believe $3 trillion. This train just doesn't stop.
The biggest problem, you don't see this on radio, but he dresses conservative for us because
he's very
you
conservative
and I are
today.
So conservative.
This is highly conservative.
He's got it's a clashing, the shoes are outrageous. He goes on Wapner, and he's dressed like, it's party time Friday afternoon, 4 p.m.
They dress down over there at the stock exchange?
No, they don't dress down. They just dress, it's like a cultural thing. He might as well wear a tuxedo when he comes on this.
When I'm with such debonair, like the way, like someone like Keane, I need to dress a little down, and then later I'm just going to go on Threads.
Apple, buy Target. give me some update here. We're coming into earnings season. They going to do it again?
220 base, 250 bull case. I think this now starts the road to $4 trillion, in my opinion. I think it's going to be another trophy case, not just quarter, but in terms of what we're seeing going into iPhone 15 into September for Cook and Cupertino, which is why I believe this is really just the start of this next cycle.
This is a secret on Ives. He actually knows the data. How many people like John Tucker and Bloomberg Radio have an iPhone that's 400 years old where they're going to bite for the new toy?
It's John Tucker and 250 million other individuals that have not upgraded their iPhone in 4+ years. That's the key, and that's ultimately why right now Apple continues to sort of own it and everyone else is paying rent.
I'm holding off the upgrade at the moment. I just don't see anything in the new iPhone that I particularly want.
I'm addicted. To me, it's a chip technology. This new phone,
is it quicker?
Don't buy it. You buy it just for the battery life.
Is the camera better?
The camera's better.
Yeah,
you buy it for the battery.
That's exactly why I end up upgrading, because they kill the battery. They get in there.
The new phone's got what? More whiz bang?
You know what they do,
Come on, you talk to Gurman.
Look, and ultimately what I believe here, it's not just about technology we're going to see on the camera side, we're going to see on the chip, but I think it's really going to be at the software, because I believe this is really the start of what's going to be the AI ecosystem being built out in Cupertino.
I've asked you this before. You've got to have a better answer this time. I didn't like the last one. What are you talking about with Apple and AI? What is it?
What it is?
Siri on steroids?
No, because ultimately 12, 18 months from now, you are going to have a separate app store for Apple that's AI apps only within the ecosystem. And I believe for developers, and in terms of the sum of the parts, that could ultimately add $40 to $50 per share that we see for Apple. And that, I think that's the next leg of the stool, along with the Apple car in 2026.
2026 for the Apple car. That's a cool.
Yeah, and I believe it's a matter of when, not if. And it just shows, as much as the haters continue to yell fire in a crowd theater saying innovation's done at Apple, yet again, they continue to innovate. And that's why Cook is Hall of Fame CEO tactician like he is.
Okay. Dan Ives of Wedbush, Dan, good to see you.
Great to be
As
here.
always.
Good update. I just followed Lando Norris.
Okay.
On Threads.
Did Lando follow you back?
No, Lando didn't follow me back.
Lando's busy.
You know,
okay.
How about, should I follow Girls Think I'm Funny?
Maybe. I don't know what that. I don't know what that account is, Tom. So I can't.
It's just.
Back that
It's
decision.
just Gary V's on here. I mean, you know.
He's an interesting guy.
Yeah. You know.
All right.
It's like.
Let's see if Dom
It's a
Constant's
whole
on
new
it. Dom Constant of Mizuho is going to be joining us very shortly from New York. Futures new session lows negative 0.5%.
Welcome back to another special Wimbledon update for Bloomberg TV and Radio from Tennis Channel. I'm Andrew Guy. Top seed Iga Swiatek dropped just 2 games as she blasted Sarah Sorribes-Tormo off center court Wednesday to reach the 3rd round. The victory was the world #1's 40th match win of the season so far. Swiatek fired 26 winners compared to just 3 for the Spaniard. And don't forget, you can watch all the action from London daily on Tennis Channel. It all starts at 5 p.m. Eastern. I'm Andrew Guy. We'll see you there.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates.
If the inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable.
The higher they go with the Fed funds rate, the more likely they are to reach their target of 2% inflation.
Feels like they're sort of locked in for this July hike.
They're going to hike one more and then they're done.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An important Thursday for economic data. We welcome all of you on radio and television. John, in 29 minutes, it begins for 25 hours.
It's the runway to July 26th, which is the next Federal Reserve meeting. A little bit of information between the last meeting and the next one. A CPI report next week. Payrolls tomorrow. And in between now and payrolls, we've got an ADP report in about 15 minutes. Jobless claims in 30 minutes. And at about an hour, 2 hours from now, you get more information. Job openings, Tom, and the ISM.
This hour, must watch, must listen for Global Wall Street. For the rest of you, Hollenhorst, Constum, that's the kind of people we're going to talk to here. And John, it comes from ultra-accommodative to accommodative. And as Dominique has talked about, we're up here at this restrictive level, and they want to go even more restrictive.
How restrictive are we? You've got Hollenhorst, who joins us, as you mentioned, in 15 minutes. Andrew says another hike at this month's meeting, another hike at September's meeting, and Tom, and then maybe they're done. But we've had this conversation, I think, 2 or 3 times already this year.
Yes, I agree.
The Fed's about to go on pause, the Fed's about to go on pause, and now we've got some people still talking about September hikes.
Most important thing I've heard today, John Farrow talking about yields, the description, the Bloomberg terminal in London, in the city, and the fact is, you said, but the UK economy just perseveres.
Yeah, upside surprises. If you look at the indexes, surprise indexes, both in the UK and the United States, positive surprises in the economic data, reintroducing a conversation about higher interest rates, inflation not coming down fast enough in places like the UK. But Tom, these numbers, I think you have to go back to early March. You've got a 2-year sitting just north of 5%. You start to hear about banks we don't often talk about, SVB.
Right.
People start discussing the banking crisis. We've got bank failures, real bank failures, playing out before our eyes. And people turn around and say, the Fed is done. We're going to have a credit crunch. And this is the beginning of a process.
Well,
Maybe this is the beginning of a process. I don't know. But that was what the conversation was at the beginning of March. I talked about it a million times. And here we are, several months later, with a 2-year yield just short of 5% and a conversation about high interest rates at the Federal Reserve.
30-year bank rate mortgage goes right out, pops up like a 7.05 out to 7.1, whatever, really breaching out near new highs. In the summary of this, John, to get to the data quickly here, to get to Dr. Constam, to me, the summary here is what Ed Hyman said yesterday of Evercore ISI. He's never been this negative on an economy. For that from Hyman is a huge statement.
Equities right now on the S&P, negative 0.5%, a bit softer, a touch softer yesterday as well. Let's see if we add to the weakness through today's session. Yield's just a little bit higher here, up by 3 basis points, a 10-year just short of 4%, a 2-year just short of 5%, and a euro right now just short of 109 against the dollar. Tom, 108.92.
Long ago and far away, I was in Tokyo, and a gentleman from Credit Suisse came up to me and said, "Thank you so much for telling people about our world-class literature." We say this now, of course, with the death of Credit Suisse. And all of that effort was led by Neil Sauce, who got me really helped jumpstart everything I do here. And under Neil Sauce was a guy named Dominic Constam. He and Ira Jersey led a world-class team synthesizing all of this mumbo-jumbo together. We are joined by Dr. Constam now at Mizuho Americas. Dominic, I'm going to cut to the chase. You invented super restrictive. Does Jerome Powell want to become super restrictive?
Well, I think he's obviously already super restrictive. And I think the only reason why they would be willing to unwind that will be either if you get a faster fall in inflation or you see the labor market beginning to loosen up materially, which, a combination of both we think will happen. I think the panic, if you like, back in March, going into sort of April, May, when rates were very low, the curve was steepening, people were focused on the banking crisis. That panic has obviously subsided, thanks a lot to what the policymakers did. But there's still a scar on the economy that I think you're going to see coming through.
John, in our opening, you mentioned this, the idea of March, and we forget the bank trauma. While you were gone, we had stress tests, and you'd think we'd move beyond the trauma. I'm not so sure.
Drink. That's our new drinking game, while you were gone.
Yeah, but it's Jenny Cream Ale. That's what we're using.
Okay, nothing too hard because you're mentioning it so much. Dom, just to build on that, you said the scars are there, and they're going to start to come through. That indicates that you believe a process did begin back in March. Could you shine a light on that a little bit more, Dom? What are you seeing that is taking place at the moment that you think will come to the surface?
Well, we know that credit conditions have tightened a lot in the survey data, and that anyway works through to a lag in terms of lending growth itself slowing down. And you can see in the weekly data, lending growth doesn't look particularly good, particularly for the larger banks. So that's sort of one issue that's already in place. The other issue is really the net interest margin story. So you're going to start getting the bank earnings, and NIMs are going to get released. And you can model NIMs, relatively straightforward, and they're going to deteriorate. They're clearly going to deteriorate. The curve is very inverted. NIM compression, I would argue, is very much in place. Again, it takes a few quarters to properly see through. But we're talking about a swing of a few $100 billion potentially, as much as that, in terms of what could be taken out of bank earnings, essentially. And that's just from a sort of top-down macro view. And then, of course, the issue is how that's distributed across the banks. Some banks are going to be much better placed than other banks to deal with this. The ones that really had to fight for deposits, if you like, are going to be the ones that will come back into focus. So the policymakers have done a lot, I think, to put to ring fence the crisis in terms of sort of a banking systematic sort of problem. But that's all going to sort of feed through still into weaker lending growth. And that collides with what we think is going to be a loosening up of the labor market, because people are kind of, there's too much labor hoarding going on, not yet enough labor shedding going on, but that transition, I think, will take place in the fall. So we've had obviously a bit of a round trip in markets, but I think the fundamentals behind the outlook for the economy are still a little bit, very much concerning. If we can get a soft landing, fantastic, but a hard landing is very much still on the radar, I think.
Tom, we need you to build on that just a little bit more. You mentioned how some of those banking issues might be distributed across the banking system. how that will be distributed across banks, small through to large, will have implications for how it's distributed through the economy. Can you give me that element of it? Dom, how do you think this will show up in the broader economy? Is it just small sections of the economy that starts to struggle, or is it a broader issue?
No, I think it's going to be a little bit like what we've already seen. I think it's going to be the combination of the banks that perhaps haven't had the benefit of earning at IOER rates at the Fed. They haven't had the excess reserves perhaps, so they've had to on their income side it's been a bit more difficult, and in addition they've had to fight for their deposits. So that's going to be probably the same sort of thing that we saw before. In terms of the economic impact, you can just look at the sectors where there's clearly been sort of overemployment. I mean, technology is obviously one. So I think that's kind of where you'll probably see the stress.
Years ago, Dominic, the most famous chart you generated was how everybody was consistently wrong predicting higher rates, and there were these little wisps on a Credit Suisse model of wrong over time. I'm not saying you were wrong. I'm saying the entire street was wrong. What's the chart now that indicates how wrong we are? What's the chart now that we're just getting it wrong?
Well, I mean, I guess, the way in which the Fed expects, if you're going to look at the same kind of hair charts we used to call them, whereby the market had always consistently overestimated what the Fed was going to be doing, you can certainly argue that the market has tended to underestimate the commitment of the Fed to sort of maintain rates at an elevated level and keep pushing through. So if you go back a year, we were pricing for cuts and come this year, and obviously the market's not there now. So it's been wrong on the other side of that.
That's why we're dovetailing you with Hollenhorst from Citigroup here. We're getting two different views. If we get an Andrew Hollenhorst market with 2 rate increases, how does our world change?
Well, I mean, every time they hike rates, I think the market is not going to be convinced that they're going to have to do even more. I think it's more like they hike, but that's the last one sort of thing, or at least they reduce the probability of the next hike. So the market is very much, and that's just a function of the super restrictive. I mean, there's no way you can look at the market in any kind of sort of context and say that the Fed isn't very, very restrictive in terms of where real rates are. And it's just a question really of what your view of inflation is. If inflation is coming down, if the Fed doesn't do anything, they become even more restrictive, and that's very important to realize that even if the Fed does sort of get rates up to say 5.5% or even 6% and keep them there, unless you think inflation is also going back up again, then that policy will become just even more and more restrictive, and they're going to have to unwind those rate hikes very quickly. Otherwise, they will collapse the economy. And when we look at inflation, I actually think the inflation picture in the US is looking pretty good. The core services side has come down, and the goods side is bad because of used cars. But you know what? No one's actually buying that many used cars. In real terms, the real purchases of used cars has been going down for the last couple of months, but that's because the price has been going up. And that's just a sort of supply side issue. And that's not really, in my view, what the central bank should be really focused on, that they should be focused on demand side inflation. They can't really help the supply side. So that's why we get into this sort of concern around this really restrictive sort of policy, and why you get this tail risk of a harder landing. When it all goes wrong, it's going to go wrong pretty quickly, and that's why the Fed may have to reverse course very, very quickly.
Dom, amazing. Dom Constant there of Mizuho Americas. Can I ask one thing from the audience, if you have 10, 15 minutes? Go back to yesterday and listen to Tom Tsouras of Strategas, and then replay that conversation we just had with Dom Constant and make a decision. Who's convinced you? Because on the one side, you've got Tom Tsouras saying something completely different to what Dom Constant and Mizuho just said.
John and I are off for a game today. We're so threadsed up here. We're just missing the legacy back 24 hours. Jim Bianco, Tom Tsouras, talking about disinflation, where you are sticky, you come down, and then you either stop, or as Jim Bianco talks about, rates actually go up. Nobody's modeling that in. Nobody.
It's amazing. Polar opposites in the last 24 hours. If you are just tuning in, welcome to the program. The S&P 500. Equities right now negative. Session lows, negative 0.62%. Coming up in about 5 minutes or so, Andrew Hollenhorst of Citi on a slew of economic data. That economic data begins with the ADP report just moments away. At the corner of my eye, I can see Mike McKee's just entered the studio, TK. So Mike's going to break that down for us. The ADP report, the expectation, the median estimate in our survey, 225,000. The previous number, Tom, 278,000.
It's a huge two-day concentration here. And, you know, McKee talks about the JOLT survey. He's looking at the underneath the headline data. And he taught me this. You know, the media is focused on 3 or 4 numbers, and you can go that afternoon over a beverage and say, OMG, did you see the unemployment rate? But there's a lot of dynamics under here. And what I'm fascinated by at the heart of the matter, you mentioned Neil Dutta earlier, how does all this synthesize down to everybody being wrong on a GDP guess since time began? That's sort of where I want to be in 25 hours.
I think a lot of people have been wrong this year, Tom, on both the economy and on the market as well. So the economic data comes out in about 2 minutes' time, the ADP report, and then it's on to jobless claims at 8:30 Eastern time, so about 17 minutes from now. Then after that, you'll get job openings, the JOLTS report. Mike will give you some colour on that in just a moment. Then a read on services in America, an important sector, of course, for output in the US economy. Manufacturing is dreadful. All that recession talk, manufacturing is in a recession worldwide. If you look at the indexes that we get from the likes of S&P Global, most of them are sub 50 on the manufacturing side of things, Tom. Services is still robust. I go back to what we talked about yesterday, how those two things converge. Is it manufacturing up to services or services down to manufacturing? You know, is an important topic of debate.
It includes boat rentals in Italy. I mean, that's what services
contributing. Yes, yes.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I am the most bearish I've ever been on the economy without being in a recession. And it's because of the yield curve, the contraction in money, and QT at the same time they're hiking rates. That 3 blow hit to the economy is going to cause a recession, but it doesn't happen overnight.
Ed Hyman of Evercore, just absolutely fantastic yesterday. You can find a full conversation on Bloomberg.com and on the Bloomberg terminal. Remember this phrase, nobody cares about the ADP report.
Yeah.
And then the number comes out from ADP, Mike McKee, and it's a big one.
It is a very big one. Tom called Ed Hyman, asked what he thinks about this. 497,000 jobs created, according to ADP, during the month of June. That is well in advance of the forecast for 225,000, way ahead of the revised 267 that they say we got in May. Now, ADP for months and months has been coming in lower than the non-farm payrolls number from the Bureau of Labor Statistics. And so if we got a higher number from BLS, you can only imagine what the market would reset to. The numbers are really interesting because most of the hiring was in leisure and hospitality still. And although they seasonally adjust these numbers, I'm not sure if they've got it exactly right, because 232,000 jobs in leisure and hospitality. Now you're going to open all the beaches, the lifeguards get hired, the amusement parks open up. That would increase employment in those areas. But 232,000 is a very, very large number. And you get this 497,000 guys with a loss of 42,000 jobs in manufacturing, according to ADP. So this is quite a number, and it's going to be really, really interesting to think about it tomorrow morning at 8:30 Wall Street time.
Let's push it through the bond market first of all, Mike. Yields up at the front end on a 2-year by 7 basis points. We reclaim 5% at the front end of the curve. On a 10-year, just short of 4 at the moment, but about to get there at 3.99. And we break 4 on a US 10-year. Yields higher by 7 basis points. So through 5% on a 2-year, through 4% briefly on a 10-year. And in the FX market, dollar weakness this morning, dollar making a comeback now post that number. The euro back down to about 108.62, so well off session highs. Looking at the equity market, we are negative now at session lows. We're down by 0.65%. If you are just tuning in, big upside surprise, 497K on the ADP report. The survey was 225, and TK, that's the appetizer. Going into payrolls tomorrow and just ahead of jobless claims in about 12 minutes' time.
Let's sell forward to Michael McKee's busy morning claims here at 8:30. I'm going to say ISM services, John, is also suddenly germane at 10 a.m. before we get to jobs tomorrow. Mike, John, I want to point out the 10-year real yield explodes is the word I'm going to use, out to 1.75%. That's a big, big
It's amazing.
number.
I think, Mike, you did a great job of framing what's happening with manufacturing and what isn't happening with services. Do you expect to see that in the ISM in about 2 hours' time?
That's been the general pattern, although the ISM for services employment numbers were negative. They were below 50 last month. So do we get that again, or does it start to go up again? I mean, in theory, if you get these kind of numbers at service establishments, especially leisure and hospitality, those numbers should go higher. So we'll see if this is an outlier or not. One other important point, ADP has now started publishing a pay survey. They've been doing that for some months now, and according to the pay insights, the overall pay for employees increased 6.4% if you stayed in your job. That's down from 6.6% in May. Job changers slowed for the 12th straight month, 11.2% raise. That's the lowest since October of 2021, they say. So we're getting all this job creation without in theory, significant wage gains, or at least they're slowing, which if the Fed were to look at it, they probably would like that. I'm not sure they would. They do use, interestingly enough, the Fed does have its own private index of employment, and they use ADP data to create it. It's not the same. It's not the same index, but they do use it.
On in 9 minutes, Michael McKee with claims. Right now, he was an outlier. He's not anymore. Andrew Hollenhorst has led its Citigroup. He's our chief U.S. economist on 1-2 rate hikes. All of a sudden, with a number today, Andrew, I'm interested in September 20th. And I'm absolutely, my head is spinning over restrictive. Are we close to restrictive in our complex mathematics of this economy?
I mean, I don't know that you need to go into the complex mathematics. We can, and I think that's important. But if you just step back and you look at this labor market data in particular, we've surprised month after month to the upside. We continue to see these jobs numbers coming in stronger. And I think Mike gave all the right caveats around ADP employment. There's a lot of reasons that can differ from the official payrolls reading, and we have some big seasonal adjustment issues. All of that, I think, is right. But just take a step back, look at these jobs numbers, hundreds of thousands of additional jobs relative to expectations that have been created. That's a signal that maybe we're not at appropriately restrictive rates.
Is that an appropriate signal? Is that a lagging indicator, Andrew?
That's the big issue is the Fed is making policy now, looking at data that is going to depend on their lagged policy making. And I think the bank issue, the credit tightening, that's something that probably still is going to be working its way through the economy, slowing things down. The concern, though, is that some areas have already been worked through. If you look at the housing sector, we bottomed in housing. We've come off of that bottom, and we didn't lose construction jobs. And that's a great thing for construction workers, a good thing for the economy. But if the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
Can you help me with that? That's been a key question for me in the last 24 hours, and I'll keep digging into this too with other guests later on Bloomberg TV and on Bloomberg Radio. When you look at the surprise indicators, that index is the highest it's been since 2021. So that's the incoming information relative to the estimates before that economic data. Is that because things are better than expected, or are things getting better? Are they actually improving?
I think it is better than expected, and this is really theory versus data. And the theory would tell you interest rates are higher, real interest rates are higher, that tailwind from lagged fiscal stimulus should be coming off. All of those things should be slowing the economy, and we think we see some signs that some of that slowing is happening. But job growth has slowed down. It used to be running 1 million a month, and it was running 500,000 a month, but it slowed to somewhere around 300,000 a month, and that's just a lot faster than anyone would have expected at this point.
The arch issue here is Ed Hyman looks at a very, very weak economy, and yet we've got service sector doing this and that. Does Citigroup look at this as a weak economy after 2% GDP adjusted in the first quarter?
I think this cycle is just so different that some of the standard indicators of weakness are not working the way that they have historically. One example John was talking about before, manufacturing. Manufacturing ISM showing contraction, that's usually a good leading indicator of recession. The housing sector being in contraction, that's usually a good leading indicator of recession. But this cycle is different. We have this transference to services spending.
In the continuum here, are we, as Constam just mentioned from Mizuho, are we where it's a pandemic supply side analysis, or is it a demand side demand-driven analysis for the Fed?
I think you have to do them together, and I think that it's a commonly made statement now that, well, central banks should be focused on the demand side, not the supply side. You have to focus on where is the demand side relative to the supply side. And unless you think the shock to supply is some very transitory issue, and a lot of the issues that we have on the supply side now are structural and will be with us for some time, central banks need to recognize that supply side and then adjust demand accordingly.
Looking forward to bookmarking the address from Chairman Powell in Jackson Hole next month with the address from last year and comparing where unemployment was there and where it is now. Because we're looking for that to come in at 3.6%, which is basically where it was, where he was addressing the public, talking about causing pain and potentially pain in the labor market.
I'm in the camp a la Sintra that this isn't in the textbooks, as Andrew alludes to. Post-pandemic, it's both sides, supply and demand, and we're just making it up as we go. They're wildly exposed.
497,000 on ADP.
Yeah, you know, I mean,
it's almost a laughable number. Yeah. You know, it's like kind of ridiculous when you see a number like that come out. Just a monster upside surprise.
Yes. I mean, Mike, is there one color here that you can give us before claims?
I don't think there's a particular color other than to say that the initial reaction from most economists is this is kind of an outlier. It's hard to explain. The small businesses added 1 million different jobs, and that's not what the NFIB has found.
Mike McKee coming up in 5 minutes. He's going to break down jobless claims. Andrew Hollenhorst of Citi responding to that. A 2-year through 5%, 10-year yield through 4%. On that debate, Christian Mamani thinks there's upside risk. Potentially that's the pain trade for high yields. Mike Kontopoulos of Richard Bernstein taking the other side. And should you sell the low volatility? Amy Wood Silverman of RBC on that at the opening bell.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg surveillance, if you thought it would be a quiet start to July, you are wrong. We see history in the interest rate market right now. The two-year yield 5.03%, up a solid 9 basis points off a bang-up ADP report. And the data, well, we'll slide into it here in 6 seconds, but we have a new sobering reality. Michael McKee really matters for the next 25 hours. The trade balance boring comes in on plan. Michael McKee, we're waiting for claims. How do claims, Michael McKee, dovetail into the ADP report?
Well, I can tell you they come in a little bit higher than anticipated at 248,000. That is higher than the initial report of 239 last week, but it is also higher than the anticipated 245. So a bit of a rebuild in claims. Now, this is a tough time of year to get claims right because you have a couple things going on. We had a Juneteenth holiday that was in the last report, which is now revised down to 236, and that's a new holiday, so hard to seasonally adjust for that. And then you've got the auto industry shutdowns that come around every summer. So I wouldn't put too much on the actual number, but the level change is a little bit stronger, but it's still nowhere near telling you that we have a big layoff problem going on. Right. 1,720,000 continuing claims. That's down from 1,733 the week before. So the people who are getting benefits has fallen back, which is tells you something as well. So that's 2 out of the 3, or 2 out of the 4 today. We'll get jobs, the JOLTS numbers, and we'll get the services employment numbers coming up. And then watch that 225 survey for payrolls tomorrow. That may change. The
survey may change before the jobs report.
Before the jobs report, because if we get all this strength, people might start to build some of that into their anticipated numbers.
Futures deteriorate, negative 33 on the S&P futures. We're out of stick on the VIX, 15.29. The two-year yield's got a life of its own, up 13 basis points, 5.07%. Think what that money market fund at Citigroup is going to do. We have the honor of continuing from Citigroup, where he has a 7.2% 6-month CD. Andrew Hollenhorst is with us, their chief U.S. economist. I want to go to what matters in the textbooks, which is not the yield of the 10-year, 4.02%, up 9 basis points, but a 10-year inflation-adjusted yield measurement of 1.77%. Given the Hollenhorst rate structure, given the Bill Dudley rate structure, given the Mohamed El-Arian rate structure, where's a comfortable real yield that we can live with?
I think you're going to the right place, Tom, which is that 10-year inflation-adjusted yield. That's going to control the level of activity in the economy. And what we've seen historically is those level of real yields need to get up above 1%, maybe even above 2% to really slow the economy. So that's the first thing to keep in mind on the real yield story. The second thing is, what is the inflation number that you're subtracting? That's really the key question. If you're subtracting 2% inflation, then an approximately 4% 10-year treasury yield is going to be a 200 basis point real yield. If you're subtracting 4% inflation, then we're at zero real yield. So that's really the question. I think the question is, where is inflation going to run structurally?
And UCLA 101 there, what you got from Holland is you got three statistics. You got the nominal yield, take away the inflation rate, that's movable, and that gets you to a real yield, the residual off the back end. One of the themes we're hearing on the show from smart people is the stickiness of our disinflation. What is your call on disinflation? Do we get to 3%, whereas Jim Bianco states we could actually reverse or stay there for a good amount of time? What's your call on inflation?
Yeah, so we have some positive dynamics over the next few weeks, actually, in the inflation data, where you should see used car prices coming down, shelter prices should be slowing. So there are reasons to think we're going to slow into the end of the year, probably get down to something like a 4% underlying core PCE pace, maybe into the high threes. That's all good news for the Fed. The issue is looking further into 2024 now. If this housing rebound continues, if house prices continue to rise, if the labor market stays tight, then it's really hard to tell a story where inflation is disinflating further, and you have risks that inflation actually increases. So that's not our base case outlook, but I think those risks are becoming a lot more material.
There's July 26th. And then there's Jackson Hole. Does all this chit-chat might change what you believe you'll perceive at Jackson Hole?
Not so far. I mean, I think a lot will depend on tomorrow, in the sense that if we get something like 500,000 jobs created, they're going to raise rates. They're probably going to raise rates in September, and Jay Powell will explain it to us all in Jackson Hole. But if it comes in more like the 225 that's anticipated, then you've got open questions about September. So let me throw that out to Andrew here. When you start to model out what happens over the next 6 months, let's just get to the end of 2023. Do they go 2 or do they just go 1 and hold? Are they on every other month? How should people anticipate what the Fed's going to be doing?
Yeah, I don't think there's a strong presumption towards every other month. We saw in the minutes, as well as in comments from Chair Powell, that they want to moderate the pace, but they're not really telling us that that's necessarily every other meeting. And they want to keep this kind of very data-dependent approach. So I think it's exactly what you said. They're going to look at the labor market data. They're going to look at the inflation data. Like I said, core inflation, the next couple prints maybe are going to be a little bit softer. So that should be somewhat encouraging for Fed officials. On the other hand, this resurgent activity story and this 2% growth that is continuing longer than expected, job growth that stays stronger than expected, that might end up being pivotal for whether they make that September hike or not. I agree with you. If we see anything approaching what we saw in ADP and the NFP reading, then that's probably a strong signal that they will go ahead in September.
I'll get Tom all excited here because he loves to talk about R-star. But part of the calculation going forward, you mentioned the 2% growth that goes on longer than expected. Do you think that the neutral rate is higher and will stay higher than it has been? Or are you in the John Williams Fed camp that says we're going to go back down to 2% and rates can fall down as well?
I mean, I guess maybe you could say I'm in the Laubach John Williams camp, which is a paper that the two co-authors wrote that suggests that you should have this kind of very slow-moving update to where that R-star is, because we really don't observe it. What we do observe is where's inflation, where's growth, and if inflation and growth are coming in stronger than expected, then you should start revising that up. So I am kind of slowly starting to adjust higher where that R-star might be. I don't think we've come a long way there yet. We have to see more data to really know where we end up. If you look at the Fed's dots, remember that long-run R-star in their dot plot came down significantly over the last decade that they had the dot plot. We're starting to see some of those dots move higher, and I think that's just appropriate given the data that we've seen.
If you're just joining us, it is 23 hours of chaos. That's the only way to put it. Michael McKee is focused on the JOLT survey tomorrow. We'll bring you the unemployment data tomorrow, the 2 jobs reports, this off the shock of ADP. In a market on the move, the equity space down 32 points on the S&P futures. The VIX out of stick 15.28. And the yields, I'm not going to take a lot of time here, but I'm out 9 basis points higher. 10-year real yield, the 2-year yield is a 5.08%. Really remarkable. Andrew Hollenhorst, I just brought up the Citigroup mortgage rate, and it's something like a published 7.07%. What do these yield moves do to housing? And it's to me, we're right on the edge of a jump condition in the cost of money to affect real estate, right?
Higher mortgage rates are going to slow the housing market, and we've seen that over the past few quarters. But that mortgage rate actually peaked back in September, October of last year when 10-year yields peaked. Now we're getting back to those levels again. So you can see those same kind of mortgage rates. The issue that you've had is that reduced demand for housing, but it also now has reduced the supply of housing in the sense that if you have an existing home, you don't want to put that home on the market. You don't want to lose that 3% mortgage rate. So what we're seeing in the housing data is a really interesting development where we're actually getting more activity in new housing starts. You're getting prices that are moving higher because demand is lower, but like we were talking about before, the supply is also lower. And as that market adjusts to that, you're actually starting to see some renewed price pressure.
As a general statement, if businesses live in the nominal space, the top line space, so it's not the inflation adjusted space, I'm sorry, it's a jump condition, Andrew. 14 basis points in the 2-year yield, 5.09%. How does the business appetite change with the shock of this Thursday morning?
Yeah, we definitely will see this feeding through to broader credit conditions. You see that in the senior loan officer survey. It'll be interesting. We'll get another look at that soon. And you see lending conditions broadly that are tightening. This is just going to take time to work through the banking system and the credit system.
We had a viewer question, but I never get the viewer questions. McKee's the only one that gets the viewer questions. Who's the viewer?
You're getting
is this from which governor is this going to?
You get all the questions.
Is this Krosner emailing him?
Well, it's a pretty simple question, and it's probably something I should have thought of to ask you as well. You guys are at 170 for tomorrow, and that's below the consensus. Do you change based on any of this data? How are you going to put it together?
Yeah, I don't think we'll change based on this, and the issue there is what you mentioned, Mike, which is the seasonal adjustment issues. The reason we're lower on tomorrow's number is because this data is so difficult to seasonally adjust, and that seasonal adjustment tends to differ between ADP and NFP. So when we go back and look at this data, I think we probably will end up being weaker on NFP than we were on ADP, and we'll end up attributing that to seasonal adjustment issues.
I look at it, my head spinning. You're going to go back to the office today. Do you guys rip it up, or do you just have to wait to see what 8:30 tomorrow is?
You know, every day it's like we're starting over again. I mean, the cycle has just been so different than anything we've seen. So we take the data as we get it.
And that, I'm going to suggest, describes the central bank of the United States right now. To me, they're wildly ex post, as I've never defined in my mind before.
Yeah, I think that's right. A very reactionary.
And I saw that at Sintra. I think all four they were all struggling to come up with theory. There's no theory here.
Yeah, there is a sense in which the data have just diverged so much from the theory that everyone has become more empirical and more reactionary to the data.
Thank you so much for joining us. Can we see you tomorrow at 8:30? If we get a bang-up number like this, we get 600,000 non-farm payrolls.
Yeah, I'd love
to pick up the phone, take a call. Andrew Hollenhorst with us with Citigroup as well. Michael, Dr. Hollenhorst makes clear he's never seen this. Have you ever seen this?
Not like this. I mean, it's just a completely different kind of economy. And the interesting question is, how long is that going to last? Do we go back to the old rules working again? To talk about our friend,
that's John Williams, our
friend Mohammed El-Arian. Do we have a new normal? Do we go back to the old new normal? Do we go back to the old normal? We don't know at this point.
Are you doing threads?
I did sign up.
You did sign up. So Isabel Lee over at Bloomberg News just announced she signed up. She's very brave.
I think everybody's going to try it out. We'll see how it goes.
We'll have to see tomorrow. This is really exciting, folks. You know, forget about sleepy July and the heat that's out there, particularly in New York City. We're not seeing it. We're seeing a 2-year yield, 5.10%. Standard & Poor's 500 on a percent basis, down 0.8%. This is Bloomberg Surveillance on radio, on television. Michael McKee with us right now to garner wisdom here. I want to go to McKee 101, which as usual, you leaned forward yesterday, Mike, and said we need to lean forward and pay attention to JOLTS. Review this now. Why is JOLTS important?
Well, it's important because basically the Fed has hung its idea of a tight labor market on the idea that there's so many job openings that the people are going to have to pay up, and that'll be inflationary to try to get workers. So they've been watching these numbers, and economists have a lot of questions about JOLTS. The survey response rate is very low, and a lot of these may be repeat job announcements that maybe have already been filled and they just didn't take them down. The folks at Indeed.com who run their own job surveys say their numbers are much lower in terms of overall jobs. They're about where we are in terms of unemployed people. So, you know, does this give Jay Powell a reason to continue to claim that the labor market is really tight, or what do we get out of it? But since they're watching it, everybody else is.
And do the PhDs at the Fed pay attention to the ADP report? That's the heart of the matter.
Well, my guess is they pay attention and they look at the data, but as I said, they have an index that they say is based on ADP data. It's not the ADP report. So I would be very interested, if you're listening down at 20th and C Streets, send me that number. I would be very interested to see how it differs from the number we got.
The 10-year real yield, 1.80%. That is a wow statistic. That's all the reason you need to stay with us through the coming day. The conversation here as we go to the jobs report, we'll do that tomorrow at 8:30. We'll go beneath the headline data. We do that with Michael McKee. This is Bloomberg on radio, on television.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You know, it's an interesting time because no one expected what happened in the first half. I would call myself more of a sober bull at this point. There's risk in the market. It's clear that there's a lot of risk in the market. I'm paying attention to the bond market. I'm paying attention to a lot of the economic data. Not all that suggests things are great out there.
Ann Maletti, Ace Value Manager at Allspring Global Investments. She's paying attention to the land of Ira Jersey. So is Gina Martin Adams. We're never going to admit that Ira with his 201k is probably paying attention to the Gina Martin Adams world. But they are here to synthesize this. This is an important conversation. As we mentioned Dominic Constam earlier, Ira is a young whippersnapper, worked for Constam a few years ago at Credit Suisse when Gina was holding court. I think it was at Wells Fargo. And we've got here real bond and real equity perspective given the tumult. Let me define the tumult for you right now. And this goes to Newtonian calculus. Because of that, Gina, I'm going to you because Ira's like weak at math. The basic idea here is a 2-cent spread hasn't moved 107 basis points. A 10-year real yield's a rocket ship out to a 1.80%. 2-year yield up 16 basis points. These are wow moves in the bond market. When you get gamma in bonds, Gina, what does it do to the equity market?
Yeah, well, it depends on the offsetting impact on the economy, frankly, because earnings are the primary driver of stock prices. But you do see when you have very significant moves in the bond market, you usually see it play out through valuations, suppressing in particular the longer duration assets in the equity market, those with cash flows concentrated much more distant into the future. Now, the interesting aspect of 2023 is we're not seeing this necessarily happen this year because of the earnings landscape, which is significantly offsetting a lot of volatility that still exists in the bond market. Also, because 2023 is so polar opposite in difference in terms of margins to what we experienced in 2022. So even though the bond market is experiencing a lot of movement, the equity market has other factors to tie to. AI driving earnings, compressed inflation spreads helping to stabilize margins and the like. As long as you have pretty strong job growth as well, any concerns about revenue growth for the equity market are diminished. So the equity market has other factors to kind of tie to right now.
Years ago, Ira, Constant would lean over his desk and turn to you and say, which number on the BTMM screen matters? Ira Jersey, which number on the BTMM screen, the great Bloomberg money market screen, matters to you at this moment?
Yeah, so, well, there all of them matter at some level, Tom, as you know that I was going to tell you. But what's going on in the repo market matters quite a lot, because a lot of these moves are much larger than you might think, given just given the data that we've received. So liquidity is certainly something that's on the minds of a lot of people in the bond market right now. It's a holiday shortened week. We have a big data number tomorrow. Not a lot of people want to take risk and probably want to get out of some risk before tomorrow's jobs report. And then on top of that, you've had a weak Europe, because now they're talking about more rate hikes in the UK. So maybe going up to 7% in the UK. So Hugh Worthington, our colleague in London, is flagging that as one of the reasons that the sell-off started overnight quite dramatically.
Are we in a jump condition? The fancy talk here, folks, is you have glide path, smoothness, which indicates stability. If I take the 2-year yield back 3 years, Ira Jersey, can we now state with this breakout a jump condition?
Well, we've certainly jumped a lot in a short period of time, and we keep doing that as we reprice where the Federal Reserve is going to ultimately end up in terms of its hiking cycle. So now we're almost fully priced for that 50 basis points of hikes that you saw in the dot plot. There's still a lot of data to go before we get to the September or November meetings in order to see if the Federal Reserve will ultimately make that second hike. But when you get data like this morning's ADP report, it's almost you almost have to think it's a done deal that the Fed's going to move again in July at least, if not again.
Gina, 5.09% on a 2-year, that's a ginormous 15 basis point move. What's it mean for Diamond? What's it mean for Moynihan? And what does Bloomberg Intelligence say about the dynamics of the financial statements of our big banks?
Yeah, I mean, without a doubt, the banks within the financial sector are not one of the preferred segments, given the yield curve signals, as well as general credit distress in certain segments of the economy. When we run our broader financial models, we actually find that some of the consumer finance companies, some of the insurance companies tend to filter toward the top, leaving banks far behind, given the dynamics of the yield curve, as well as this potential for defaults and ongoing risk emanating out of the regional banks.
Gina, are we going to see, I mean, you talk like that, and I think of Visa just has been a huge performer. Good morning, Meredith Whitney, who nailed that call a million years ago. Gina Martin Adams, am I going to see 33%, 35% annual charge card rates?
Look, it's certainly not within my purview to finance. I do think we are seeing the cost of borrowing go higher and go higher very, very quickly. At the same time, we're seeing the amount that consumers are able to get on deposits rise very, very rapidly as well. So it really depends on the degree to which the job market slows down, suppressing wage growth, forcing consumers to go out and borrow. I think it's worth noting that borrowing overall is still at a very, very low level relative to income. Debt service relative to income is at a 40-year or near a 40-year low. So there's plenty of capacity to borrow, but it will without a doubt cost more to borrow money going forward, given where interest rates are. There are offsetting factors, and it's important to note that's not the only decision that consumers will be forced to make. In particular, the job market remains very strong, wage growth remains relatively steady, and inflation pressures come down. Those factors can offset the cost of debt.
I mean, Ira, the bond strategist Gina Martin Adams gets to the heart of it. which is we're all living very, very quickly. I mean, that's what I'm seeing right now, Ira. Define very, very quickly in your world, and what will it do to mere mortals that are watching?
Well, I think very quickly is, as you saw this morning, almost instantaneous. The market right now is kind of confused, and I think a little bit fickle. We see some of the data on inflation, for example, continuing to trend a little bit lower, but then you get data like we had this morning in the ADP report, and people are worried that you might see a reacceleration, or if nothing else, maybe a flattening out of the level of price growth in the economy, continue to maybe stay at 4%, right? So in an environment like that, I think the market's continually reassessing where is the Federal Reserve's terminal rate, and we all thought, well, most of us thought it was 5% plus or minus 25 basis points. Now we have to reassess that because we've gotten to that 5%, and the question is, can we go to 6 now? Is going to be the next question that I think the market's going to ask itself.
Can we go to 6 now, Ira Jersey?
I don't think so, but then again, I didn't think we'd go to 5.5, and now, now I have to reassess whether or not we're going to get to 5.5, and I think that's a distinct possibility.
Gina, Dan Ives was in this morning. He absolutely nailed the tech rally of 7, 8 stocks. He gets lucky once every decade. You know how that goes, Gina. And he talked about ecosystem. There's been a lot of zeitgeist, Gina Martin Adams, in the last 3 days about how older people in America have loaded the boat in the equity space. Do you agree with that? That everybody owns stocks in our ecosystem? Is stocks ever higher?
I think if you look at the broader statistics, you actually find that less than 50% of U.S. households actually own stocks. Net households have not added to their equity positions in more than 20 years, as investors were burned by the tech bubble. So we're talking about, you have to go back more than 20 years to the peak in equities holdings as a share of overall household holdings on net basis. Certainly those investors that were able to ride the wave of the equity market and weather the storm of 2000 and then again in 2008 have benefited from that, but they've been riding it. They haven't net added to those positions. So I would take a little bit of issue with this idea that right. Investors are over allocated to the equity market. They certainly are holding, and that has benefited them, frankly, as equities continue to sort of perform significantly better than many had anticipated, tied to growth.
I mean, Ira, you taught me the 30-year yield function here, and I'm looking at the intraday on the 30-year bond. That used to be the benchmark. Young Jersey doesn't remember. We didn't get to 4%. Ira, what's my mortgage rate in 2 weeks?
Oh, it's going to be a little bit higher, that's for sure.
Thank you. The analysis there from Ira Jersey of Bloomberg Intelligence. And Gina Martin Adams, thank you so much. Folks, we said it's going to start slow. This is nuts. We'll see you tomorrow. By then, I'll have more Threads followers.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and
that's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Jobs data coming in strong. Equities down, yields up. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, the latest jobs data coming in hot. Janet Yellen touching down in Beijing, and Instagram taking on Twitter. We begin with the big issue, payrolls, up next.
We're looking for another big print on Friday.
The June payroll report.
Payrolls. The jobs data.
We're going to see a strong jobs report.
We expect the consensus.
Payroll data are suggesting that things are very tight.
The labor markets are tight.
Labor market has been really, really strong.
Robust strength.
It's been rock solid. We really need to see the job market start to crack.
We haven't seen anything crack yet.
That's what everybody will be looking for.
The payroll report has beaten 14 consecutive months.
We're still worried that the Fed needs to do more. Unless we get a surprise to the downside, they are moving ahead with one or two more hikes.
That might be the game changer.
That employment picture is probably the linchpin that we're all looking for.
Joining us now to discuss, Lafayette's Krishna Mamani, Mike Kontopoulos of RB Advisors. Gents, great to get your reaction to that data 30 minutes ago. Krishna, first to you. Should I care about the ADP report?
Well, ADP report certainly foretells the potential strength that we are going to see tomorrow. I think the bottom line is very simple. That is, the labor market remains extraordinarily strong. The U.S. economy is actually has the chances of re-accelerating rather than slowing down meaningfully. And the unfortunate part in all of this is that has been discounted in the market already. So that makes the bond market extraordinarily vulnerable.
Bond market's seen a big move this morning, that's for sure. Bonds down, yields up in a big way. 2-year through 5%. Actually taken out the highs for the year at one point. The 2-year at the moment at 5.06%. The 10-year through 4%. The 10-year up by 9 basis points. The 2-year up by 12. Look at that data, Mike, this morning. ADP, 497,000. 225K. The estimate. That's a blowout report, a massive upside surprise. Mike, how much weight should I put on 497,000 from ADP?
Well, Jonathan, you can't discount it for sure. I mean, listen, it's a red hot, if not a white hot labor market, which is a bit surprising given what the Fed has already done. And, this cycle sure seems to be a bit long in the tooth at this particular point. I think I disagree with Krishna a little bit. I don't see a lot of reason for re-acceleration of the economy here, but clearly it's not slowing down to the extent that you would think 500 plus basis points of hikes would ultimately achieve. And so I think, listen, you have to pay attention to the data, and the data is clear. Labor market is hot, and I think at the end of the day, this is going to be a big concern for the Fed, and they're going to have to continue to hike until they break labor. Labor is the key, and so. You can't discount this one bit.
And most people anticipate another one in a couple of weeks' time. hence why we're seeing a 2-year through 5%. You talked about the broader data here, Krishna. If you look at the surprise indicators, we've been talking about them, upside surprise after upside surprise. That index is the highest since 2021. And one thing I've been asking of guests, and Krishna, I'll ask you as well, is it because the data is just better than expected, or is this economy improving?
Well, so I think the data is certainly better than expected, but I would say that the economy is actually improving, if not improving, at least holding on to the strength that it had coming into the second quarter. And there is basically no sign of slowdown whatsoever, especially in sectors that are traditionally interest rate sensitive. And if the Fed's 500 basis point rate rise is going to have a meaningful impact, it has to show up somewhere. And so far, it hasn't shown up anywhere in terms of investments, in terms of housing, in terms of construction. I think if there is a kind of a silver lining in terms of a potential slowdown, it's probably consumption to some extent. And hopefully that kind of drives the normalization of growth. And that's what, as a soft landing proponent, that's what I'm hanging on to.
Sit tight. I want to bring Mike McKee into the conversation. Michael McKee, a blowout jobs report 34 minutes ago.
Yeah, everybody's saying how hot it was. I feel like Ed McMahon with Johnny Carson. How hot was it, Johnny? 497,000. That's 500,000 jobs. And most analysts right now are kind of dismissing that, saying it's out of left field. Omar Sharif saying it doesn't relate to anything we've seen on this planet. But it is a data point that we want to look at. Jobless claims probably getting more attention in the sense that at least we have something in the range of what we've normally seen. And they're continuing claims, maybe telling the story, because they fall. That's the number of people who are actually getting benefits, not just filing. And if that's falling, it doesn't suggest problems in the labor market. The June's jobs forecast not changed yet. 225 is the number so far for tomorrow. We'll see when we go into the report at 8:30 in the morning. Speaking of ADP, I wanted to show this chart here because ADP has been coming in, this is all private sector jobs, lower for the most part for the last year or so than the non-farm payrolls private sector jobs. And look at how high ADP is in comparison to anything else. If we were to get something like that in payroll, you would have quite the bond market reaction. I can tell you that. And then just in from the Federal Reserve, John, Lori Logan, the Dallas Fed president, is a voter. She's out with a speech this morning saying we need to raise rates more. She was one of the people in the minutes who said she wanted to raise rates in June. She says the continuing outlook for above target inflation and a stronger than expected labor market calls for more restrictive monetary policy. So she's the first one out. Next week we get Daly, Mester, Bostic, Barkin, Kashkari. A lot of Fed speak, and it's going to be very interesting in the wake of all these employment numbers to see what they have to say.
Mike McKee, you did the hard work yesterday. You read through those minutes. I found them somewhat confusing. Go through them for me. How splintered is that Federal Reserve right now?
They are definitely have a division there because several members wanted to raise rates. That's more than two. So you do have a contingent at the Fed who thinks that they're going to have to do more and should have done more, which means that there is a strong likelihood, given what everybody has said, that we're locked in now pretty much on a July rate move. And the question we'll get out of maybe tomorrow's numbers is how locked in are we going to be on September?
Still got some PMIs coming up in the next hour. Mike McKee will touch base with you in just a moment. Michael Kontopoulos, I want to talk to you about the recession call. The recession call, which just seems to be pushed out and pushed out and pushed out and pushed out continuously. Is the second half too soon to make a recession call based on the information we're looking at this morning?
It sure seems like it is. You know, there's an irony to this, Jonathan. We've spoken about it before, which is that the stronger the data comes in, the more aggressive the Fed ultimately needs to be, and that increases the probability of a hard landing. Now, when that ultimately occurs, you know, whether it's later this year, in the first half of next year, in the second half of next year, you know, we can't be sure. Clearly, the data, to Krishna's point, is surprising to the upside. But what I worry about is the stresses that we're seeing in the weakest parts of the credit market. And as I look at things like repeat filers or small private companies, when I look at the amount of distressed companies out there, the fact that the floating rate sub-investment grade part of the market is now nearly $3 trillion between private credit and the leveraged loan market, you've got some real potential stress coming from higher interest payments that these companies are going to have to incur. and ultimately likely layoffs and a lack of investment in CapEx in order to continue as going concerns. And so when does that happen? Does it happen in the second half of this year? I mean, anything's possible, but it doesn't look like that's going to be the case. But certainly, I think at some point, you will see something break here, and I think it's going to come from the credit markets, quite frankly.
Well, we saw it break several months ago. We had bank failures, and we've moved on pretty quickly since then. Michael, you made the connection there between a market problem, potentially, and an economic impact. Do you think that is a market issue, or is that a broader economic problem on the horizon?
I actually think it's going to be both. It could be a market issue and a broader economic issue. I mean, listen, what's happened so far this year, right? It's been really an environment where certainly, you've had risk run because of, data that surprised the upside. But let's be frank, you've had a huge increase in tech, comm services, discretionary on the back of expectations for the Fed cutting and an AI mania. That can easily go away if the Fed's going to hike another 25, 50, 75, or 100 basis points. And then you've got the underlying stress in the credit markets really kind of denting the economic outlook. Again, maybe 6 months out, maybe 9 months out, we don't know. So I think it's both. You could really see a big unraveling of everything we've seen so far this year, wider credit spreads, a broader economic impact. But it doesn't, I mean, listen, I don't want to be too dire here. I mean, it doesn't feel like this is going to be the case in the next 3 months or maybe even the next 6 months. And so there's certainly a lag, and I wouldn't be too quick to say it's imminent.
Well, let's be clear. That's not what's been developing, and you're acknowledging that right now. The S&P 500, double-digit gains year to date, high-yield spreads, tight, south of 400 basis points. Credit to you, Krishna. A lot of people have struggled with this equity market. You've said repeatedly, continuously through this year, upside risk to equities. That could be the pain trade. That's been a pain trade, Krishna, for so many people. Krishna, away from equities now, what do you think the pain trade is?
I think the pain trade really is in the bond market. That is, the economy has to start slowing down somewhat. Labor markets have to soften. And if that doesn't happen, then the Fed has to make a decision as to how are they going to tackle this challenge. One option is to continue to raise Fed funds rates to 6%. They can certainly do that, but I think if they start going down that path too hard, then it creates a problem in the banking sector. So I think the more likely outcome is they probably raise it to 5.5%, somewhere less than 6% anyway, and just hold it for a lot longer than what the markets are anticipating. And if that ends up being the accepted thesis in the market, I have difficulty understanding how 10-year at 4% ends up being the end point of a pain trade.
Well, that's what I want to build on. 2-year, that's easy stuff. If you expect more hikes, ultimately you get a higher 2-year yield, 5% plus. New cycle highs right now. Earlier on this morning, 511.76. I want the 10-year call from you, Krishna. 4% right now. Have we seen a cycle high? Where do you think that high is?
No, I think 4.5 at the current pace anyway. 4.5 is probably more likely the cycle high than 4%. The real action, as you said, is really in the 10-year. The 2-year is going to move, is really more Fed funds determined. 4% is really more about longer-term policy outlook from the Fed, whether they hold a high Fed funds level for a really long period of time, and that is what is looking very likely at the moment. I think on the 10-year front, one of the things why the 10-year has held down as well as it has is because of inflation expectations remaining somewhat anchored, not somewhat anchored, very well anchored. But that doesn't mean real rates cannot go up, and I think that's where the pain trade will manifest itself.
Mike, you get the final word on this one. On a 10-year, what's your stance now?
I mean, listen, I think it'll be tough to break through the fall highs of 4.35. I mean, that was really driven based on, some boneheaded moves by what was going on in England in terms of tax cuts and high inflation, and of course the Bank of Japan defending the currency. And I don't see unless you get something like that again, I don't think the 10-year is going to go appreciably higher than where we were in the fall. I mean, Krishna's absolutely right? The long end of the yield curve is a representation of future growth and inflation expectations. And if the Fed can remain, credible and bring down inflation and growth expectations, then the 10-year shouldn't go up that much higher. And if they fail to bring down inflation expectations or anchor them as they have so far, if they were to kind of get unhinged, then certainly you have higher to go. I think I have a lot of faith in the Fed's ability to be able to bring down growth and bring down inflation. And so, yeah, I think we've probably seen the highs, but at this point, it's anybody's guess. But I think, Jonathan, what the last thing I will just say is, at the end of the day, to me, what matters is the end game. The path to get to that end game, it might be a little bit unclear and uncertain, but the end game is likely lower because I just don't see how we get inflation to 2% without really denting labor and without causing a hard landing. And so I see much lower 10-year yields as the ultimate destination, but who knows what happens between now and then.
Mike, Krishna, to the both of you, thank you. What a 44 minutes we've just seen. 44 minutes ago, no one cared about the ADP report, and then 1 minute after that, all of a sudden people care about the ADP report. Often that's how it goes. 497,000, the number. That's the print, the expectation, the estimate, 225, the runway through this morning. We move on to a PMI that comes out a little bit later this hour. ISM services coming out too. We get jobs, job openings, all of that good stuff onto payrolls tomorrow. Yields are flying through 5% on 2s, through 4% on 10s. Let's get you some movers. Here's Abby.
John, let's keep it super simple. And on that super hot ADP report and those yields flying higher, big tech is down. In fact, Apple right now in the pre-market is set to open back below the $3 trillion mark. The price to watch is $190.73. Right now on pace for its third down day in a row, the longest losing streak potentially for Apple going back to, and actually we don't have Apple on this board, but Tesla is also lower, representation of big tech being lower, down 1.6%. On the other hand, Meta still getting a little bit of a boost from its competition to Twitter. And big tech overall, John, it's down as yields are in fact higher.
Abby, thank you. We'll stay on tech. Coming up on the program, Mark Zuckerberg's Meta taking on Elon Musk's Twitter.
If you look at anything that's tried to challenge Twitter in terms of any of the other platforms, it's been very difficult to scale. The question is, how much resources are they going to put into this? And is this just sort of a moonshot type project or something that they really want to scale?
That conversation up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
The question is, how much resources are they going to put into this? And is this just sort of a moonshot type project or something that they really want to scale? And look, I think for Zuckerberg, they went from a position of massive weakness, going back to, when you talk about 8-9 months ago, to now it's a flex the muscles moment. Monetizing has obviously been key. Ultimately, that's been the issue for Twitter. That's been the uphill battle.
It is Zuck versus Musk as Meta launches its new Threads app. The platform designed as a direct rival to Twitter, collecting more than 10 million sign-ups within the first 7 hours. The CEO, Mark Zuckerberg, celebrating their debut with his first tweet in 11 years, taking a playful jab at Elon Musk. Musk responding shortly after tweeting, quote, "It's infinitely preferable to be attacked by strangers on Twitter than indulge in the false happiness of hide the pain Instagram." Let's bring in the Bloomberg team. Ed Ludlow on the West Coast, Mandeep Singh here in New York, Alex Webb over in London. Ed, I have to say, you've looked at it, I've looked at it, we're both on it. Looks a lot like Twitter, doesn't it?
Looked at it, I spent hours on it. It was the most strange afternoon of my life, to be honest. But that was what was happening. You know, 10 million's the latest figure. It's probably higher by now. And lots of people acknowledged straight away on the platform it is the same. That is the meme that Zuckerberg tweeted, right? It's a reference to episode 19B of the 1967 Spider-Man called Double Identity, basically saying, there it is, good timing, Mr. Director. It's the same thing. And a lot of people acknowledge it. That said, you know, from a technology perspective, John, I've been engaging with a lot of market analysts, a lot of users as well. They point out there are some UX differences that they don't like about Threads, that they do like about Twitter. But the pace of adoption, that's what was really interesting to me Wednesday afternoon.
10 million, 7 hours. Mandeep, what is critical mass? How big do you think that needs to be and how quickly?
I mean, look, as you said, you know, right now everyone is trying to grab their handles, but to me the key is, you know, the feed and the algorithm that goes into driving engagement. And time and again, we have seen anytime you change the algorithm on Twitter, people start to complain. And look, they have amassed an interest graph over the last 15 years. It's hard to bring in that interest and follower graph on Threads overnight, even though Instagram has a great, you know, stack and they can leverage a lot of the user data they currently have, but it still won't be able to replicate that Twitter interest follower graph. And to me, the algorithm is the key. That's what TikTok did with their video platform. That's what Meta needs to do with Thread algorithm in terms of how they curate the feed.
Alex, this effort clearly accelerated. Any idea where this leaves leadership over at Twitter and their next move?
And I'm sure we'll see the sort of fairly characteristic Elon Musk braggadocio saying everything's fine, no need to worry. The likelihood of things changing anyway with the new leadership, Linda Yaccarino coming in, trying to forge closer relationships with advertisers, many of whom have left the Twitter platform. I think the key thing, as sort of Mandeep partially alludes to, is like, do you lose the power users, the people who generate a huge amount of the content disproportionately to the number of users they are, even if there's only 10, maybe 20 million at this stage users over on Threads, are they those people? And therefore you're losing the stuff that drives a lot of your engagement and by extension then losing the advertisers. Those are the people they really need to keep. And they seem to, at least judging by the current evidence, like old Twitter. If you've got your head screwed on, maybe you think about, well, do we need to be more like old Twitter?
Alex, how seriously do you think creditors will be taking this morning after that unveiling yesterday evening? Creditors to Twitter, to Elon Musk specifically.
I mean, I wonder whether actually anything has changed because things already seem pretty dire over at Twitter. This seems to be another piece of bad news rather than necessarily being the nail in the coffin. There's probably a certain amount of panic. We saw Fidelity writing down the value of their stake in or their investment in Twitter by, you know, 3/4 in May. That's already considerably bad news for people who have helped Elon Musk buy the business.
Mandeep, Twitter was never a great business, regardless of who ran Twitter. And I'm wondering, Mandeep, if this is ultimately something that Meta can achieve themselves in-house. Is this a business you want to try and build out?
I think for Meta, it's you know, an engagement play. Right now, their top line growth is not going to come from adding more users. They already have 3 billion users across their family of apps. It's going to come from driving engagement. And they did that with Reels. If they can add another dimension in terms of, you know, real-time conversations, politics, news, etc., with Twitter, that'll be huge, not only for, you know, the incremental ad dollars, but also the large language model that they're trying to develop, the proprietary data that they have around users and their interests. I think this will be huge.
Mandeep, we're going to stand top of the story with you, sir. Thank you. Mandeep Singh with Alex Webb. To the both of you, thank you. Ed, I know we're going to touch base around the opening bell in about 7 or 8 minutes' time. Looking forward to doing so. Your equity market right now, negative 0.9% on the S&P 500, about 7 or 8 minutes away from the opening bell. About an hour ago, if you are just tuning in, you missed this one, a blowout upside surprise on the ADP report. A jobs report here in America coming in hot, 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 just south of 500,000, 497K, the estimate 225. That just in front of payrolls tomorrow morning. That sent equities down, yields absolutely flying. The 2-year yield is up by 13 basis points at the moment at 5.07%. The 10-year is up by 11 to just north of 4. Coming up, the morning calls, and then more on that move in this equity market with Amy Wu Silverman of RBC. From New York, this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
Stocks near session lows here, about 5 minutes out from the opening bout. We're down 1% on the Nasdaq, down a similar amount on the S&P 500. That's the price action. Here are some morning calls. First up, Baird downgrading American Express to neutral, 185 price target, seeing a more balanced risk reward following the stock's recent outperformance. Finally, KeyBank raising its meta price target to $335, saying the company's new Threads platform could represent billions of dollars in ad revenue. Think we've got another call in there. Have we skipped it? Okay, we might have skipped it. Coming up, another piece of hot economic data. That's next with RBC's Amy Wu Silverman.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So It's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
20 seconds or so away from the opening bell. Let's whip through the price action for you. Equity futures negative 0.9% on the S&P. On the Nasdaq, we're down by a little more than 1%. The main event, the last hour or so, it's all about the ADP report coming in much hotter than anticipated, driving equities down and yields much, much higher. There's the opening bell. Switch on the board and get to the bond market. The bond market looks like this. Treasuries down, yields up and away. Up by 9 basis points on a 10-year through 4%, 4.0271% on a 10-year this morning. Dollar not showing much strength off the back of that move. The euro just south of 109 at 108.85. We're positive on that currency pair by 0.3%. And to round things out in the commodity market, down by 0.4%. No drama there. $71 and about 50 cents. Let's get to one sector to watch at the open. The airlines. JetBlue terminating its joint venture with American following a judge's ruling against the partnership, writing, quote, JetBlue has made the difficult decision not to appeal the court's determination, beginning a wind-down process that will take place over the coming months. The airline now shifting to focus on completing a $3.8 billion acquisition of Spirit Airlines. Kelly Lyons joined us in D.C. for more. Hey, Kaylee.
Hey, John, this literally seems to be a matter of picking battles because, as you said, you did have that federal court ruling that its Northeast alliance with American Airlines violated antitrust laws. That was one legal fight they had underway, the other being the challenge to that $3.8 billion merger with Spirit, which JetBlue says it needs in order to scale and compete with the carriers that dominate in the U.S. market. But the U.S. has concerns about market concentration in certain cities that could give that company, a merged company, pricing and competitive advantages. So JetBlue deciding to focus on saving that deal, going to wind down that alliance with American, which is why you are seeing JetBlue and American shares lower in the first few minutes of trading here, each down about 2%, whereas Spirit Airlines, the ticker there, SAVE, on the idea that this may help the odds of that merger actually going through, is up by about 1.6%. I would note that JetBlue CEO Robin Hayes did say in a statement that he's hoping that taking the DOJ's, quote, misplaced concerns about this partnership off the table could help, though, when they go to trial this fall, actually obtain Spirit Airlines. That trial is set to begin on October 16th, John, so we'll all have to eagerly await that result.
Kelly, thanks for that. JetBlue down about 2%, American down by 1.5%, Spirit up by 1.9%. About 2 minutes into the session, we are down by 1% on the Nasdaq. On the S&P, we're down by 0.9%. Much of this off the back of this move in the bond market, off the back of the ADP report about an hour ago. We're going to get some more data in the next 30 minutes. PMI and services, the ISM just around the corner. Job openings as well, so looking forward to all of that. I want to turn to energy. Shares of Exxon under pressure after saying lower nat gas prices and refining margins should reduce its Q2 results by roughly $4 billion. Analysts at RBC Capital weighing in, writing this. The update is likely to be viewed negatively for earnings expectations, and we expect consensus numbers to move lower over the coming days. Abby has more. Hey, Abby.
Hey, John. Yeah, this is not good, and this suggests that the earnings season that we're moving into now could be under some pressure. This is the first big pre-announcement that I'm aware of with this company, basically lowering the guidance below what the street was looking for. They are saying that the lower natural gas prices and the refining margins are going to reduce the second quarter earnings. If you recall, well, actually you were away, you missed this one, but General Mills, their outlook was not great because consumers are finally not willing to pay up for their brand prices. So totally two different sectors, but I think that the big takeaway here from this Exxon this pre-announcement, is the idea, again, that this earnings season that's coming up could be a little bit challenged, and analysts are across the street somewhat neutral here, basically saying that this guidance that they provided was a bearish miss.
Abby, thank you. Stock down 1.5%. Broader equity market near session low, still falling, down about 1% on the S&P 500 right now. Keeping an eye on that. Also keeping an eye on the automakers, Tesla and China's top EV makers, signaling a truce to their price war, with top executives pledging to, quote, adhere to industry rules and regulations, regulate marketing activities, maintain fair competition, and not disrupt fair competition with abnormal pricing. David Welsh, the Bloomberg Detroit Bureau Chief, joins us now for more. David, is that the price war over?
It was already starting to abate even before this. I think maybe they had all pushed each other until they collectively cried uncle. But okay, I think once they go public with this, and they were probably nudged strongly by the government to cut it out, I think probably it is. You may see some adjustments here and there, but yeah, I think they probably will. It's kind of a strangely worded agreement if you look at it. One of the things was promote core socialist values, I think. And they were very careful not to make it sound like price fixing. But I think there is kind of, a collective will to say, all right, let's kind of normalize things if we can. And consumers were very upset about some of these price cuts, too, if they had paid more weeks before.
Yeah, you do wonder how much certainty you'd have going out to buy a car and wondering whether in a couple of weeks' time it's going to be much, much cheaper. David, thanks for that. David Welch there of Bloomberg on the latest. Big implications for Tesla, of course, and maybe some good news for Elon Musk. Some not so good news for Elon Musk, with shares of Meta getting a boost at the opening bell. Instagram officially launching its new Threads platform, an app designed as a direct rival to Twitter. The CEO, Mark Zuckerberg, posting his first message on Threads, writing, I think there should be a public conversations app with 1 billion plus people on it. Twitter has had the opportunity to do this, but it hasn't nailed it. Ed Ludlow joins us now for more again. Ed, question, I guess, is whether Meta or Instagram Threads can nail it.
Yeah, there was a lot of enthusiasm at the open. We were up more than 1% on Meta, now down actually flat on the stock, so it was a pretty short-lived higher open. Bernstein has a note out, John, posing this question, whether they could ever achieve critical mass to make it a competitor to Twitter. KeyBank Capital Markets has actually raised its price target to $335 from $280. They see in the near term Threads being an immaterial contributor to Meta's financials, but longer term do pose the question what kind of ad streams it could bring in. That Zuckerberg comment about a platform with 1 billion users and Twitter's failure to achieve that scale, that was kind of the most interesting development to me in the last 24 hours. A fun fact, John, that if you consider all of the user base of Meta's other properties, Facebook, Instagram, and WhatsApp, they would only have to onboard 1 in 10 of each of those users to the Threads platform to eclipse what Twitter was able to do with its